The Market Wizards. Conversations with America's Top Traders. Jack D. Schwager, Prologue. The name of the book was The Big Board. It was about an Earthling man and woman who were kidnapped by extraterrestrials. They were put on display in a zoo on a planet called Zircon 212. These fictitious people in the zoo had a big board supposedly showing stock market quotations and commodity prices along one wall of their habitat, and a news ticker, and a telephone that was supposedly connected to a brokerage on Earth. The creatures on Zircon 212 told their captives that they had invested $1 million for them back on Earth, and that it was up to the captives to manage it so that they would be fabulously wealthy when they were returned to Earth. The telephone and the big board and the ticker were all fakes, of course. They were simply stimulants to make the Earthlings perform vividly for the crowds at the zoo, to make them jump up and down and cheer, or gloat, or sulk, or tear their hair, to be scared shitless, or to feel as contented as babies in their mother's arms. The Earthlings did very well on paper. That was part of the rigging, of course, and religion got mixed up in it too. The news ticker reminded them that the President of the United States had declared National Prayer Week and that everybody should pray. The Earthlings had had a bad week on the market before that. They had lost a small fortune in olive oil futures. So they gave praying a whirl. It worked. Olive oil went up. Kurt Vonnegut Jr. Slaughterhouse 5. If the random walk theorists are correct, then earthbound traders are suffering from the same delusions as the zoo inhabitants of Kilgore Trout's novel. Kilgore Trout is the ubiquitous science fiction writer in Kurt Vonnegut's novels, whereas the prisoners on Zircon 212 thought their decisions were being based on actual price quotes. They were not real-life traders. Believe they can beat the market by their acumen or skill. If markets are truly efficient and random in every time span, then these traders are attributing their success or failure to their own skills or shortcomings, when in reality it is all a matter of luck. After interviewing the traders for this book, it is hard to believe this view of the world. 1. Comes away with a strong belief that it is highly unlikely that some traders can win with such consistency over vast numbers of trades and many years. Of course, given enough traders, some will come out ahead even after a long period of time, simply as a consequence of the laws of probability. I leave it for the mathematicians to determine the odds of traders winning by the magnitude and duration that those interviewed here have. Incidentally, the traders themselves have not a glimmer of doubt that, over the long run, the question of who wins and who loses is determined by skill, not luck. I, too, share this conviction. My own story. Right out of graduate school, I landed a job as a commodity research analyst. I was pleasantly surprised to find that my economic and statistical analysis correctly predicted a number of major commodity price moves. It was not long thereafter that the thought of trading came to mind. The only problem was that my department generally did not permit analysts to trade. I discussed my frustration over this situation with Michael Marcus, first interview, with whom I became friends while interviewing for the research position he was vacating. Michael said, I had the same problem when I worked there. You should do what I did, open an account at another firm. He introduced me to a broker at his new firm who was willing to open the account. At the time, I was earning less than the department secretary, so I didn't exactly have much risk capital. I had my brother open a 2000 account for which I acted as an advisor. Since the account had to be kept secret, I could not call in any orders from my desk. Every time I wanted to initiate or liquidate a position, I had to take the elevator to the building's basement to use the public phone. Marcus's solution to the same problem is discussed in his interview. The worst part of the situation was not merely the delays in order entry, which were often nerve-wracking, but the fact that I had to be very circumspect about the number of times I left my desk. Sometimes I would decide to delay an order until the following morning in order to avoid LT. Rearing any suspicion. I don't remember any specifics about my first few trades. All I recall is that, on balance, I did only a little better than break even after paying commissions. Then came the first trade that made a lasting impression. I had done a very detailed analysis of the cotton market throughout the entire post-World War period. I discovered that because of a variety of government support programs, only 2 seasons since 1953 could truly be termed free markets. I correctly concluded that only these 2 seasons could be used in forecasting prices. Unfortunately, I failed to reach the more significant conclusion that existing data were insufficient to permit a meaningful market analysis. Based on a comparison with these 2 seasons, I inferred that cotton prices, which were then trading at 25 cents per pound, would move higher, but peak around 32-33 cents. The initial part of the forecast proved correct as cotton prices edged higher over a period of months. Then the advance accelerated, and cotton jumped from 28 to 31 cents in a single week. This latest rally was attributed to some news I considered rather unimportant. Close enough to my projected top, I thought, and I decided to go short. Thereafter, the market moved slightly higher, and then quickly broke back to the 29-cent level. This seemed perfectly natural to me as I expected markets to conform to my analysis. My profits and elation were short-lived, however, as cotton prices soon rebounded to new highs and then moved unrelentingly higher. 32 cents, 33 cents, 34 cents, 34 cents. Finally, with my account equity wiped out, I was forced to liquidate the position. Not having much money in those days may have been one of my luckiest breaks. Since cotton eventually soared to an incredible level of 99 cents, more than double the century's previous high price. That trade knocked me out of the box for a while. Over the next few years, I again tried my hand at trading a couple of times. In each instance, I started with not much more than 2,000 and eventually wiped out because of a single large loss. My only consolation was that the amounts I lost were relatively small. 2 things finally broke this pattern of failure. First, I met Steve Kronowitz. At the time, I was the commodity research director at Hornblower Amp, Weeks, and I hired Steve to fill a slot as the department's precious metals analyst. Steve and I shared the same office, and we quickly became good friends. In contrast to myself, a pure fundamental analyst, Steve's approach to the markets was strictly technical. The fundamental analyst uses economic data to forecast prices, while the technical analyst employs internal market data, such as price, volume, and sentiment to project prices. Until that time, I had viewed technical analysis with great skepticism. I tended to doubt that anything as simple as chart reading could be of any value. Working closely with Steve, however, I began to notice that his market calls were often right. Eventually, I became convinced that my initial assessment of technical analysis was wrong. I realized that, at least for myself, fundamental analysis alone was insufficient for successful trading. I also needed to incorporate technical analysis for the timing of trades. The second key element that finally put me into the winner's column was the realization that risk control was absolutely essential to successful trading. I decided that would never again allow myself to lose everything on a single trade, no matter how convinced I was of my market view. Ironically, the trade that I consider my turning point and one of my best trades ever was actually a loss. At the time, the Deutsche Mark had carved out a lengthy trading range following an extended decline. Based on my market analysis, I believed that the Deutsche Mark was forming an important price base. I went long within the consolidation, simultaneously placing a good till canceled stop order just below the recent low. I reasoned that if I was right, the market should not fall to new lows. Several days later, the market started falling and I was stopped out of my position at a small loss. The great thing was that after I was stopped out, the market plummeted like a stone. In the past, this type of trade would have wiped me out. Instead, I suffered only a minor loss. Not long thereafter, I became bullish on the Japanese yen, which had formed a technically bullish consolidation, providing a meaningful close point to place a protective stop. While I normally implemented only a 1-contract position, the fact that I felt reasonably able to define my risk at only 15 ticks per contract today, I find it hard to believe that I was able to get away with that close a stop, allowed me to put on a 3-contract position. The market never looked back. Although I ended up getting out of that position far too early, I held one of the contracts long enough to triple my small account size. That was the start of my success at trading. Over the next few years, the synthesis of technical and fundamental analysis combined with risk control allowed me to build my small stake into well over $100,000. Then the streak ended. I found myself trading more impulsively, failing to follow the rules I had learned. Retrospect, I believe I had just become too cocky. In particular, I remember a losing trade in soybeans. Instead of taking my loss when the market moved against me, I was so convinced that the decline was a reaction in a bull market that I substantially increased my position. The mistake was compounded by taking this action in front of an important government crop report. The report came out bearish, and my equity took a dramatic decline. In a matter of days, I had surrendered over 1/4 of my cumulative profits. After cashing in my chips to buy a house and later taking a year-long sabbatical to write a book, my savings were sufficiently depleted to defer my re-entry into trading for nearly 5 years. When I began trading again, typical to my usual custom, I started with a small amount, $8,000. Most of this money was lost over the course of a year. I added another $8,000 to the account and, after some further moderate setbacks, eventually scored a few big winning trades. Within about 2 years, I had once again built my trading account up to over $100,000. I subsequently stalled out, and during the past year, my account equity has fluctuated below this peak. Although objectively, my trading has been successful on an emotional level, I often view it with a sense of failure. Basically, I feel that given my market knowledge and experience, I should have done better. Why? I ask myself, have I been able to multiply a sub-$10,000 account more than tenfold on 2 occasions, yet unable to expand the equity much beyond that level, let alone by any multiples? A desire to find the answers was one of my motivations for writing this book. I wanted to ask those traders who had already succeeded, what are the key elements to your success? What approach do you use in the markets? What trading rules do you adhere to? What were your own early trading experiences? What advice would you give to other traders? While on one level, my search for answers was a personal quest to help surpass my own barriers, in a broader sense, I saw myself as everyman, asking the questions I thought others would ask if given the opportunity. Jacked. Schwager, A Complete Guide to the Futures Markets, John Wiley Amp, Sons, New York, New York, New York, 1984. Taking the Mystery Out of Futures. Of all the markets discussed in this book, the futures market is probably the one least understood by most investors. It is also one of the fastest growing. Trading volume in futures has expanded more than 20-fold during the past 20 years. In 1988, the dollar value of all futures contracts traded in the U.S. exceeded $10 trillion. Obviously, there's a lot more than pork belly trading involved here. Today's futures markets encompass all of the world's major market groups, interest rates, for example, T-bonds, stock indexes, for example, the S&P 500, currencies, for example, Japanese yen, precious metals, for example, gold, energy, for example, crude oil, and agricultural commodities, for example, corn. Although the futures markets had their origins in agricultural commodities, this sector now accounts for only about 1/5 of total futures trading. During the past decade, the introduction and spectacular growth of many EW contracts has resulted in the financial-type markets, currencies, interest rate instruments, and stock indexes, accounting for approximately 60%. This is a rough but conservative estimate based on 246 million contracts traded and assuming an average contract value well over $40,000. Excluding short-term interest rate futures, such as Eurodollars, single contract values ranged from about $11,000 for sugar at 100 to $150,000 for the S&P 500 at an index value of 300. Of all futures trading, energy and metal markets account for nearly half of the remaining 40%. Thus, while the term commodities is often used to refer to the futures markets, it has increasingly become a misnomer. Many of the most actively traded futures markets, such as the financial instruments, are not truly commodities, while many commodity markets have no corresponding futures markets. The essence of a futures market is in its name. Trading involves a standardized contract for a commodity, such as gold, or a financial instrument, such as T-bonds, for a future delivery date, as opposed to the present time. For example, if an automobile manufacturer needs copper for current operations, it will buy its materials directly from a producer if However, the same manufacturer was concerned that copper prices would be much higher in 6 months. It could approximately lock in its costs at that time by buying copper futures now. This offset of future price risk is called a hedge. If copper prices climb during the interim, the profit on the futures hedge would approximately offset the higher cost of copper at the time of actual purchase. Of course, if copper prices declined instead, the futures hedge would result in a loss, but the manufacturer would end up buying its copper at lower levels than it was willing to lock in. While hedgers, such as the above automobile manufacturer, participate in futures markets to reduce the risk of an adverse price move, traders participate in an effort to profit from anticipated price changes. In fact, many traders will prefer the futures markets over their cash counterparts as trading vehicles for a variety of reasons. 1. Standardized contracts. Futures contracts are standardized in terms of quantity and quality. Thus, the trader does not have to find a specific buyer or seller in order to initiate or liquidate a position. Liquidity. All of the major futures markets provide excellent liquidity. 2. 3. Ease of going short. The futures markets allow equal ease of going short as well as long. For example, the short seller in the stock market, who is actually borrowing stock to sell, must wait for an uptick before initiating a position. No such restriction exists in the futures markets. 4. Leverage. The futures markets offer tremendous leverage. Roughly speaking, initial margin requirements are usually equal to 5 to 10% of the contract value. The use of the term margin in the futures market is unfortunate because it leads to tremendous confusion with the concept of margins in stocks. In the futures markets, margins do not imply partial payments since no actual physical transaction occurs until the expiration date. Rather, margins are basically good faith deposits. Although high leverage is one of the attributes of futures markets for traders, it should be emphasized that leverage is a two-edged sword. The undisciplined use of leverage is the single most important reason why most traders lose money in the futures markets. In general, futures prices are no more volatile than the underlying cash prices, or for that matter, many stocks. The high-risk reputation of futures is largely a consequence of the leverage factor. 5. Low transaction costs. Futures markets provide very low transaction costs. For example, it is far less expensive for a stock portfolio manager to reduce market exposure by selling the equivalent dollar amount of stock index futures contracts than by selling individual stocks. 6. Ease of offset. A futures position can be offset at any time during market hours, providing prices are not locked at limit up or limit down. Some futures markets specify daily maximum price changes. In cases in which free market forces would normally seek an equilibrium price outside the range of boundaries implied by price limits, the market will simply move to the limit and virtually cease to trade. 7. Guaranteed by exchange. The futures trader does not have to be concerned about the financial stability of the person on the other side of the trade. All futures transactions are guaranteed by the clearinghouse of the exchange. Since by their very structure, futures are closely tied to their underlying markets, the activity of arbitrageurs assures that deviations are relatively minor and short-lived. Price moves in futures will very closely parallel those in the corresponding cash markets. Keeping in mind that the majority of futures trading activity is concentrated in financial instruments, many futures traders are in reality traders in stocks, bonds, and currencies. In this context, the comments of futures traders interviewed in the following chapters have direct relevance even to investors who have never ventured beyond stocks and bonds. The interbank currency market. Defined: the interbank currency market is a 24-hour market which literally follows the sun around the world, moving from banking centers in the US to Australia to the Far East to Europe, and finally back to the US and the market exists to fill the need of companies to hedge exchange risk in a world of rapidly fluctuating currency values. For example, if a Japanese electronics manufacturer negotiates an export sale of stereo equipment to the US with payment in dollars to be received 6 months hence, that manufacturer is vulnerable to a depreciation of the dollar versus the yen during the interim. If the manufacturer wants to assure a fixed price in the local currency, yen, in order to lock in a profit, He can hedge himself by selling the equivalent amount of US dollars in the interbank market for the anticipated date of payment. The banks will quote the manufacturer an exchange rate for the precise amount required for the specific future date. Speculators trade in the interbank currency market in an effort to profit from their expectations regarding shifts in exchange rates. For example, a speculator who anticipated a decline in the British pound against the dollar would simply sell forward British pounds. All transactions in the interbank market are denominated in US dollars. A speculator who expected the British pound to decline versus the Japanese yen would buy a specific dollar amount of Japanese yen and sell an equivalent dollar amount of British pounds. Michael Marcus Blyting never strikes twice. Michael Marcus began his career as a commodity research analyst for a major brokerage house. His near-compulsive attraction to trading led him to abandon his salaried position to pursue full-time trading. After a brief, almost comical, stint as a floor trader, he went to work for Commodities Corporation, a firm that hired professional traders to trade the company's own funds. Marcus became one of their most successful traders. In a number of years, his profits exceeded the combined total profit of all the other traders. Over a 10-year period, he multiplied his company account by an incredible 2,500-fold. I first met Marcus the day I joined Reynolds Securities as a futures research analyst. Marcus had accepted a similar job at a competing firm, and I was assuming the position he had just vacated. In those early years in both our careers, we met regularly. Although I usually found my own analysis more persuasive when we disagreed, Marcus ultimately proved right about the direction of the market. Eventually, Marcus accepted a job as a trader, became very successful, and moved out to the West Coast. When I first conceived the idea for this book, Marcus was high on my list of interview candidates. Marcus's initial response to my request was agreeable, but not firm. Several weeks later, he declined, as his desire to maintain anonymity dominated his natural inclination to participate an endeavor he found appealing. Marcus knew and respected many of the other traders I was interviewing. I was very disappointed because Marcus is one of the finest traders I have been privileged to know. Fortunately, some additional persuasion by a mutual friend helped change his mind. When I met Marcus for this interview, it had been 7 years since we had last seen each other. The interview was conducted in Marcus's home, a two-house complex set on a cliff overlooking a private beach in Southern California. You enter the complex through a massive gate, amazing gate as described by an assistant who provided me with driving directions, that would probably have a good chance of holding up through Panzer Division attack. On first greeting, Marcus seemed aloof, almost withdrawn. This quiet side of Marcus's personality makes his description of his short-lived attempt to be a floor trader particularly striking. He became animated, however, as soon as he began talking about his trading experiences. Our conversation focused on his early roller coaster years, which he considered to be the most interesting of his career. How did you first get interested in trading futures? I was something of a scholar in 1969. I graduated from Johns Hopkins Phi Beta Kappa near the top of my class. I had a PhD fellowship in psychology at Clark University and fully expected to live the life of a professor. Through a mutual friend, I met this fellow named John, who claimed he could double my money every 2 weeks like clockwork. It sounded very appealing. I don't think I even asked John how he could do it. It was such an attractive idea that I didn't want to spoil things by finding out too many facts. I was afraid I would get cold feet. Weren't you skeptical? Didn't he sound too much like a used car salesman? No, I had never invested in anything, and I was very naive. I hired John, who was a junior at my school, to be my commodity trading advisor at $30 a week. Occasionally, I threw in free potato chips and soda. He had a theory that you could subsist on that diet. That's all you paid him. Weren't there any profit incentives, extra potato chips if he did well? No. How much money did you allot for trading? About $1,000 that I had saved up. Then what happened? My first trip to a brokerage house was very, very exciting. I got dressed up, putting on my only suit, and we went to the Reynolds Securities office in Baltimore. It was a big, posh office, suggesting a lot of old money. There was mahogany all over the place and hushed, reverential tone permeated the office. It was all very impressive. The focal point was a big commodity board at the front of the office, the kind that clicked the old-fashioned way. It was really exciting to hear the click, click, click. They had a gallery from which the traders could watch the board, but I was so far away that we had to use binoculars to see the prices. That was also very exciting, because it was just like watching a horse race. My first realization that things might become a little scary was when a voice came over the loudspeaker recommending the purchase of soybean meal. I looked at John, expecting to see an expression of confidence and assurance on his face. Instead, he looked at me and asked, "Do you think we should do it?" It quickly dawned on me that John didn't know anything at all. I remember soybean meal was trading quietly, 783,078. 0.4078. We put the order in, and as soon as we got the confirmation back, almost mystically, the prices started clicking down. As soon as it knew that I was in, the market took that as a signal to start descending. I guess I had good instincts even then, because I immediately said to John, "We're not doing too well. Let's get out." We lost about $100 on that trade. The next trade was in corn, and the same thing happened. John asked me whether we should do the trade. I said, "Well, all right, let's try calm." The outcome was the same. Did you know anything at all about what you were doing? Had you read anything about commodities or trading? No, nothing. Did you even know the contract sizes? No, we didn't. Did you know how much it was costing you per tick? Yes. Apparently, that was about the only thing you knew. Right. Our next trade in wheat didn't work either. After that, we went back to corn, and that trade worked out better. It took us 3 days to lose our money. We were measuring success by the number of days it took us to lose. Were you always getting out after about a 100 loss? Yes. Although one trade lost almost $2,001 was down to about $500 when John came up with an idea that was going to save the day. We would buy August pork bellies and sell February pork bellies because the spread was wider than the carrying charges. He said we couldn't lose on that trade. I vaguely understood the idea and agreed to the trade. That was the first time we decided to go out to lunch. All the other times we had been too busy scrutinizing the board. But we thought this was a can't-lose trade, so it was safe to leave. By the time we came back, I was just about wiped out. I remember this feeling of shock, dismay, and incredulity. I will never forget the image of John. He was a very portly guy with thick, opaque glasses going up to the quote board, pounding and shaking his fist at it and shouting, "Doesn't anyone want to make a guaranteed profit?" Later on, I learned that August pork bellies were not deliverable against the February contract. The logic of the trade was flawed in the first place. Had John ever traded before? No. So where did he come up with this story about doubling your money every 2 weeks? I don't know. But after that trade, I was wiped out. So I told John that in light of what happened, I thought I knew as much as he did, which was nothing, and that I was going to fire him. No more potato chips. No more diet soda. I'll never forget his response. He told me, "You are making the greatest mistake of your life." I asked him what he was going to do. He said, "I am going to Bermuda to wash dishes to make a trading stake. Then I am going to become a millionaire and retire." The thing that amused me was that he didn't say, "I'm going to Bermuda and take a job to make a trading stake." He was very specific. He was going to wash dishes to get his trading stake. What eventually happened to John? To this day, I have no idea. For all I know, he might owe living in Bermuda as a millionaire because he washed dishes. After that, I managed to rustle up another 500 and placed a few silver trades. I wiped out that stake as well. My first 8 trades, 5 with John and 3 on my own, were all losers. Did the thought ever enter your mind that maybe trading was not for you? No. I had always done well at school, so I figured it was just a question of getting the knack of it. My father, who died when I was 15, had left $3,000 in life insurance, which I decided to cash in, despite my mother's objections. But I knew I really needed to learn something before trading again. I read Chester Keltner's books on wheat and soybeans, and I also subscribed to his market letter, which made trading recommendations. I followed the first recommendation, which was to buy wheat, and it worked. I think I made 4 cents per bushel on that trade. It was my first win and very exciting. Then between letters, the market fell back to my original buying price, so I bought it again and made another profit on my own. I felt I was beginning to develop a sense for trading. Even in the beginning, I liked the feeling of doing things on my own. What happened next was just sheer luck. I bought 3 contracts of December corn in the summer of 1970s, based on a Keltner recommendation. That was the summer that blight devastated the corn crop. Was that your first big win? Yes, that trade combined with buying some more wheat and soybeans, partly on recommendations in the letter and partly on my own intuition. When that glorious summer was over, I had accumulated 30,000, a princely sum to me, having come from a middle-class family. I ought it the best thing in the world. How did you decide when to take profits? I took some on the way up and some when the market started coming down. Overall, I cashed in very well. So instinctively you were doing the right thing even then. Yes. Then that fall, I attended graduate school in Worcester, Massachusetts, but I found that I didn't want to think about my thesis. Instead of going to class, I would often sneak down to the Payne-Weber office in Worcester to trade. I was having a great time. I made a little money, not a lot. I was shocked to find myself cutting classes. Frequently, since I had been a dedicated scholar at Johns Hopkins, I realized that the handwriting was on the wall, and in December 1971 dropped out of school and moved to New York. I stayed at the Y for a while. When people asked me what I did, I rather pompously told them that I was a speculator. It had a nice ring to it. In the spring of 1971, the grain started getting interesting again. There was a theory around that the blight had wintered over. That is, it had survived the winter and was going to attack the corn crop again. I decided I would be really positioned for the blight this time. Was this Keltner's theory or just a market rumor? I think Keltner believed it too. I borrowed $20,000 from my mother, added it to my $30,000 and bet everything on the blight. I bought the maximum number of corn and wheat contracts possible for $50,000 in margin. Initially, the markets held steady because there was enough fear of the blight to keep prices up. I wasn't making money, but I wasn't losing it either. Then one day, I will never forget this. There was an article in the Wall Street Journal with the headline, "More blight on the floor of the Chicago Board of Trade than in Midwest cornfields." The corn market opened sharply lower and fairly quickly went limit down. High many futures markets, the maximum daily price change is restricted by a specified limit. Limit down refers to a decline of this magnitude, while limit up refers to an equivalent gain. If, as in this case, the equilibrium price that would result from the interaction of free market forces lies below the limit down price, then the market will lock limit down. That is, trading will virtually cease. Reason: there will be an abundance of sellers but virtually no willing buyers at the restricted limit down price. Were you watching the market collapse? Yes, I was in the brokerage office watching the board as prices fell. Did you think of getting out on the way down before the market was locked limit down? I felt that I should get out, but I just watched. I was totally paralyzed. I was hoping the market would turn around. I watched, and then, after it locked limit down, I couldn't get out. I had all night to think about it. But I really had no choice. I didn't have any more money and had to get out. The next morning, I liquidated my entire position on the opening. Was the market sharply lower again on the opening? No, not sharply, just about 2 cents. How much did you lose on the trade by the time you liquidated? I lost my own $30,000, plus $12,000 of the $20,000 my mother had lent me. That was my lesson in betting. My whole wad. What did you do then? I was really upset. I decided I had to go to work. Since there was a recession at the time, I thought I probably couldn't get a really good job and should try to settle for a lesser position. I found that even though I interviewed for positions for which I was unusually well qualified, I couldn't seem to get any job. I finally realized that I couldn't get these jobs because I didn't really want them. One of the best job openings I found was a commodity research analyst slot at Reynolds Securities. I discovered that it was easier to get this better position because they could tell I really wanted it. I learned that if you shoot for what you want, you stand a much better chance of getting it because you care much more. Anyway, There was a glass partition between the office and the main office where the brokers sat. I still had the trading bug, and it was very painful to watch them trading and whooping it up. While you were just doing the research? Right, because the analysts were strictly forbidden to trade. But I decided I wouldn't let that stop me. I borrowed from my mother again, my brother, and my girlfriend, and opened an account at another firm. I worked out an intricate code system with my broker to keep people in my office from knowing that I was violating the rules. For example, if I said the sun was out, that meant one thing, while if I said the weather is cloudy, it meant something else. While I was trying to write my market reports, I kept peering out through the glass partition to see the prices on the big trading board in the main office. When I was winning, I tried to hide my elation, and when I was losing, I had to make sure not to let it show on my face. I don't think anyone ever caught on, but I was in a manic depressive state throughout that time. I felt tortured because I wanted to be free to trade without going through this elaborate charade. Were you making or losing money during this time? I lost. It was the same old cycle of borrowing money and consistently losing it. Did you know what you were doing wrong then? Good question. Basically, I had no real grasp of trading principles. I was doing everything wrong. Then in October 1971, while at my broker's office, I met one of the people to whom I attribute my success. Who was that? Ed Sikota. He is a genius and a great trader who has been phenomenally successful. When I first met Ed, he had recently graduated from MIT and had developed one of the first computer programs for testing and trading technical systems. I still don't know how Ed amassed so much knowledge about trading at such an early age. Ed told me, "I think you ought to work here. We're starting a research group and you can trade your own account." It sounded great. The only problem was that the firm's research director refused to hire me. I couldn't imagine why, since I wrote well and had experience. When I pressed him for a reason, he told me, "I can't hire you because you already know too much and I want to train somebody." I said, "Look, I will do anything you want." Eventually, I convinced him to hire me. It was really great because I had Ed to learn from, and he was already a very successful trader. He was basically a trend follower who utilized classic trading principles. He taught me how to cut my losses, as well as the importance of riding winners. Ed provided an excellent role model. For example, one time, he was short silver and the market just kept eking down, a half penny a day, a penny a day. Everyone else seemed to be bullish, talking about why silver had to go up because it was so cheap. But Ed just stayed short. Ed said, "The trend is down and I'm going to stay short until the trend changes." I learned patience from him in the way he followed the trend. Did Ed's example turn you around as a trader? Not initially. I continued to lose, even with Ed there. Do you remember what you were still doing wrong at that time? I think I wasn't patient enough to wait for a clearly defined situation. Did you think of just tailcoating Ed because he was so successful? No, I couldn't bring myself to do that. Did you ever think of just giving up on trading? I would sometimes think that maybe I ought to stop trading because it was very painful to keep losing. In Fiddler on the Roof, there is a scene where the lead looks up and talks to God. I would look up and say, "Am I really that stupid?" And I seemed to hear a clear answer saying, "No, you are not stupid. You just have to keep at it." So I did. At the time, I was befriended by a very kind, knowledgeable, and successful semi-retired broker at Shearson, named Amos Hostetter. He liked my writing, and we used to talk. Amos reinforced a lot of the things Ed taught me. I was getting the same principles from two people. Were you making recommendations for the firm at the time? Yes. And how did the recommendations work out? They were better because I was more patient. Anyway, I was totally out of money and out of people who would lend me money. But I still had a kind of stubborn confidence that I could somehow get back on the right track again. I was only making $12,500 a year, but I managed to save $700. Since that wasn't even enough to open an account, I opened a joint account with a friend who also put up $700. Were you totally directing the trading in this joint account? Yes, my friend didn't know anything about the markets. This was in July 1972, and at the time we were under price controls. The futures market was supposedly also under price controls. This was Nixon's price freeze? Yes. As I recall, the plywood price was theoretically frozen at $110 per 1,000 square feet. Plywood was one of the markets I analyzed for the firm. The price had edged up close to 110, and I put out a bearish newsletter saying even though supplies were tight, since prices couldn't go beyond 110. There was nothing to lose by going short at $110. How did the government keep prices at the set limits? What prevented supply and demand from dictating a higher price? It was against the law for prices to go higher. You mean producers couldn't charge more for it? Right. What was happening, though, was that the price was being kept artificially low, and there is an economic principle that an artificially low price will create a shortage. So shortages developed in plywood, but supposedly the futures market was also under this guideline. However, no one was sure. It was sort of a gray area. One day, while I was looking at the quote board, the price hit 110, then it hit 11,010, then 11,020. In other words, the futures price was trading 20 cents over the legal ceiling. So I started calling around to see what was going to happen, but nobody seemed to know. Was plywood the only market exceeding its price freeze level? Yes. Anyway, nothing happened. I think the market closed somewhere over 110 that day. The next day it opened at about $11,080. 1 cent used the following reasoning. If they let it trade over $110 today, they might let it trade anywhere. So I bought one contract. Well, ultimately, plywood went to 200. After I bought that first contract and prices rose, it was just a matter of pyramiding and riding the position. Was that your first really big trade after you had been wiped out in the corn market? Yes. Did the cash plywood market stay at 110? The futures market functioned as a supply of last resort to users who couldn't get supplies elsewhere. Basically, it created a two-tiered market, a sort of legal black market? Yes, those who were frozen out because they didn't have any long-standing relationships with producers could get their plywood at a higher price in the futures market. The producers were fuming at the thought that they had to sell at the legal price ceiling. Why didn't producers just sell futures and deliver against the contract as opposed to selling in the cash market at the price control level? The smarter ones were learning that. But it was the infancy of futures trading in plywood, and most producers weren't that sophisticated. Some producers probably weren't sure that it was legal to do that. Even if they thought it was, their lawyers might have told them, maybe people can buy plywood at any price in the futures market, but we better not sell and deliver above the legal ceiling. There were a lot of questions. Did the government ever try to interfere with the futures markets? Well, not exactly, but I will get back to that. In just a few months, 700 had grown into $12,000 trading. Plywood. Was this the only trade you had on? Yes. Then I got the bright idea that the same shortage situation was going to occur in lumber. I bet everything on one trade just as I had on the corn-wheat trade, expecting that lumber would also go through the seal. Price. What was lumber doing at this time? It did nothing. It just watched plywood go from $110 to $200. Since they were both wood products, and lumber was also in short supply, I reasoned that lumber could go way up, and it should have. However, after I bought lumber at around 130, the government finally woke up to what had happened in plywood, and they were determined not to let the same thing happen in lumber. Day after I went long, some government official came out with an announcement that they were going to crack down on speculators in lumber who were trying to ran up the market like they had plywood. The lumber market crashed just on that statement. I was down to the point where I was close to being wiped out again. There was a 2-week period during which they kept issuing these statements. The market stabilized at a level just above where I would have been wiped out. I had just enough money left to hang on to my position. The market was at 130 when you bought it. Where was it at this time? About $117. So even though the magnitude of this decline was much smaller than the price rise in plywood, you lost almost as much money because you had a much larger position in lumber than you had in plywood. During those 2 weeks, I was constantly on the verge of being wiped out. It was the worst 2 weeks in my whole life. I went to the office each day just about ready to give up. Giving up just to stop the pain, or so that you would at least have something left. Both. I was so upset that I couldn't stop my hands from shaking. How close did you come to being wiped out again? Well, my 12,000 had shrunk to under $4,000. Did you say to yourself, I can't believe I have done this again? Yes, and I never did it again. That was the last time I bet everything on one trade. What eventually happened? I managed to hold on and the market finally turned around. There was a shortage and the government didn't seem to have the will to stop the futures market. Was it insight or courage that gave you the willpower to hold on? Desperation, mainly, although there was a support point on the charts that the market couldn't seem to take out. So I held on. At the end of that year, the 700, which I had ran up to over $12,000 and back to under $4,000, was now worth $24,000. After that scary experience, I never really overtraded again. Next year, 1973, the government began lifting the price controls. Because the price controls had created numerous artificial shortages when they were lifted, there was a tremendous run-up in many commodities. Just about everything went up. Prices doubled in many markets, and I was able to take advantage of the tremendous leverage offered by low futures margins. The lessons I had learned from Schwager about staying in markets with major trends really paid off. In 1973, my account grew from $24,000 to $64,000. At that time, we were seeing something completely new. I remember those markets. Even after prices had gone up only 10% of their eventual advance, historically, it seemed like a very large price move. What made you realize that prices could go so much further? At the time, I was politically right-wing, and that fit with being an inflation alarmist. The theory that the evil government was constantly debasing the currency provided the perfect perspective for trading the inflationary markets of the mid-1970s. It was the right theory for the right time. Right. The markets were so fertile for trading then that I could make plenty of mistakes and still do well. Trading strictly on the long side? Yes. Everything was going up. Although I was doing very well, I did make one terrible mistake. During the great soybean bull market, the one that went from $325 to nearly $121, impulsively took my profits and got out of everything. I was trying to be fancy instead of staying with the trend. Ed Schwager never would get out of anything unless the trend changed. So Ed was in while I was out, and I watched in agony as soybeans went limit up for 12 consecutive days. I was real competitive, and every day I would come into the office knowing he was in and I was out. I dreaded going to work because I knew soybeans would be bid limit again and I couldn't get in. Was this experience of not being in a runaway market as aggravating as actually losing money? Yes, more so. It was so aggravating that one day I felt I couldn't take it anymore, and I tried tranquilizers to dull the mental anguish. When that didn't work, somebody said, "Why don't you take something stronger called Thorazine?" I remember taking this Thorazine at home and then getting on the subway to go to work. The subway doors started to close as I was getting on, and I started to fall down. At first, I didn't connect it with the Thorazine. Anyway, I wandered back home and just fell through the doorway. It was that strong. It knocked me out and I missed work that day. That was the low point in my trading career. You never threw in the towel and just went back into soybeans at some point? No, I was afraid of losing. Despite that mistake, you mentioned before that you built your account up to $64,000 by year end. What happened next? Around that time, I would occasionally have to go over to the cotton exchange. I would have an adrenaline rush when I heard the traders yelling and screaming. It seemed like the most exciting place in the world. But I learned that I needed to show $100,000 net worth to get in. Since I had virtually no assets outside of my commodity account, I couldn't qualify. I continued to make money in the markets, and after several months, I had surpassed the $100,000 mark. Around that same time, Ed Schwager recommended that I go long coffee. So I did, but I put a close stop in under the market just in case it went down. The market turned down and I was stopped out quickly. Ed, however, because he was a major trend follower, had no stop in and ended up being locked in a limit down market for several days in succession. Each day, Schwager was locked in a losing position while I was out of the market. That was the exact opposite situation of the soybean trade, when he was in a winning trade and I was out. I couldn't help it, but I felt a sense of joy. I asked myself, what kind of a place is this that one's greatest joy is to be found when somebody else is getting screwed? That was the point I realized that what I was doing was too competitive. and I decided to become a floor trader at the New York Cotton Exchange. It sounds like the floor would have been even more competitive. Well, maybe, but it wasn't. Did you have any concern about being a floor trader? The fact that you were now reducing your field of opportunity down to one market? I was a little concerned about it. As it turned out, I should have been very worried. However, the thought of trading in the ring was very exciting to me. The truth of the matter was that while I was very good at picking trades, I was a total bust at the execution part. I was very shy, and I was too timid to yell loud enough to make myself heard on the floor. I ended up slipping my orders to a floor trader friend of mine, who handled them for me. It went on for a few months until I realized what I was doing. Were you still approaching the markets as a position trader even though you were on the floor? Yes, but it was just out of timidity, so I assume that many days you weren't even trading, right? Was there any advantage to being on the floor? No, not for me. But I did learn a lot from the experience, and I would recommend it to anybody who wants to become a better trader. I used what I learned there for years. What type of things did you learn? You develop an almost subconscious sense of the market on the floor. You learn to gauge price movement by the intensity of the voices in the ring. For example, when the market is active and moving and then gets quiet, that is often a sign that it is not going to go much further. Also, sometimes when the ring is moderately loud and suddenly gets very loud, instead of being a sign that the market is ready to blast off, as you might think, it actually indicates that the market is running into a greater amount of opposing orders. But how do you use that type of information once you are off the floor? You said that the things you learned on the floor helped you later on. I learned the importance of intraday chart points, such as earlier daily highs. At key intraday chart points, I could take much larger positions than I could afford to hold, and if it didn't work immediately, I would get out quickly. For example, at a critical intraday point, I would take a 20-contract position instead of the 3 to 5 contracts. I could afford to hold using an extremely close stop. The market either took off and ran, or I was out. Sometimes I would make 300,400 points or more, with only a 10-point risk. That was because, by being on the floor, I had become familiar with how the market responded to those intraday points. My trading in those days was a little bit like being a surfer. I was trying to hit the crest of the wave just at the right moment. But if it didn't work, I just got out. I was getting a shot at making several hundred points and hardly risking anything. I later used that surfing technique as a desk trader. Although that approach worked real well then, I don't think it would work as well in today's markets. Is that because the markets have become choppier? Right. In those days, if the market reached an intraday chart point, it might penetrate that point, take off, and never look back. Now it often comes back. So what is the answer? I think the secret is cutting down the number of trades you make. The best trades are the ones in which you have all three things going for you: fundamentals, technicals, and market tone. First, the fundamentals should suggest that there is an imbalance of supply and demand, which could result in a major move. Second, the chart must show that the market is moving in the direction that the fundamentals suggest. Third, when news comes out, the market should act in a way that reflects the right psychological tone. For example, a bull market should shrug off bearish news and respond vigorously to bullish news. If you can restrict your activity to only those types of trades, you have to make money in any market under any circumstances. Is that more restrictive trading style the approach you eventually adopted? No, because basically I enjoyed the game too much. I knew that I should only be in those optimum trades, but trading was a release and hobby for me. It replaced a lot of other things in my life. I placed the fun of the AC machine ahead of my own criteria. However, the thing that saved me was that when a trade met all my criteria, I would enter 5 to 6 times the position size I was doing on the other trades. Were all your profits coming from the trades that met the criteria? Yes. Were the other trades breaking even? The other trades broke even and kept me amused. Did you keep track of which were which so you knew what was going on? Just mentally. My goal on the other trades was just to break even. I knew that the big money was going to be made on the trades that met my criteria. There will always be trades that meet those requirements, but there may be fewer of them, so you have to be much more patient. Why are there fewer such trades? Has the marketplace gotten more sophisticated? Yes. There are many more professional traders than in my early days. In those years, I had an edge just by knowing the angles that Ed Sikota and Amos Hostler taught me. Now everybody knows those principles. You have trading rooms filled with bright people and computers. In those days, you watched the board, and you would buy corn when it moved above a key chart point. An hour later, the grain elevator operator would gel a call from his broker, and he mile by. The next day, he brokerage house would recommend the trade, pushing the market up some more. On the third day, we would get short covering from the people that were wrong, and then some fresh buying from the dentists of the world, who finally got the word that I was the right time low buy. Ow, that lime. I was one of the first ones low buy because I was one of the few professional traders playing the game. I would wind up selling out to the dentists several days later. Trade. You're talking about short-term trades. Weren't you trading for the major moves? I traded some major moves, but many times I would make my profits in 2 or 3 days in USL, that kind of when did you get back in the market. The dentists weren't going to keep their positions, since they were buying at the wrong time. So when the market would fall back, I would go back in. Nowadays, the moment the market breaks a key chart point, it is perceived by a whole universe of traders. So the lagged follow-up trades are no longer there. Right? The grain elevator operator has already bet. The dentists don't count because their level of trading participation is infinitesimal. Is that because they now have their money invested with fund managers instead of trading by themselves? Right, and even if the dentists are still there, they are trading one lots, which is a meaningless position when the fund managers are trading 1,000 at a clip. Now you almost have to be contrary. You have to ask, isn't it true that all my fellow professional traders are already in, so who is left to buy? You didn't have to worry about that before, because there was always somebody left by the people who were getting the information or reacting slower. Now, everybody is just as decisive, just as fast. Are the markets more prone to false breakouts now? Yes, much more. Are trend-following systems then doomed to mediocrity? I believe so. I believe that the era of trend following is over until and unless there is a particular imbalance in a market that overrides everything else. Another exception would be if we were to enter a major inflationary or deflationary environment. In other words, unless there is some very powerful force that can overwhelm everything else. Yes. Have the markets changed during the past 5 to 10 years because professional money managers now account for a much greater proportion of speculative trading activity, as opposed to the small speculators who tend to make all the mistakes? The markets have changed. The proof is that Richard Dennis, who has done well for many years, lost over 50% on the funds he was managing in 1988. The trend-following systems approach doesn't work anymore. The problem is that once you have defined a trend and taken a position, everyone else has taken a position as well. Since there's no one left to buy, the market swings around in the other direction and gets you out. One reason we don't have many good trends anymore is that the central banks are preventing currency moves from getting out of hand by taking the other side of the trend. Haven't they always done that? I don't think so. If you look at a chart of treasury debt held by foreign central banks, you will see that it has risen astronomically during the last few years. The foreign banks seem to be taking over from private foreign investors in financing our trade debts. What do you think that means in terms of trading, and has your own trading style changed because of it? At one time, I traded heavily in currencies. For example, in the years after Reagan was first elected and the dollar was very strong, I would take positions as large as 600 million Deutsche Marks between my own account and the company account. At the time, that was about $300 million line worth. That was a pretty good line. I was probably one of the bigger currency traders in the world, including the banks. It was very exhausting because it was a 24-hour market. When I went to sleep, I would have to wake up almost every 2 hours to check the markets. I would tune in every major center as it opened: Australia, Hong Kong, Zurich, and London. It killed my marriage. Nowadays, I try to avoid the currencies because I feel it is a totally political situation. You have to determine what the central banks are going to do. When you are trading the currencies actively, Were you getting up through the night because you were worried about getting caught on the wrong side of a major move before the markets opened in the US? Yes. Did you always trade that way, or did you get caught enough times so that you started trading around the clock? It happened enough times to make me leery. There would be a big gap move that you could have avoided by trading overseas. That is right. For example, I remember one time during late 1978, the dollar was getting battered, falling to new lows every day. This was during a period when I was cooperating and trading as a colleague with Brace Kovner. We used to talk hours every day. One day, we noticed that the dollar got mysteriously strong. There was an intense price movement that couldn't be explained by any known information. We just bailed out of our long currency positions like crazy. That weekend, President Carter announced a dollar support program. If we had waited until the next U.S. trading session, we would have been annihilated. That situation illustrates one of the principles we believed in, namely, that the big players, including the governments, would always tip their hand. If we saw a surprise price move against us that we didn't understand, we often got out and looked for the reason later. I remember that market well. The currency futures markets were locked limit down for several days in a row after that announcement. You must have gotten out right near the top of that market. We made a great exit on that trade. Anyway, my point is that I believe, as a courtesy, the European central banks are notified about major changes we're going to make, and they often act ahead of U.S. policy announcements. Consequently, the price move shows up in Europe first, even if it is because of something we initiate. If it's an action initiated by the Europeans, the price move is certainly going to occur there first. I think the best hours to trade are often in Europe. If I had a period in which I was going to devote my life to trading, I would want to live in Europe. Let's go back and fill in some of your trading history. Where did you go after you decided to give up on being a floor trader? I got a call from Amos Hostetter, who had befriended me at Shearson. At the time, he was also trading some money for Commodities Corporation. Amos told me that I would be well advised to consider joining Commodities Corporation as a trader. At the time, their theory was that they were going to hire all these great econometricians to be traders. They had people like Paul Samuelson on the board. They brought up the idea of hiring me at a meeting. The first question was, what articles has he written? In what journals has he been published? I had a BA in liberal arts, and that was it. The punchline was, he just trades. Everybody thought that was very funny. But weren't they in business to make money trading? They didn't think it was possible to really make money unless you had a PhD, but Amos convinced them to give me a chance. Believe I was the first non-PhD trader they had ever hired. They started me out with $30,000 in August 1974. After about 10 years, I had turned that account into $80 million slian. Those were some very good years. Did you multiply the original $30,000 into $80 million slian, or did they add money along the way? After the first few years, they gave me another $100,000 to trade. After that time, they were always taking money out. Those years, they were in an expansionary phase, and they taxed the trader 30% a year to pay for their expenses. So you had to make 30% a year to keep your account level. You must have had some incredible return years, given the growth of your account, particularly under that handicap. I was making at least 100% a year for years and years. What was your best year? My best year must have been 1979. It was an incredible year. I caught gold when it went up to over $800. You caught the whole move? I was in and out, but I remember catching big chunks of it, $100 per ounce at a time. It was a wild time. In those days, I would buy gold in Australia. Hong Kong would push it up $10 higher. It would go up another 10 in London. And by the time New York opened, I was able to sell out at a 30 profit. It sounds like there was an enormous advantage to buying gold in the overseas markets rather than in the United States. In those days, I had an advantage by being in California, because I was up trading in Hong Kong when my New York colleagues were asleep. I remember when I heard about the invasion of Afghanistan on the television news. I called Hong Kong to see if anybody knew about it, and nobody seemed to. The price wasn't changing. I was able to buy 200,000 ounces of gold before anybody knew what was happening. That's 2,000 contracts. Did you have any liquidity problems with their taking on that size position? In Hong Kong? No, they gave me the stuff. But of course they got fried by doing it. I was told on my last visit to Hong Kong that I shouldn't visit the gold floor. Some of the people still remember that episode. They knew who was on the other side of the trade. Yes, they knew. Did they think that you knew something? No, they probably thought I was just crazy, coming in and buying all that gold. Then, when the news broke about 5 to 10 minutes later, everybody started scrambling. I had an immediate 10 per ounce profit on 200,000 ounces. It's hard to believe you could trade off the television news. I know, I had never done it before. That was the first, last, and only time, but I did do it. That particular gold market ended in a near vertical rise and fall. Did you get out in time? Yes, I got out around $750 on the way up. I felt sick when I saw gold go up to nearly $900. But later when it was back down to $4,001, felt much better about it. All in all, you got out very well. What tipped you off that we were near a top? At that time, we had many wild markets. One of my rails was to get out when the volatility and the momentum became absolutely insane. One way I had of measuring that was with limit days. In those days, we used to have a lot of situations when a market would go limit up for a number of consecutive days. On the third straight limit up day, I would begin to be very, very cautious. I would almost always get out on the fourth limit up day. And if I had somehow survived with any part of my position that long, I had a mandatory rail to get out on the fifth limit up day. I just forced myself out of the market on that kind of volatility. Your transition from being a losing trader to being very successful coincided with the big bull phase in the commodity markets during the early to mid-1970s. How much of your early success was due to your skills as a trader, and how much was just the markets? Honestly, I think the markets were so good that by buying and holding you just couldn't lose. There were a lot of other success stories. Fortunes were being made, but a lot of those people didn't keep their fortunes. That's true, but I was very fortunate. By the time the markets got difficult again, I was a good trader. By then, I had really learned my craft. Also, by that time, I had the advantage of having become very knowledgeable in one market, cocoa. For almost 2 years, I traded almost nothing but cocoa because of the information and help I got from Helmut Weimar, the founder of Commodities Corporation. Helmut was an incredible expert on cocoa. Hell wrote a book that was so deep I couldn't understand the cover also. He had all kinds of friends in the business. With the knowledge and information I got from Helmut and his friends, I felt that I knew the universe of cocoa in a way that I had never known any market before. That phase of almost exclusive cocoa trading obviously came to an end. What happened? Helmut retired from cocoa trading. I assume Helmut was not nearly as successful a trader as you were. Let's just say that I traded much better on Helmut's information than he did. Excluding the early losing years, were there any trades that stand out as being particularly traumatic? Well, I would never let myself get caught up in potentially intimidating disasters. The worst situation occurred during my heavy currency trading period. I was doing well and could afford to hold large positions. One time I had a really large position in Deutsche Marks when the Bundesbank came in and decided to punish the speculators. I called in just around the time that all this was happening and found out that I was out $2,000 million in about 5 minutes. So I got out, rather than see the $2,000 million loss go to $10 million lion. Then I had to endure the disturbing experience of watching the market recover its entire fall. How long after you got out? About half an hour. Did you go back in? No. They had taken the starch out of me by that point. In retrospect, do you feel you did the right thing by getting out of that trade? Yes. But it still hurt to realize that if I had sat it out and done nothing, I would have been okay instead losing $2 million lion. Did you invest any of the money you were making in your trading, or did you keep plowing it back into your own account? I made a number of bad investments and lost a fairly large chunk of the money I had made trading. When I was trading big, I wanted to have a reason to keep doing it, so I just spent money wildly. At one time, I owned about 10 houses and ended up losing money on all of them. Some I sold before I'd even spent a single night in them. I had a plane charter service and lost a lot of money on that. At one point, I figured out that for every dollar I made trading, 30% was going to the government, 30% was going to support my planes, and 20% was going to support my real estate. So I finally decided to sell everything. It sounds like as wise as you were as a trader, you were naive as an investor. Yes, I was incredibly naive. Out of a fairly large number of real estate transactions, many in California, I lost money on all but one of them. I am probably the only person alive that can claim that dubious distinction. Why do you think you did so poorly on your investments? I would do everything emotionally. I didn't analyze anything. In a sense, you were repeating the mistake of your early trading experience, getting involved in something you knew nothing about and then losing money. Didn't any bells go off? It almost sounds like you had a self-destructive instinct in losing your money elsewhere. Yes, absolutely. I probably lost more than half the money I made. During this period when you were doing all these unwise things, didn't anybody try to grab you by the shoulders and say, "Do you realize what you're doing?" Yes. But any time someone on my staff did, I would fire them. At one time, I was employing 60 or 70 people. High addition to all my money-losing businesses, I had a huge nut to make to just support the payroll. Frankly, a lot of the money I made just went down the drain. Did these losses have any of the emotional impact of losses in the market? The reason I ask is that you seem to talk about these investment losses very dispassionately. Yes, it hurt to realize what a fool I had been, but I have learned not to be as attached to material things. I accepted it as a life lesson. I learned I don't have to own a house in every beautiful place in the world. I can stay at a hotel and walk on the beach or climb a trail there. Or, if I really feel like spoiling myself, I can charter a plane. I don't have to own one. Right, that certainly makes sense. But what I am getting at is that I suspect that if you had lost the same amount of money trading, it would have been a much more traumatic experience. Is that because your ego wasn't attached to these other ventures? Yes, I'm sure that's true. I always felt that at least I was smart at one thing. I feel like trading is the only thing I am really good at. If not for that, I probably would have wound up shining shoes. Do you think being a great trader is an innate skill? I think to be in the upper echelon of successful traders requires an innate skill, a gift. It's just like being a great violinist. But to be a competent trader and make money is a skill you can learn. Having been through the whole trading experience from failure to extreme success, what basic advice could you give a beginning trader or a losing trader? The first thing I would say is always bet less than 5% of your money on any one idea. That way you can be wrong more than 20 times. It will take you a long time to lose your money. I would emphasize that the 5% applies to one idea. If you take a long position in two different related grain markets, that is still one idea. The next thing I would advise is to always use stops. I mean, actually put them in, because that commits you to get out at a certain point. Do you always pick a point where you will get out before you get in? Yes, I have always done that. You have to. I would imagine in your case you can't actually put a stop in because your orders are too large. Yes, but my broker can hold it. When you place an order to get into a position, is it accompanied by an order to get out? That's right. Another thing is that if a position doesn't feel right as soon as you put it on, don't be embarrassed to change your mind and get right out. So if you put the trade on and 5 minutes later it doesn't feel right, don't think to yourself, if I get out this quickly, my broker will think that I'm an idiot. Yes, exactly. If you become unsure about a position and you don't know what to do, just get out. You can always come back in. When in doubt, get out and get a good night's sleep. I've done that lots of times, and the next day everything was clear. Do you sometimes go back in right after you get out? Yes, often the next day. While you are in, you can't think. When you get out, then you can think clearly again. What other advice would you give the novice trader? Perhaps the most important rule is to hold on to your winners and cut your losers. Both are equally important. If you don't stay with your winners, you are not going to be able to pay for the losers. You also have to follow your own light. Because I have so many friends who are talented traders, I often have to remind myself that if I try to trade their way or on their ideas, I am going to lose. Every trader has strengths and weaknesses. Some are good holders of winners, but may hold their losers a little too long. Others may cut their winners a little short, but are quick to take their losses. As long as you stick to your own style, you get the good and bad in your own approach. When you try to incorporate someone else's style, you often wind up with the worst of both styles. I've done that a lot. Is it a problem because you don't have the same type of confidence in a trade that isn't yours? Exactly. Hi, the final analysis. You need to have the courage to hold the position and take the risk. If it comes down to I'm in this trade because Brace is in it, then you are not going to have the courage to stick with it. So you might as well not be in it in the first place. Do you still talk to other traders about markets? Not too much. Over the years, it has mostly cost me money. When I talk to other traders, I try to keep very conscious of the idea that I have to listen to myself. I try to take their information without getting overly influenced by their opinion. I assume that we are talking about very talented traders, and it still doesn't make a difference. If it is not your own idea, it messes up your trading, right? You need to be aware that the world is very sophisticated and always ask yourself, how many people are left to act on this particular idea? You have to consider whether the market has already discounted your idea. How can you possibly evaluate that? By using the classic momentum type indicators and observing market tone. How many days has the market been down or up in a row? What is the reading on the sentiment indexes? Can you think of any good examples of market tone tipping you off on a trade? The most classic illustration I can think of is one of the soybean bull markets in the late 1970s. At the time, soybeans were in extreme shortage. One of the things pushing the market up was the weekly government reports indicating strong export commitments and sales. I was holding a heavy long position in soybeans and someone from Commodities Corporation called me with the latest export figures. He said, I have good news and I have bad news. Okay, what is the good news? The good news is that the export commitment figure was fantastic. The bad news is that you don't have a limit position, the maximum permissible speculative position size. They were expecting the market to be limit up for the next 3 days. Actually, I wound up being a little depressed that I didn't have a larger position. The next morning, I entered an order to buy some more contracts on the opening, just in case I got lucky and the market traded before locking limit up. I sat back to watch the fun. The market opened limit up as expected. Shortly after the opening, I noticed a lot of ticks being recorded, as if the market was trading at the limit up. Then prices eased off limit up just as my broker called to report my fills. The market started trading down. I said to myself, soybeans were supposed to be limit up for 3 days, and they can't even hold limit up the first morning. I immediately called my broker and frantically told him to sell, sell, sell. Did you get out of your whole position? Not only that, but I was so excited that I lost count of how much I was selling. I accidentally wound up being short a substantial amount of soybeans, which I bought back 40 to 50 cents lower. That was the only time I made a lot of money on an error. I remember a situation just like that. It was the cotton bull market when prices almost reached $1 a pound. To this day, I recall I was long cotton and the week's export figure came out showing 500,000 bales of exports to China. It was the most bullish cotton export figure I had ever seen. But instead of opening limit up the next day, the market opened only about 150 points higher and then started trading off. That proved to be the exact high. Another interesting example I remember occurred when we were in a very inflationary period and all the commodity markets were trading in lockstep fashion. On one particularly powerful day, almost all the markets went limit up. On that day, cotton opened limit up, fell back, and finished only marginally higher for the day. That was the market peak. Everything else stayed locked limit up, but cotton never saw the light of day again. Is the implied rule that if you find a common behavior between markets, you want to sell the one that is lagging as soon as it starts heading down? You absolutely want to put down a bet when a market acts terribly relative to everything else. When the news is wonderful and a market can't go up, then you want to be sure to be short. What kinds of misconceptions about the markets get people into trouble? Well, I think the leading cause of financial disablement is the belief that you can rely on the experts to help you. It might, if you know the right expert. For example, if you happen to be Paul Tudor Jones's barber and he is talking about the market, it might not be a bad idea to listen. Typically, however, these so-called experts are not traders. Your average broker couldn't be a trader in a million years. More money is lost listening to brokers than any other way. Trading requires an intense personal involvement. You have to do your own homework, and that is what I advise people to do. Any other misconceptions? The foolish belief that there is conspiracy in the markets. I have known many of the great traders in the world, and I can say that 99% of the time the market is bigger than anybody, and sooner or later it goes where it wants to go. There are exceptions, but they don't last too long. You have attributed a lot of your success to Ed and Amos, who taught you the principles of trading. Have you in turn taught other traders? Yes. My best result, in terms of his becoming the best trader I ever worked with, as well as being a close friend, is Bruce Kovner. How much of his success do you attribute to your training, and how much of it was just his own talent? When I first met Bruce, he was a writer and a professor. In his spare time, he was doing some trading. I was staggered by the breadth of trading knowledge he had accumulated in such a short time. I remember the first day I met Bruce, I tried to impress him with complicated concepts. Here I was, a professional trader who in those days spent 15 hours a day trading and analyzing the markets, and I couldn't come up with anything that he couldn't understand. I recognized his talent immediately. That relates to his intellect. But was there something about him that told you that he was going to be a good trader? Yes, his objectivity. A good trader can't be rigid. If you can find somebody who is really open to seeing anything, then you have found the raw ingredient of a good trader, and I saw that in Bruce right away. I knew from the moment I first met him that he was going to be a great trader. What I tried to do was convey to Bruce the principles that Ed and Amos had taught me, along with some of my acquired skills. My best trading occurred when Bruce and I were collaborating. We did some phenomenal trading. There were years when I was up 300% and he was up 1,000%. He had a very great gift. Do you feel you get ground down as a trader? Absolutely. Around 1,983, began to taper off in my trading. I felt that I needed to recharge my batteries. How important is gut feel in trading? Gut feel is very important. I don't know of any great professional trader that doesn't have it. Being a successful trader also takes courage. The courage to try, the courage to fail, the courage to succeed, and the courage to keep on going when the going gets tough. Do you have any goals aside from trading at this point? I have taken karate for many years. I am already at a high level, but I would like to get the black belt. Also, I have made a study of spiritual traditions, and there is a bit more work I would like to do with that. You sound very vague about it. Do you want to be vague? It is very hard to talk about this. Let me see how I can put it. Albert Einstein said that the single most important question is whether the universe is friendly. I think it is important for everybody to come to a point where they feel inside that the universe is friendly. Are you there now? I'm a lot closer, but that's not where you started off. No. I started off with the feeling that it was an unfriendly place. Do you see yourself trading 10 or 20 years from now? Yes, it's too much fun to give up. I don't want to make a lot more money. I would probably just end up losing it in real estate again. Is the fun aspect still there if you're doing it 13 hours a day? No. If trading is your life, it is a torturous kind of excitement. But if you're keeping your life in balance, then it is fun. All the successful traders I've seen that lasted in the business sooner or later got to that point. They have a balanced life. They have fun outside of trading. You can't sustain it if you don't have some other focus. Eventually, you wind up over-trading or getting excessively disturbed about temporary failures. When you do hit a losing streak, how do you handle it? In the past, I've sometimes tried to fight back by trading even heavier after I start losing, but that usually doesn't work. Then I start cutting down very fast to the point of stopping completely if it gets bad enough. But usually it never gets that bad. Do you sometimes manage to fight your way out of it? Sometimes, but most of the time I would have been better off if I had just stopped. I've had trouble bringing myself to do that because I am a natural fighter. The typical pattern is lose, fight like hell, lose again, then cut back or sometimes stop until I get on a winning track. How long have you stopped for? Usually 3-4 weeks. When you are in a losing streak, is it because you are out of sync with the markets, or is there a better way to describe it? I think that in the end, losing begets losing. When you start losing, it touches off negative elements in your psychology. It leads to pessimism. There are very few traders who have been as successful as you. What do you think makes you different? I am very open-minded. I am willing to take in information that is difficult to accept emotionally, but which I still recognize to be true. For example, I have seen others make money much faster than I have, only to wind up giving everything back, because when they started losing, they couldn't stop. When I have had a bad losing streak, I have been able to say to myself, you just can't trade anymore. When a market moves counter to my expectations, I have always been able to say, I had hoped to make a lot of money in this position, but it isn't working, so I'm getting out. Do you keep track of your equity on a day-to-day basis? Do you actually plot it? I have done that a lot in the past. Is that helpful? Do you think it's a good idea for traders to plot their equity? I think so. If the trend in your equity is down, that is a sign to cut back and reevaluate. Or if you see that you are losing money a lot faster than you made it, that would be a warning. Are there any advisors you pay attention to? My favorite market letter in terms of readability, imagination, and knowledge of the subject is the California Technology Stock Letter. CTSL Publishing Partners, 155 Montgomery Street, Suite 1401, San Francisco, California, 94104. I also like the market letters put out by Marty Zweig. The Zweig Letter, The Zweig Forecast, P.O., Box 360, Belmore, New York. And Richard Russell, Dow Theory Letters, Dow Theory Letters, Inc., P.O., Box 1000, La Jolla, California, 92038. Of the traders I have interviewed, Zweig is probably the one most mentioned. You always get something of value out of Marty Zweig. He is very solid. Judging by the letters you have mentioned, I take it that you trade stocks as well. How long have you been trading stocks? For about the last 2 years. Do you trade stocks differently than you trade futures? I'm more patient. Is the selection process different? No. I look for confirmation from the chart, the fundamentals, and the market action. I think you can trade anything in the world that way. Do you focus on any particular types of stock? I don't trade the Dow stocks. I prefer the little ones because they are not dominated by the big professional traders who are like sharks eating each other. The basic principle is that it is better to trade the Australian dollar than the Deutsche Mark, and the small OTC stock than the big Dow stock. What are the fundamentals you look for in a stock? I like to use something I found in Investors Daily, the earnings per share EPS. The EPS ranking is based on comparing the earnings per share growth of a stock relative to all other stocks. For more details on the EPs, see the William O'Neill and David Ryan interviews. I combine the EPs with my own sense of market share potential. If a company has already saturated their little niche in the world, a high EPs is not that important. But in those issues where the EPS is growing and there is still plenty of pie out there, the situation is much more attractive. I also like to look at the price-earnings PE ratio in conjunction with the EPs. In other words, while I like to see a company with a strong earnings growth pattern, I also want to know how much the market is paying for that earnings growth pattern. So you like seeing a high EPs with a low PE, yes, that's the best combination. I am sure there is a way of combining the two on a computer and coming up with a very good system. How about the relative strength, a measure of a stock's price performance relative to all other stocks, which is another key indicator in Investors Daily? I don't think that helps that much. Relative strength tells you what a stock has already done. Frequently, by the time you get a high relative strength figure, the stock has exhausted itself. Is there anything else you look for in a stock? I look at the basic industry. For example, right now, May 1988, I happen to be bullish on tanker rates and therefore the shipping business. For what reasons? Supply and demand. Tanker rates are like commodity prices. They follow a classic cyclical pattern. Prices get high and everyone makes a lot of money, so they build a lot of ships and prices go down. Eventually the ships are scrapped and prices go back up again. We have had very low rates for many years and have scrapped a lot of tankers annually. So we are entering that part of the cycle where prices go back up again. Does trading become more difficult as the size of the account gets bigger? Yes, because you are forced to compete in fewer and fewer markets that are being traded by other big professionals. How much common behavior is there between different markets? For example, can you trade bonds in the same way you trade corn? I really feel that if you can trade one market, you can trade them all. The principles are the same. Trading is emotion. It is mass psychology, greed, and fear. It is all the same in every situation. For most great traders, early failure is more the rule than the exception. Despite an incredible long-term performance record, Michael Marcus began his trading career with an unbroken string of trading losses. Moreover, he wiped out not just once, but several times. The moral is, early trading failure is a sign that you are doing something wrong. It is not necessarily a good predictor of ultimate potential failure or success. I found it particularly interesting that, despite a number of painful trading losses, Marcus's most devastating experience was actually a profitable trade in which he got out prematurely. Taking advantage of potential major winning trades is not only important to the mental health of the trader, but is also critical to winning. In the interview, Marcus stressed that letting winners ride is every bit as important as cutting losses short. In his own words, if you don't stay with your winners, you are not going to be able to pay for the losers. Marcus learned about the dangers of overtrading the hard way. In one instance, the grain trade in the non-existent corn blight year, an account he had built up from a very small stake to 30,000 was wiped out by betting all his money on a single trade. He made the same mistake a second time in the lumber market, coming to the brink of disaster before narrowly escaping. These experiences had a dramatic impact on Marcus's trading philosophy. It is no accident that the first rule he cites when asked to give advice to the average trader is, never commit more than 5% of your money to a single trade idea. In addition to not overtrading, Marcus stresses the importance of committing to an exit point on every trade. He feels that protective stops are very important because they force this commitment on the trader. He also recommends liquidating positions to achieve mental clarity when one is losing money and is confused regarding market decisions. Marcus also emphasizes the necessity of following your own mind as a trader. He suggests that following the advice of others, even when they are good traders, often leads to problems as it combines the worst elements of both traders. Finally, despite being an aggressive trader, Marcus strongly believes in being restrictive in selecting trades. He advises waiting for those trades in which all the key elements line up in one direction. By doing so, you greatly enhance the probability of success on each trade. Making lots of trades when the conditions appear to be only marginally in favor of the trade idea has more to do with entertainment than trading success. Bruce Kovner, the world trader. Today, Bruce Kovner may well be the world's largest trader in the interbank currency and futures markets. In 1987 alone, he scored profits in excess of $300 million for himself and the fortunate investors in his funds. During the past 10 years, Kovner has realized a remarkable 87% averaged annual compounded return. $2,000 invested with Kovner in early 1978 would have been worth over $1 million 10 years later. Despite his incredible track record and huge trading size, Kovner has managed to keep a surprisingly low profile. He has assiduously pursued his privacy by steadfastly refusing all interview requests. "You might be wondering why I consented to this interview," he said. "As a matter of fact, I was, but I did not want to raise the question. I had assumed that his agreement reflected a vote of confidence and trust. 7 years earlier, our paths had crossed briefly when we both worked at Commodities Corporation. He as one of the firm's principal traders, I as an analyst." Kovner continued, "It seems like I can't avoid some publicity, and the stories are usually distorted and fanciful. I thought that this interview would help establish at least one accurate record." Kovner hardly fits the intuitive image of a trader who typically holds positions with a total face value measured in billions of dollars. With his incisive intellect and easygoing manner, he reminds one more of a professor than a giant-scale trader in the highly leveraged currency and futures markets. Indeed, Kovner started out as an academic. After graduating from Harvard, Kovner taught political science courses at Harvard and the University of Pennsylvania. Although he liked teaching, he was not enthused with the academic life. "I didn't enjoy the process of always confronting a blank page in the morning and thinking of something brilliant to write." In the early 1970s, Kovner managed a number of political campaigns with the idea of eventually running for office himself. He abandoned politics because he didn't have the financial resources or the desire to work his way up the political ladder from committee jobs. During this time, he also worked as a consultant for various state and federal agencies. Searching for a career direction, Kovner shifted his attention to the financial markets in the mid-1970s. He believed that his economics and political science education provided the right background, and he found the idea of analyzing the world to make trading judgments tremendously appealing. For about a year, Kovner immersed himself in studying markets and the related economic theory. He read everything he could get his hands on. One subject he studied intensively was interest rate theory. I fell in love with yield curve. The yield curve is the relationship between the yield on government securities and their time to maturity. For example, if each successively longer-term maturity provided a higher yield than a shorter-term maturity, for example, 5-year T-notes at a higher yield than 1-year T-bills, the yield curve would reflect a continually rising slope on a graph. Kovner's study of the interest rate markets coincided with the initial years of trading in interest rate futures. At that time, the interest rate futures market was relatively unsophisticated and price distortions, which would be quickly eradicated by arbitrageurs today, persisted over time. As Kovner explains it, the market hadn't become important enough for Citibank or Salomon Brothers, but it was important enough for me. One of the primary anomalies Kovner discovered was related to the price spread difference between different futures contracts. Futures are traded for specific months, for example, March, June, September, and December. Given the prevailing phase of the business cycle, interest rate theory predicted that the nearby contract, for example March, should trade at a higher price, lower yield, than the next contract, for example June. Although the nearest two contracts did indeed tend to reflect this relationship, Kovner found that the price difference between more forward contracts often started trading at near zero levels. His first trade involved buying a forward interest rate contract and selling a more forward contract, in the expectation that, as the purchased contract became the nearby contract with the passage of time, the price spread between the two contracts would widen. That first trade worked just according to textbook theory, and Kovner was hooked as a trader. His second trade also involved an intra-market spread, the purchase of one contract against the sale of another contract in the same market. In this case, he bought the nearby copper contract and sold a more forward contract, in the expectation that supply tightness would cause the nearby copper contract to gain relative to the forward position. Although his idea eventually proved right, he was too early and lost money on that trade. At the end of these two trades, Kovner was still ahead, with his original $3.00 stake having grown to about $4,000. My third trade is what really put me in the business. In early 1977, an apparent shortage was developing in the soybean market. It was a demand-driven market. Every week, the crush was higher than expected and nobody believed the figures. The crush is the amount of soybeans processed for use as soybean meal and soybean oil. I was watching the July-November spread, the price difference between the old crop July contract and the new crop November contract. Since it looked like we were going to run out of soybeans, I thought that the old crop July contract would expand its premium to the new crop November contract. This spread had been trading in a narrow consolidation near 60 cents premium July. I figured I could easily stop myself out just below the consolidation at around a 45 cents premium. At the time, I didn't realize how volatile the spread could be. I put on one spread, that is, bought July soybeans and simultaneously sold November soybeans near 60 cents, and it widened to 70 cents. Then I put on another spread. I kept on pyramiding. How big of a position did you build up? I eventually built up to a position of about 15 contracts, but not before I had to switch brokerage firms. When I started out, I was trading at a small brokerage house. The head of the company, who was an old floor trader, went over the trades every day and spotted what I was doing. By that time, I had built my position up to about 10 or 15 contracts. The margin on a single outright contract was $2,000, while the spread margin was only $400. He told me, "The spread position you have on trades like an outright long position. I'm going to raise your margins from $400 to $2,000 per contract. Spread margins are lower than outright margins, reflecting the assumption that a net long or short position will be considerably more volatile than a spread position. Reason: in a spread, the long contract portion of the position is likely to at least partially offset price movement in the short contract position. In a shortage situation, however, an intercrop spread, such as long July soybeans, short November soybeans, can prove to be nearly as volatile as a net long or short position. He was obviously quite concerned with the risk in your position. Yes, he was concerned that I had only put up 400 margin per spread, on a spread which behaved like a net long position. Actually, he wasn't that far off. He was right, but I was furious. So I moved my account to another brokerage firm, which shall remain nameless, for reasons that will soon become clear. You were furious because you felt he was being unfair, or well, I am not sure I thought he was being unfair, but I certainly knew he was an obstacle to my objective. I moved my account to a major brokerage house and got a broker who was not very competent. The market kept moving up and I kept adding to my position. I had put on my first spread on February 25. By April 12, my account was up to 35-0. Were you just adding to your position as the market went up, or did you have some plan? I had a plan. I would wait until the market moved up to a certain level and then retraced by a specified amount before adding another unit. My pyramiding did not turn out to be the problem. The market had entered a string of limit-up moves. On April 13, the market hit a new record high. The commotion was tremendous. My broker called me at home and said, "Soybeans are going to the moon. It looks like July is going limit up, and November is sure to follow. You are a fool to stay short the November contracts. Let me lift your November shorts for you, and when the market goes limit up for the next few days, you will make more money." I agreed, and we covered my November short position. All of it, he laughs loudly. Was this a spur-of-the-moment decision? It was a moment of insanity. 15 minutes later, my broker calls me back and he sounds frantic. "I don't know how to tell you this, but the market is limit, Downell. I don't know if I can get you out." I went into shock. I yelled at him to get me out. The market moved off of limit, down by a little bit, and I got out. Did you end up getting out at limit down? I got out between limit down and slightly above limit down. I can tell you the dimensions of the loss. At the moment I covered my short November position, leaving myself net long July, I was up about $45,000. By the end of the day, I had $22,000 in my account. I went into emotional shock. I could not believe how stupid I had been, how badly I had failed to understand the market, in spite of having studied the markets for years. I was sick to my stomach, and I didn't eat for days. I thought that I had blown my career as a trader. But you still had $22,000 compared to your original stake of only $3,000. Keeping things in perspective, you were still in pretty good shape. Absolutely. I was in good shape, but was it the stupidity of the mistake, or was it the money that you had given back that caused such emotional pain? No, it wasn't the money at all. I think it was the realization that there really was fire there. Until then I had ridden $3,000 to $45,000 without a moment of pain. On the way up, did you think this is easy? It was easy. Way? Did you give any thought to the possibility that the market streak could eventually go the other? No. But clearly, my decision to lift the short side of my spread position in the middle of a panic showed a complete disregard for risk. I think what bothered me so much was the realization that I had lost a process of rationality that I thought I had. At that moment, I realized that the markets were truly capable of taking money away every bit as fast as they gave it to you. That made a very strong impression on me. Actually, I was very lucky to get out with $22,000. I assume that your quick action that day probably averted a complete disaster. Absolutely. After that day, the market went straight down as fast as it had gone up. Perhaps if I hadn't made my stupid mistake, I might have made the mistake of riding the market down. What eventually happened to the spread? The spread collapsed. Eventually, it went below the level that I had first begun buying it at. Since you liquidated your position on the day the market and the spread topped, you would have given back a portion of the profits even if it wasn't for the disastrous decision that forced you out of the market. That may be true, but for me, that was my going bust trade. It was the closest I ever came to going bust, and psychologically it felt as if I had. Was that your most painful trade? Yes, far and away. Even though you actually ended up making a substantial amount of money on the trade, I multiplied my money by nearly sixfold on that trade. I was, of course, insanely leveraged, and I didn't understand how risky my position was. Was getting out of your entire position immediately after your broker called to tell you the market was limit down a matter of panic? Or do you think you had some instinctive common sense about controlling risk? I'm not sure. At that moment, I was confronted with the realization that I had blown a great deal of what I thought I knew about discipline. To this day, when something happens to disturb my emotional equilibrium and my sense of what the world is like, I close out all positions related to that event. Do you have a recent example? October 1987, the week of the stock market crash. I closed out all my positions on October 19 and 20s because I felt there was something happening in the world that I didn't understand. The first rule of trading, there are probably many first rails, is don't get caught in a situation in which you can lose a great deal of money for reasons you don't understand. Let's get back to the period after your soybean trade. When did you start trading again? About a month later. After a few months, I had my account back to about $40,000. Around that time, I answered an ad for a trading assistant position at Commodities Corporation. I was interviewed by Michael Marcus in his usual idiosyncratic manner. He had me return to Commodities Corporation several weeks later. Well, he said, I have some good news and some bad news. The bad news is that we are not hiring you as a trading assistant. The good news is that we are hiring you as a trader. How much money did Commodities Corporation give you to trade? $35,000. Were you trading your own money as well at the same time? Yes, and that is something I am very glad about. Commodities Corporation had a policy that allowed you to trade your personal account as well as the company account, and Michael and I were very aggressive traders. Were you influenced by Michael? Oh yes, very much. Michael taught me one thing that was incredibly important. Pause. That is a great lead-in. What is the punchline? He taught me that you could make $1 million. He showed me that if you applied yourself, great things could happen. It is very easy to miss the point that you really can do it. He showed me that if you take a position and use discipline, you can actually make it. It sounds like he gave you confidence. Right. He also taught me one other thing that is absolutely critical. You have to be willing to make mistakes regularly. There is nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. You are one of the most successful traders in the world. There are only a small number of traders of your caliber. What makes you different from the average guy? I'm not sure one can really define why some traders make it, while others do not. For myself, I can think of two important elements. First, I have the ability to imagine configurations of the world different from today and really believe it can happen. I can imagine that soybean prices can double, or that the dollar can fall to 100 yen. Second, I stay rational and disciplined under pressure. Can trading skills be taught? Only to a limited extent. Over the years, I have tried to train perhaps 30 people, and only 4 or 5 of those have turned out to be good traders. What happened to the other 25? They are out of the business, and it had nothing to do with intelligence. When you compare the trainees that made it to the majority that did not, do you find any distinguishing traits? They are strong, independent, and contrary in the extreme. They are able to take positions others are unwilling to take. They are disciplined enough to take the right size positions. A greedy trader always blows out. I know some really inspired traders who never managed to keep the money they made. One trader at Commodities Corporation, I don't want to mention his name, always struck me as a brilliant trader. The ideas he came up with were wonderful. The markets he picked were often the right markets. Intellectually, he knew markets much better than I did, yet I was keeping money and he was not. So where was he going wrong? Position size. He traded much too big. For every 1 contract I traded, he traded 10. He would double his money on 2 different occasions each year, but still end up flat. Do you always use fundamental analysis in forming your trading decisions? I almost always trade on a market view. I don't trade simply on technical information. I use technical analysis a great deal, and it is terrific, but I can't hold a position unless I understand why the market should move. Is that to say that virtually every position you take has a fundamental reason behind it? I think that is a fair statement. But I would add that technical analysis can often clarify the fundamental picture. I will give you an example. During the past 6 months, I had good arguments for the Canadian dollar going down and good arguments for the Canadian dollar going up. It was unclear to me which interpretation was correct. If you had put a gun to my head and forced me to choose a market direction, I probably would have said down. Then the U.S.-Canadian Trade Pact was announced, which changed the entire picture. High fact, the market had broken out on the upside a few days earlier, as the negotiations were finishing up. At that instant, I felt completely comfortable saying that one of the major pieces to the valuation of the Canadian dollar had just changed, and the market had already voted. Prior to the agreement, I felt the Canadian dollar was at the top of a hill, and I wasn't sure whether it was going to roll backwards or forwards. When the market moved, I was prepared to go with flat movement because we had a conjunction of 2 important elements. A major change in fundamentals, although wasn't smart enough to know in which direction it would impact the market, and a technical price breakout on the upside. What do you mean you weren't smart enough to know in which direction the trade pact announcement would move the market? Since U.S.-Canadian trade is so much a larger component of Canadian trade than it is of U.S. trade, wouldn't it have been logical to assume that the trade pact would be bullish for the Canadian dollar? It didn't have to happen that way. I could just as easily have argued that the trade pact was negative for the Canadian dollar because elimination of the trade barriers would allow imports from the W to submerge Canadian interests. There are still some analysts who adhere to that argument. My point is that there are well-informed traders who know much more than I do. I simply put things together. TFA knew which way to go, and they voted in the marketplace by buying Canadian dollars. Is the generalization of that example that when an important fundamental development occurs, the initial direction of the market move is often a good tip-off of the longer-term trend? Exactly. The market usually leads because there are people we know more than you do. For example, the Soviet Union is a very good trader. Good trader in which markets? In currencies and grains to some degree. How does one know what the Soviets are doing? Because the Soviets act through commercial banks and dealers, and you hear about it. It seems rather contradictory to me that a country that is so poor in running its own economy should be a good trader. Yes, but if you ask people in the business, you will find out that they are. Why or how? It is a joke, but perhaps they do read some of our mail. The Soviets and other governments occasionally have advance information. Why shouldn't they? They have the best developed intelligence service in the world. It is a well-known fact in the intelligence community that the Soviets and others are capable of eavesdropping on commercial communication. That is why the large commodity trading firms sometimes use scramblers when they are making very sensitive calls. My point is that there are thousands of difficult-to-understand mechanisms that lead the market, which come into play before the news reaches some poor trader sitting at his desk. But the one thing that does hit the market is a huge sale or purchase. Isn't that the basic rationalization for technical analysis? Technical analysis, I think, has a great deal that is right and a great deal that is might, and that's an interesting statement. What's right and what's black magic? There is a great deal of hype attached to technical analysis by some technicians who claim that it predicts the future. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. But of course, that would be sheer folly. If you are a responsible participant in the market, you always want to know where the market is, whether it is hot and excitable or cold and stagnant. You want to know everything you can about the market to give you an edge. Technical analysis reflects the vote of the entire marketplace and, therefore, does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. It is very important for me to study the details of price action to see if I can observe something about how everybody is voting. Studying the charts is absolutely crucial and alerts me to existing disequilibria and potential changes. Do you sometimes put on a trade because you look at a chart and say, "I've seen this pattern before," and it is often a forerunner of a market advance? That is, even though you may not have any fundamental reasons. Yes, I will do that sometimes. I would only add that as a trader who has seen a great deal and been in a lot of markets. There is nothing disconcerting to me about a price move out of a trading range that nobody understands. Does that imply you usually go with breakouts? Sure, but the markets are often prone to false breakouts. There has to be more to it than that. Tight congestions in which a breakout occurs for reasons that nobody understands are usually good. Squash reward trades. How about breakouts that occur because there is a story in the Wall Street Journal that day? That would be much less relevant. The Heisenberg principle in physics provides an analogy for the markets. If something is closely observed, the odds are it is going to be altered in the process. If corn is in a tight consolidation and then breaks out the day the Wall Street Journal carries a story about a potential shortage of corn, the odds of the price move being sustained are much smaller. If everybody believes there is no reason for corn to break out, and it suddenly does, the chances that there is an important underlying cause are much greater. It sounds like you are saying that the less explanation there is for a price move occurring, the better it looks. Well, I do think that. The more a price pattern is observed by speculators, the more prone you are to have false signals. The more a market is the product of non-speculative activity, the greater the significance of technical breakouts. Has the greatly increased use of computerized trend-following systems increased the frequency of false technical signals? I think so. The fact that there are billions of dollars out there trading on technical systems that use moving averages or other simple pattern recognition approaches helps produce many more false signals. I have developed similar systems myself, so that I can tell when the other systems are going to kick in. If it is clear that prices are moving because these billions are kicking into the market, it is a lot less interesting than if a breakout occurs because the Russians are buying. Let's say you do buy a market on an upside breakout from a consolidation phase, and the price starts to move against you, that is, back into the range. How do you know when to get out? How do you tell the difference between a small pullback and a bad trade? Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. The position size on a trade is determined by the stop, and the stop is determined on a technical basis. For example, if the market is in the midst of a trading range, it makes no sense to put your stop within that range since you are likely to be taken out. I always place my stop beyond some technical barrier. Don't you run into the problem that a lot of other people may be using the same stop point and the market may be drawn to that stop level? I never think about that because the point about a technical barrier, and I've studied the technical aspects of the market for a long time, is that the market shouldn't go there if you are right. I try to avoid a point that floor traders can get at easily. Sometimes I may place my stop at an obvious point if I believe that it is too far away or too difficult to reach easily. To take an actual example, on a recent Friday afternoon, the bonds witnessed a high-velocity breakdown out of an extended trading range. As far as I could tell, this price move came as a complete surprise. I felt very comfortable selling the bonds on the premise that if I was right about the trade, the market should not make it back through a certain amount of a previous overhead consolidation. That was my stop. I slept easily in that position because I knew that I would be out of the trade if that happened. Talking about stops, I assume because of the size that you trade, your stops are always mental stops, or is that not necessarily true? Let's put it this way. I've organized my life so that the stops get taken care of. They are never on the floor, but they are not mental. What eventually tells you that you are wrong on a major position trade. Your stop point will limit your initial loss, but if you still believe in the fundamental analysis underlying the trade, I assume that you will try it again. If you're wrong about the general direction of the market, won't you take a series of SSEs? At what point do you throw in the towel on the trade idea? First of all, a loss of money itself slows me down, so I reduce my positions. Secondly, in the situation you described, the change in the technical picture will give me second thoughts. For example, if I am bearish on the dollar and a major intermediate high has been penetrated, I would have to reevaluate my view. Earlier, you mentioned that you had developed your own trend-following systems to provide an indicator of where the large amount of money managed under such systems could be expected to hit the market. Do you use your own trend-following systems to trade any portion of the money you manage? Yes, about 5%. Is that the level of your confidence? I guess it is not negative 5%, so it could be worse. Overall, my systems make money, but they have volatility characteristics and problems related to risk control that I don't like. But since they offer diversification from my other trading, I use them to a small degree. Do you feel it is possible to ever develop a system that would do as well as a good trader? I think it is unlikely because the learning features of such a system would have to be very highly developed. Computers are good at learning only when there are clear hierarchies of information and precedent. For example, expert systems for medical diagnostics are very good because the rules are very clear. The problem with developing expert systems for trading is that the rules of the trading and investment game keep changing. I have spent some time working with expert system developers, and we concluded that the rules for interpreting the information keep changing. Does the fact that you are trading so much greater size than you did in your early years make it more difficult? There are far fewer markets with sufficient liquidity for the optimum size of my trades. How much money are you currently managing? Over $650 million, Lion. I assume more than half of that is due to capital appreciation. Yes, last year's profits alone were about $300 million, Lion. What are some markets that you really have trouble trading because of insufficient liquidity? An example of a market I like a great deal, but in which the liquidity is often poor, is copper. High copper I am. Now the elephant. What kind of size can be moved comfortably in a market like copper before it becomes a problem? Would say, in a day, you can comfortably move 500 to 800 contracts, uncomfortably, somewhat more than that. But the daily volume of copper is currently only 7,000 to 10,000 contracts, and a lot of that is local trading or spreads. In contrast, in the T-bond market, you can move 5,000 contracts without a problem. You can also move very large size in the interbank currency market. Can you trade a market like coffee, which doesn't have deep liquidity but sometimes can develop enormous trends? Yes, I did trade coffee last year and made a few $1,000,000 in it. Now, if I am managing $600 million Lion, I kick in $2 million Lion in profits on coffee trades, it doesn't really matter that much. In fact, it could even be counterproductive, since the time and energy I spend concentrating on coffee diminishes my focus on the currency markets, which I trade far more heavily. It would appear that you have reached a size level that impedes your trading performance. Since you have substantial personal funds, did you ever consider just trading your own money and avoiding all the related headaches in managing money? Yes, but there are several reasons why I don't. Although I invest a great deal of my own money in my funds, the portion of my funds that is managed money represents a call. Analogy to an option that has unlimited profit potential in the event of a price rise, but risk limited to its cost in the event of a decline. I don't say this to be flippant, since my reputation among my investors is extremely important to me, but a call is a much better position than a symmetrical win-lose position. Is there a practical limit to the amount of money you can manage? In most commodity futures markets, there certainly is. However, in currencies, interest rates, and a few commodities such as crude oil, there are limits, but they are very high. I plan to very carefully manage the future growth in the size of funds I am managing. When you put in orders in markets that are not among the most liquid, in other words, not T-bonds or the major currencies, do you find your orders actually moving the market? They can, but I never bully a market. Talking about that, one often hears stories about very large traders trying to push the markets up or down. Does that work? I don't think so. It can be done for the short term, but eventually it will lead to serious mistakes. It usually results in arrogance and a loss of touch with the underlying market structure, both fundamentally and technically. The traders that I know who thought too highly of their ability and tried to bully the market ultimately made the mistake of overtrading and went under. Without mentioning any names, can you provide an example? There is a recent example of a British trading organization getting into serious trouble after they tried to corner the crude oil market. At first they succeeded, but then they lost control and crude oil prices fell by $4. What was the end result? They lost about $40 million, and the organization is in trouble. You're probably managing more money than any other futures trader in the world. How do you handle the emotional strain when you hit a losing period? The emotional burden of trading is substantial. On any given day, I could lose millions of dollars. If you personalize these losses, you can't trade. Do the losses bother you at all anymore? The only thing that disturbs me is poor money management. Every so often, I take a loss that is significantly too large. But I never had a lot of difficulty with the process of losing money, as long as losses were the outcome of sound trading techniques. Lifting the short side of the July-November soybean spread was an example that scared me. I learned a lot about risk control from that experience. But as a day-in, day-out process, taking losses does not bother me. Did you have any losing years? Yes, in 1981, one lost about 16%. Was that due to errors you made or the nature of the markets? It was a combination of the two. My main problem was that it was the first major bear market in commodities I had experienced, and bear markets have different characteristics than bull markets. Was it a matter of becoming complacent about markets always being in an uptrend? No, the problem was that the principal characteristic of a bear market is very sharp down movements followed by quick retracements. I would always sell too late, and then get stopped out in what subsequently proved to be part of a wide swinging congestion pattern. In a bear market, you have to use sharp counter-trend rallies to enter positions. What other mistakes did you make that year? My money management was poor. I had too many correlated trades. Was your confidence shaken at all that year? Did you go back to the drawing board? I went back and designed a lot of risk management systems. I paid strict attention to the correlations of all my positions. From that point on, I measured my total risk in the market every day. When you trade currencies, do you use the interbank market or the futures market? I only use the interbank market, unless I'm doing an arbitrage trade against the The International Monetary Market, IMM, is a subsidiary of the Chicago Mercantile Exchange and the world's foremost currency futures exchange. The liquidity is enormously better, the transaction costs are much lower, and it is a 24-hour market, which is important to us because we literally trade 24 hours a day. IMM, what portion of your trading is in currencies? On average, about 50 to 60% of our profits come from currency trading. I assume you're also trading currencies beyond the 5 that are currently actively traded on the NAI. We trade any currency that is highly liquid. Virtually all the European currencies, including those of the Scandinavian countries, all the major Asian currencies and the Mideast currencies. Crosses are probably the most important trading vehicle that we use that you can't trade on the IMM. Crosses are a trade involving two foreign countries. For example, buying British pounds and selling an equal dollar amount of Deutsche Marks is a cross. You can't trade crosses on the IMM because they have fixed contract sizes. But you could do a cross on the IMM by adjusting the ratio of the number of contracts between the two currencies to equalize the dollar value of each position. But it is much more exact and direct to use the interbank market. For example, Deutsche Mark, British Pound, and Deutsche Mark, Japanese Yen crosses are highly traded and very active. I assume that when you do a Mark-Yen cross, you price it in dollars, not in terms of one of the two currencies. That's right. You simply say, buy $100 million worth of marks and sell $100 million worth of yen. For interbank market, the dollar is the unit of exchange all over the world. In situations where a surprise news development or the release of an economic statistic out of line with expectations causes a sharp price response in currencies. Does the interbank market react less violently than the futures market? Or do the arbitrageurs keep the two markets tightly linked? The two markets are well arbitraged, but those are the moments when a very swift arbitrageur will make some money. The markets do get a little bit out of line, but not a lot. Will the interbank market price response to such events be less extreme? Yes, because what happens on the futures market is that the locals back away and let the stops run. The only thing that pulls the markets back is the arbitrageurs who have the bank on the other side. What percentage of bank market trading represents commercial activity or hedging vis-a-vis speculative trades? The Fed has done a study on that. I don't have the figures on hand, but it is basically a hedging market. The banks are the principal speculators, as well as a few players like myself. Is there a reason why the futures market hasn't been able to capture a larger percentage of world currency trading? The currency futures market is not efficient in several of the most important respects. First, hedging usually has a specific dollar and date requirement. For example, if I need to hedge $3.6 million line for April 12, the bank just takes it. The futures market, however, trades only for specific dates and fixed contract sizes, so the hedger is not precisely covered. So actually there is no way the futures market can compete, because the interbank market can tailor a hedge for any customer. That's right. In addition, the activity takes place within normal commercial banking relations. That is, very often, the hedger wants to show his banking interest that he has a locked-in profit so he can borrow against it. Can you talk about your fundamental analysis methodology? How do you determine what the right price for a market should be? I assume that the price for a market on any given day is the correct price. Then I try to figure out what changes are occurring that will alter that price. One of the jobs a good trader is to imagine alternative scenarios. I try to form many different mental pictures of what the world should be like and wait for one of them to be confirmed. You keep trying them on one at a time. Inevitably, most of these pictures will turn out to be wrong. That is, only a few elements of the picture may prove correct. But then, all of a sudden, you will find that in one picture, 9 out of 10 elements click. That scenario then becomes your image of the world reality. Let me give you an example. The Friday after the October 19 stock market crash, I had trouble sleeping, which is very unusual for me. But I am sure I wasn't the only trader to lie awake that night. All week long, I struggled with how the events of that week were going to impact the dollar. I was trying on different visions of the world. One of these pictures was total panic, the world coming to an end financially. In this scenario, the dollar becomes the safest political haven, and as a result, there could be a tremendous rise in the dollar. In fact, on Tuesday of that week, the dollar did rise dramatically as many people withdrew their money from other places. During the next 3 days, there was tremendous confusion. By the end of the week, the dollar had started to give ground again. It was then that it all coalesced in my mind. It became absolutely clear to me that given the combination of a need for stimulative action, dictated by the tremendous worldwide financial panic, the reluctance of the Bank of Japan and German Bundesbank to adopt potentially inflationary measures, and the continuing wide U.S. trade deficits, the only solution was for Treasury Secretary Baker to let the dollar go. Someone had to play the stimulative role, and that someone would be the United States. As a result, the dollar would drop, and it would not be in the interest of the other central banks to defend it. I was absolutely convinced that was the only thing that Baker could do. You realized all this late Friday. Was it too late to take action in the markets? Yes. And it was a very tense weekend because I realized that the dollar might open sharply lower. I waited for the Far East markets to open Sunday night. Do you do a lot of your trading outside of U.S. hours? Yes. First, I have monitors everywhere I go, in my home, in my country home. Second, I have a staff on duty 24 hours a day. Is your staff instructed to alert you immediately in case something big happens? Absolutely. First of all, we have call levels in every currency. If a currency breaks out of a range that we have previously identified, my staff is under instructions to call. How often do you get calls in the middle of the night? I have an assistant trader, and the joke is that he is allowed to wake me up at home twice a year. But it really isn't necessary very often. Whenever the markets are busy, I know what is going on all the time. My home is fully equipped with trading monitors and direct lines. Also, my assistant's job is to be up and get the calls. He probably gets called 3 or 4 times a night. Are you saying that you delegate the nighttime decision-making? We create a scenario for every currency at least once a week. We define the ranges we expect for each currency and what we will do if it breaks out of these ranges. So your assistant knows that if currency X gets to 135, he should buy it or sell it. Those decisions have been made beforehand. But they are under instruction to call me if the Prime Minister resigns, or if there is a major unexpected currency revaluation, or something else happens to invalidate the recent scenario. Are there times you end up trading at night? Yes, a lot. You obviously can't trade round the clock. How do you structure your time to balance your work versus your personal life? I generally try to keep my trading confined between 8 a.m. and 7 p.m. The Far East is very important, and if the currency markets are very active, I will trade the Far East, which opens at 8 p.m. The AM session in Tokyo trades until 12 p.m. If the markets are in a period of tremendous movement, I will go to bed for a couple of hours and get up to catch the next market opening. It is tremendously interesting and exciting. To see the wave roll from country to country? Absolutely. When you are really involved, the screen almost reaches out and grabs you. The way the quotes are made changes. They get wider, they get wilder. I have contacts all over the world in each of these markets, and I know what is going on. It is a tremendously exciting game. There are opportunities all the time. Forgetting trading for a minute. One of the reasons I am in this business is that I find the analysis of worldwide political and economic events extraordinarily fascinating. The way you describe it, you make the whole process sound like a constant game, rather than work. Do you really look at it that way? It doesn't feel like work except when you lose. Then it feels like work. He laughs. For me, market analysis is like a tremendous multidimensional chessboard. The pleasure of it is purely intellectual. For example, it is trying to figure out the problems the finance minister of New Zealand faces and how he may try to solve them. A lot of people will think that sounds ridiculously exotic, but to me it isn't exotic at all. Here is a guy running this tiny country, and he has a real set of problems. He has to figure how to cope with Australia, the US, and the labor unions that are driving him crazy. My job is to do the puzzle with him and figure out what he is going to decide, and what the consequences of his actions will be that he or the market doesn't anticipate. That to me in itself is tremendous fun. In following all these varied world markets, I know you read a tremendous amount of economic literature. Do you also pay any attention to the various market advisory letters? I get a guru report every day. Who is on that list? All the newsletter writers who have a large following. People like Prechter, Zweig, Davis, Eliades, and so on. Do you use your guru report as a measure of contrary opinion? I try not to be too much of a wise guy, because during major price moves, they will be right for a portion of it. What I am really looking for is a consensus that the market is not confirming. I like to know that there are a lot of people who are going to be wrong. So if you see that most of the members on your guru list are bullish at a time when the market is not moving up, and you have some fundamental reason to be bearish, you will feel stronger about the trade? Yes, much stronger. Do you think people can trade profitably by just following the gurus? Probably. But my impression is that to make money, you have to hold a position with conviction. That is very difficult when you are following someone else. There are some good gurus, however. For example, in the stock market, I like Marty Zweig. He uses excellent risk control. Unlike some other gurus, he doesn't believe he is predicting the future. He is simply observing what is happening and making rational bets. You talk about both the importance of risk control and the necessity of having the conviction to hold a position. How much risk do you typically take on a trade? First of all, I try very hard not to risk more than 1% of my portfolio on any single trade. Second, I study the correlation of my trades to reduce my exposure. We do a daily computer analysis to see how correlated our positions are. Through bitter experience, I have learned that a mistake in position correlation is the root of some of the most serious problems in trading. If you have 8 highly correlated positions, then you are real-lie trading one position that is 8 times as large. Does that mean if you are bullish in both the Deutsche Mark and Swiss franc, then you decide which one you like better and place your entire long position in that currency? Yes, that is definitely true. But even more important is the idea of trading a long in one market against a short in a related market. For example, right now, Although I am net short the dollar, I am long the yen and short the Deutsche Mark. In all my trading, if I am long something, I like to be short something else. Do the cross rates like the Deutsche Mark Japanese yen move slower than the individual currencies themselves? Not necessarily. For example, recently the sterling mark cross rate was in a year-long congestion between approximately 2.96 and 3.0. It finally broke out about a month ago. The day it broke out, it challenged the top of the range about 20 times. The Bank of England kept on defending it. Finally, the Bank of England gave in. As soon as the cross rate pierced the 3.1 level, there were no trades. In fact, there were no trades until it hit 3.350. So it moved virtually a full 1% without trading. Is that unusual for the interbank market? Very unusual. It meant everybody was watching the 3.0 level. Once everyone realized the Bank of England was not stepping in, no one wanted to be a seller. Is that type of breakout, a violent and quick one, much more reliable than a typical breakout? Yes, it is much more reliable. Even though your fills are worse? Terrible fills. The worse the fills are, the better your trade. In that case, after trading for a couple of hours between 3.4 and 3.2, the rate went straight up to 3.11. Do you believe that the cross rates provide better trading opportunities in currencies than net short or long positions against the dollar? Rates. Because there are a lot fewer people paying attention to the cross rates. The general rule is, the less observed, the better the trade. Your trading style involves a synthesis of fundamental and technical analysis. But if I were to say to you, Bruce, we are going to put you in a room and you can have either all the fundamental information you want or all the charts and technical input you want, but only one, which would you choose? That is like asking doctor whether he would prefer treating a patient with diagnostics or with a chart monitoring his condition. You need both. But if anything, the fundamentals are more important now. In the 1970s, it was a lot easier to make money using technical analysis alone. There were far fewer false breakouts. Nowadays, everybody is a chartist, and there are a huge number of technical trading systems. I think that change has made it much harder for the technical trader. Do you think that the trend-following system approach will eventually self-destruct under the weight of its own size and the fact that most of these systems are using similar approaches? I think that is true. The only thing that will save those technical systems is a period of high inflation when simple trend-following methodologies will work again. However, there is no question in my mind that if we have stable, moderate rates of inflation, the technical trading systems will kill each other off. Let's shift our conversation to the stock market. Do you believe that the stock market behaves differently from other markets, and if so, how? The stock market has far more short-term counter-trends. After the market has gone up, it always wants to come down. The commodity markets are driven by supply and demand for physical goods. If there is a true shortage, prices will tend to keep trending higher. So if the stock index market is much choppier, are there any technical approaches that can work? Perhaps, but they keep changing. I have found that very long-term decision-making systems will catch the bigger stock market advances, but you need to use very wide stops. So you have to be very long-term to filter out the noise. Much longer than most traders can handle because that strategy involves riding out large retracements. As an alternative approach, one of the traders I know does very well in the stock index markets by trying to figure out how the stock market can hurt the most traders. It seems to work for him. How can he quantify that? He looks at market sentiment numbers, but basically it is a matter of gut feel. Some critics have attributed the October 1987 crash to program trading. What are your own feelings? I think two different elements were involved. First, overly high prices left the stock market vulnerable to a decline, which was triggered by rising interest rates and other fundamental causes. Second, that decline was accentuated by heavy selling from pension funds who were involved in so-called portfolio insurance. Are we talking about portfolio insurance as opposed to arbitrage-type program trading? Portfolio insurance involves systematically selling stock index futures as stock prices decline and covering those shorts when prices rise in order to reduce portfolio risk. Program trading normally refers to buying and selling stock index futures against an opposite position in a basket of stocks when the prices of the two are out of line. Right? The only way in which arbitrage could be said to have contributed to the problem, rather than helped it, is that if it weren't for program trading arbitrage, portfolio insurance may never have been developed. So the arbitrageurs are only to be blamed for the market decline insofar as they made portfolio insurance possible? Yes. If you read Brady Report, you will portfolio insurers came the market with billions of dollars worth of sales in a few hours. The market was unable to absorb it. Portfolio insurance was a terrible idea. It was insurance in name only. In fact, it was nothing more than a massive stop-loss order. If it were not for portfolio insurance selling, the market would still have gone down sharply, but nothing like the 500-point decline we witnessed. Do you feel great traders have a special talent? In a sense. By definition, there can only be a relatively small group of superior traders, since trading is a zero-sum game. What is the balance of trading success between talent and hard work? If you don't work very hard, it is extremely unlikely that you will be a good trader. Are there some traders who can just coast by on innate skills? You can do that for a while. There are a lot of one-year wonders in trading. It is quite common to find somebody who has a strong feeling that sugar is going to 40 cents, or that the copper spreads are going to widen dramatically. And that one idea turns out right. For example, recently I heard about a trader who made $27 million land trading copper spreads this past year, and then lost virtually all of it. What advice would you give the novice trader? First, I would say that risk management is the most important thing to be well understood. Undertrade is my second piece of advice. Whatever you think your position ought to be, cut it at least in half. My experience with novice traders is that they trade 3 to 5 times too big. They are taking 5 to 10% risks on a trade when they should be taking 1 to 2% risks. Besides overtrading, what other mistakes do novice traders typically make? They personalize the market. A common mistake is to think of the market as a personal nemesis. The market, of course, is totally impersonal. It doesn't care whether you make money or not. Whenever a trader says, "I wish" or "I hope," he is engaging in a destructive way of thinking because it takes attention away from the diagnostic process. In my conversation with Kovner, I was struck by the immense complexity and scope of his analysis. I still can't figure out how he can find the time to follow and analyze intricately the economies of so many different countries, let alone integrate these various analyses into a single picture. Clearly, Kovner's unique synthesis of worldwide fundamental and technical analysis is hardly translatable to the average trader. Nevertheless, there are key elements in Kovner's trading approach that have direct relevance to the more mundane trader. Kovner lists risk management as the key to successful trading. He always decides on an exit point before he puts on a trade. He also stresses the need for evaluating risk on a portfolio basis rather than viewing the risk of each trade independently. This is absolutely critical when one holds positions that are highly correlated, since the overall portfolio risk is likely to be much greater than the trader realizes. One statement by Kovner, which made a particularly strong impression on me, concerned his approach in placing stops. I place my stop at a point that is too far away or too difficult to reach easily. In this manner, Kovner maximizes the chances that he will not be stopped out of a trade that proves correct, while at the same time maintaining rigid money management discipline. The philosophy behind this approach is that it is better to allocate the predetermined maximum dollar risk in a trade to a smaller number of contracts, while using a wider stop. This is the exact reverse of the typical trader, who will try to limit the loss per contract. You trade as many contracts as possible, an approach which usually results in many good trades being stopped out before the market moves in the anticipated direction. The moral is, place your stops at a point that, if reached, will reasonably indicate that the trade is wrong, not at a point determined primarily by the maximum dollar amount you're willing to lose per contract. If the meaningful stop point implies an uncomfortably large loss per contract, trade a smaller number of contracts. Kovner's worst trading mistake, his going bust trade as he terms it, resulted from a spur-of-the-moment decision. My own personal experience underscores that there is probably no class of trades with a higher failure rate. then impulsive, not to be confused with intuitive trades. Regardless of the approach used, once a strategy is selected, the trader should stick to his or her game plan and avoid impulsive trading decisions, for example, putting on an unplanned trade because a friend has just recommended it, liquidating a position before the predetermined stop point is reached because of an adverse price movement. Finally, Kovner views a good trader as strong, independent, and contrary in the extreme, and points to discipline and a willingness to make and accept mistakes as significant traits of the winning trader. Richard Dennis, a legend, retires. Richard Dennis became intrigued by commodity trading during the late 1960s, while earning the minimum wage as a runner on the exchange floor. In the summer of 1970s, he decided to take a crack at trading on his own, and with $1,600 borrowed from his family, he purchased a seat on the Mid-America Exchange. The Mid-AM, as it is called, is a kind of minor league exchange because it trades pint-sized versions of the contracts traded on the major exchanges. The Mid-AM tends to attract the business of small hedgers and speculators for whom a single regular-sized contract represents too large a position. As a fledgling trader with little risk capital, the Mid-AM was well suited to Dennis. It was also the only exchange on which he could afford a seat. The seat cost Dennis $1,200, leaving him a scant $400 for trading. Incredible as it may seem, he eventually transformed that tiny stake into a fortune, which has been estimated by some to approach $200 million. Lion. As his father is reported to have said, in what must be one of the grand understatements of all time, let's just say Richie ran that $400 up pretty good. Although Dennis has been exceptionally successful over the long haul, he has withstood a few dramatic setbacks. He was in the midst of one such downturn at the time of our interview. Several of the public funds managed by Dennis lost enough during the late 1988 period to trigger the 50% loss cutoff point for the cessation of trading. Dennis's personal account witnessed a similar fate. As he expressed in a letter to investors, these results parallel immense losses in my own personal trading. Perhaps one of Dennis's most impressive traits as a trader is his ability to weather such hard times with little emotional impact. Apparently, he has learned to accept such sporadic large losses as part of the game. His confidence during such periods remains unshaken, as he believes he will eventually rebound if he stays true to his basic trading strategy. Had I not known, judging by the mood and confidence of the man I interviewed, I would sooner have guessed that he had just made a small fortune rather than lost one. Whatever the stereotype image of a centimillionaire may be, Dennis does not fit it. His low-spending lifestyle is legendary. In fact, his only real extravagances are his sizable political and charitable contributions. His political views also do not mesh with the popular image of the very rich. Dennis is the founder of the Roosevelt Center for American Policy Studies, a liberal think tank, and he supports the concept of higher tax rates for wealthy Americans. In recent years, he has taken an increasingly active role in the political sphere, supporting a variety of liberal candidates. Unlike trading, his win-loss ratio in politics has been disappointing. In the 1988 presidential race, Dennis was the national co-chairman for the Babbitt campaign. In drawing up a list of candidates to be interviewed for this project, Dennis was an essential name. He is one of the foremost trading legends of our time, a trader that a number of others interviewed in this book cited with the phrase, "I'm not in his league." In setting up the interview, I dealt with one of Dennis's assistants. After explaining the project to him, he told me he would talk to Dennis and get back to me. About 1 week later, I received a call informing me that Dennis could see me on a date about 1 month forward for exactly 1 hour. I explained that I was coming to Chicago for the primary purpose of interviewing Dennis, and that 1 hour was hardly enough time to cover all the essential areas. The response essentially was, that was all the time allotted, the implicit message. Take it or leave it, I agreed, hoping that I would get some more time if the interview was going well. I arrived about 5 minutes before the appointed time and was ushered into a large but decidedly unpretentious office. Dennis arrived precisely on the hour, shook hands politely, and sat down at his desk. He apologized in advance if, in the course of the interview, he occasionally glanced at the quote screen, explaining that he could keep his mind on the interview at the same time, and would signal me if he had to put in any orders. Having the experience of trading myself, albeit on an infinitesimally smaller scale, I explained that I understood. As the interview began, there was an element of unease on both our parts. In my case, I had a sense of a ticking clock with not enough time to accomplish the task at hand. In the case of Dennis, I believe it was a matter of a genuinely shy personality, at least in terms of a first meeting. After 5 to 10 minutes, the tension was gone, the atmosphere became relaxed, and the conversation flowed smoothly. 45 minutes into the interview, I began to think that things were going so well that Dennis would continue our conversation beyond the allotted hour. At exactly 10 minutes before the end of the hour, my illusion was shattered. "I've only got about 10 more minutes," he said, "so if there's still stuff that's important, you may want to get to it." Covered. Precisely at the end of the hour, Dennis said, "That's about all the time I have, thank you." Shuffled through my index cards and quickly tried to identify some of the key questions I had not yet. One segment questions I did not get to dealt with the political side of Dennis' experiences. These topics included the Senate hearings on alleged manipulation of the soybean market by Dennis, the Roosevelt Institute, and the various political figures Dennis had known. Although these subjects were certainly areas of interest and color, they were not pertinent to the primary focus of this book. Consequently, I chose questions related to trading before attempting to turn to anything politically oriented. At the end of the interview, I played my final card by saying, "I didn't even get to any questions related to the political side." "They're not interested in that anyway," Dennis replied as he politely said goodbye and left the office. About 6 weeks later, I requested and obtained a follow-up interview with Dennis. The portion of the interview dealing with the budget deficit problem and Dennis's large losses in his public fund trading at that time came from this second meeting. A month after our last conversation, Dennis announced that he was retiring from trading to concentrate on his political interests full-time. Will Dennis never trade again? Maybe, but don't bet on it. How did you first get involved in commodity trading? After graduating high school, I got a summer job as a runner on the floor and I dabbled in trading a little bit. With my minimum wage salary, I was making $40 a week and losing $40 an hour trading. I didn't know what I was doing. The advantage was that at least I got to do it with small amounts of money. I like to say the tuition was small for what I learned. I heard the story that before you turned 21, you had your father stand in the ring, while you stood on the sidelines signaling trades to him. That was in 1968 and 1969. My father had the membership, but he didn't know much about trading. He was just going along with it because I was underage and wanted to do it. When I turned 21, it was one of the happiest days in his life because he said, "I really hate this. I have no idea what I'm doing. It's yours." Were you at a disadvantage trading one step removed with your father filling the orders? Sure. We consistently lost, but you couldn't have lost very much because you were trading very small. I probably lost a couple of $1,000s during that period. Do you consider that period worthwhile nonetheless because of the lessons learned? Yes, in retrospect, I would say this to new traders. Although it may not be a reassuring thought, when you start, you ought to be as bad a trader as you are ever going to be. Because it is less expensive at that time? Right. You shouldn't be too surprised if you really screw up. Do you know traders for whom early success proved to be their undoing? I have noticed variations of that. There are a lot of people who get imprinted like ducks. You can teach them that a warship is their mother if you get them young enough. For a lot of traders, it doesn't matter so much whether their first big trade is successful or not, but whether their first big profit is on the long or short side. Those people tend to be perennial bulls or bears, and that is very bad. Both sides have to be equally okay. There can't be anything psychologically more satisfying about one than the other. If there is, your trading is going to go askew. I think that's what happened to a lot of people in the 1973 runaway bull market in soybeans. Even if they didn't make money themselves, but were just present to witness the market mania and see a few people make a lot of money, they were imprinted with it. You're talking about a subsequent bias to the bullish side because of that experience. Yes. What gave you confidence when you first started trading on the Mid-America Exchange with such a small stake? After all, one mistake and you are out of the game. Well, no. The advantage of the Mid-America Exchange was that they traded mini contracts. I had a few mistakes in me, and I made most, but not all of them. I don't know that I had any confidence. I just had what a lot of people have when they get in this business, a need to try to succeed. I mean, if you were betting on this sort of thing before the fact, you should have bet that it wouldn't work. There is no doubt about that. Most traders are not successful in the first year. What were you doing differently? I was doing enough things right that I didn't capsize even with that small capitalization. I was lucky enough to stagger into having the right positions on before the big corn blight in 1970s. Was that luck or foresight? I think it was more foresight. I had very pale ideas, rails, and attitudes about the market then, but a few that I learned were right, like go with the trend. One Friday, the grain markets all closed at their highs for the year, I believed. And I still believe that you go with the trend, and the stronger the trend, the better. I remember getting in on the close and just buying a couple of mini contracts in corn, wheat, and beans. The next Monday morning, they all opened up the limit because of the corn blight news. Sure, that didn't have to happen, and if it didn't, it would have set me back. It might have taken a lot longer to about $2,000, which compared to $400 was a real grub stake. But it wasn't like I threw a dart and decided what to do. I did something that should work in the long run. I went with the trend. Is this particular pattern, a very strong close on a Friday, a market characteristic that you find useful as an indicator of the following week's price action? Yes, at a minimum. It is important not to have a short position with a loss on Friday if the market closes at a high, or a long position if it closes at a low. I was curious about your going to graduate school despite your initial trading success. I signed up for graduate school before the summer of 1970s, which was when I traded in the pit for the first time. I had just planned to trade over the summer, but the 3 months and $3,000 in profits made a big impression on me. I went to Tulane in New Orleans and lasted for about 1 week. I used my laundromat quarters phoning trades into Chicago. Once I used up all the quarters and had nothing but dirty clothes, I had no choice but to come back to Chicago. Since then, you have been a full-time commodity trader. Yes. What comes to mind as your most dramatic or most emotional trading experience? There was one in the first year. I had just quit graduate school to trade. One day, I made a particularly bad trade and lost about $300. Since I only had about $3,000, that was a very big loss and it was destabilizing. I then compounded the error by reversing my original position and losing again. To top things off, I then reversed back to my original position and lost a third time. By the end of the day, I had lost $1,000, or 1/3 of my entire capitalization. Since then, I have learned that when you have a destabilizing loss, get out, go home, take a nap, do something, but put a little time between that and your next decision. When you are getting beat to death, get your head out of the mixer. Looking back, I realized that if I had had a trading rail about losses, I wouldn't have had that traumatic experience. In retrospect, would you say that was one of your best trades because you were so imprinted with that experience that you didn't make a mistake of that magnitude, percentage-wise again? Absolutely. I learned to avoid trying to catch up or double up to recoup losses. I also learned that a certain amount of loss will affect your judgment, so you have to put some time between that loss and the next trade. I guess a corollary of that would be, when things aren't going right, don't push, don't press. Yes. After all is said and done, you have to minimize your losses and try to preserve capital for those few instances when you can make a lot in a very short period of time. What you can't afford to do is throw away your capital on suboptimal trades. If you do, you will be too debilitated to trade when the right position comes along. Even if you put the trade on, it will be relatively small because your capital will have been depleted by the other trades. Was the 1973 soybean market your first really big market? I made enough money in that market to go to the Chicago Board of Trade the next year. I didn't make my money by just going long soybeans. I was basically a pit trader who traded in and out a lot. The markets were very good because there was excellent order flow. It was a great time to be in the pit. So it wasn't so much catching the trend. It was more a matter of scalping the market successfully. Also, so many people would make incredibly bad trades just to take a profit. They would get out even though the market was locked limit up and almost sure to go up the next day. They couldn't stand the profits burning a hole in their pocket. I would try to get in when they were getting out. It sounds like easy pickings. There was some amount of risk, but if you were disposed to going with a strong trend, it was a deal. They were giving you an edge to do it, giving you a high probability that the next day you would be ahead. You have to remember some of these markets went up the limit 10 days in a row. Most people thought that even 4 or 5 consecutive limit up days was impossible. In situations where a market goes limit up, limit up, limit up, at some point the market may open limit down. How do you recognize or sense when not to buy at limit bid? It's just an odds play. There's a lot of volatility in the outcome, but you know the odds are in your favor when you go long at limit bid. In all the years you have traded, have there been any really bad years? Was there a particular market or two that you were dead wrong about and that caused it to be a bad year? When we have had bad trading periods, it is really not one market that does it. In those situations, almost all the markets are going sideways and making lots of false breakouts. If one of the markets is decent, that is usually enough to avoid a bad situation. Is there any year that stands out? 1978 was not a good year for trading. I compounded losses unnecessarily because I was in the process of making the transition from floor trader to off-the-floor trader and had no idea how different they were. Was 1978 the year that you started trading from an office? In 1000 was mostly a floor trader, and by 1978 I had made the full-time transition. Did that switch cause you to become more of a long-term position trader? Ultimately, what I learned from 1978 is that you have to be longer-term as a desk trader. In the pit, if it looked like soybeans were going to break 3 cents, I would sell, and if it didn't break, I would get out. You don't have that luxury off the floor because you lose the edge when putting in the orders. So, the judgments you make looking at prices on the screen aren't as good as those made in the pit watching what is going on. In the pit, there are indicators that you learn subconsciously. Like these 3 guys are never right at market turns, and if they all do the same thing at the same time, a light clicks on. It took me a long time to realize that those tools weren't going to be available anymore. Did you make the change? You were doing really well on the floor. Why switch to a desk? When I started in 1970s, there were no futures markets in currencies, interest rates, or gold. By 1978, these markets had been listed on the board long enough to be viable. The currencies started in 1974, but it took several years to get enough volume. So it was the desire to trade more markets than you physically could in a single location that motivated your move. And the opportunity didn't exist 5 years earlier. I understand that you initiated a trader trainee program. What year was that? We hired a group at the beginning of 1984 and another group at the beginning of 1985. What was the motivation for this program? I have a partner who has been a friend since high school. We have had philosophical disagreements about everything you could imagine. One of these arguments was whether the skills of a successful trader could be reduced to a set of rules that was my point of view, or whether there was something ineffable, mystical, subjective, or intuitive that made someone a good trader. This argument had been going on for a long time, and I guess I was getting a little frustrated with idle speculation. Finally, I said, here's a way we can definitely resolve this argument. Let's hire and train some people and see what happens. He agreed. It was an intellectual experiment. We trained them as well as we could. That was the way to do the experiment right, I thought. I tried to codify all the things I knew about the markets. We taught them a little bit about probability, money management, and trading. It turned out I was right. I don't say that to pat myself on the back, but even I am surprised how well it worked. It's frightening how well it worked. Is your basic contention that you can take almost any reasonably intelligent individual and turn him into a successful trader? No. We screened for people we thought would be right. We received 1,000 applications and narrowed it down to 40 people whom we interviewed. Then we picked 10. What qualities were you looking for? I don't like to discuss that because if I told you one of the things we looked for was chess players and we ever do it again, we would be inundated by resumes from chess players. Was intelligence one of the key items? It was one of the traits, but it wasn't the essential item. To find the things that we were looking for, we could choose from intelligent or extremely intelligent people. We picked the ones with extreme intelligence just because they were available. Didn't you have any reluctance about giving away trade secrets? Sure, But I don't think trading strategies are as vulnerable to not working if people know about them, as most traders believe. If what you are doing is right, it will work even if people have a general idea about it. I always say that you could publish trading rules in the newspaper and no one would follow them. The key is consistency and discipline. Almost anybody can make up a list of rules that are 80% as good as what we taught our people. What they couldn't do is give them the confidence to stick to those rails even when things are going bad. How long was the training process? Shockingly short. In the first year, it took 2 weeks. Then we had them trade for a month and keep a log indicating why they made their trades. We wanted to see if they were consistent in doing what they had been taught. We really got good at it in the second year. The course took just 1 week. How many trainees were there? 23 in total. What were the results? We dropped 3 people who didn't do well. The other 20, however, have averaged about 100% profit per year. When you train people, you tell them your basic approach to the markets. Isn't there a risk of creating 20 clones of Richard Dennis? Wouldn't their trading results be highly correlated with what you are doing? There was a huge spread. One of the things that we repeatedly told the class was, "We are going to teach you what we think works, but you are expected to add your own personal flair, feeling, or judgment." How large are the stakes these traders are using? It has increased over the years as they have made money. I would say on average about $2 million slian each. What did they start out with? $100,000 each. I've heard this group of traders referred to as the turtles. I found that term somewhat amusing. What is the origin of the name? When I decided to do the trader trainee program, I had just returned from a trip to the Far East. In telling someone about the program, I said, "We are going to grow traders just like they grow turtles in Singapore." I had visited a farm there and seen a huge vat with thousands of squirming turtles. That became my image of growing traders. How much of a role does luck play in trading? In the long run, 0. Absolutely 0. I don't think anybody winds up making money in this business because they started out lucky. But on individual trades, obviously it makes a difference. That is where the confusion lies. On any individual trade, it is almost all luck. It is just a matter of statistics. If you take something that has a 53% chance of working each time, over the long run there is a 100% chance of it working. If I review the results of 2 different traders, looking at anything less than 1 year doesn't make any sense. It might be a couple of years before you can determine if one is better than the other. You are one of the few people who is both a discretionary trader and a systems trader. How would you compare the 2 approaches? Professional traders may do some very intelligent things, but they have a tendency not to think systematically about what they are doing. For example, most traders who do a trade that works will not think, "Why did it work? What did I do here that I might be able to do in another market at another time?" There is not a lot of reflection on the process of trading. High contrast, I think I always have been analytical about trading, even before I ever researched. A mechanical system. On the opposite extreme, you have the academic types who research before they have ever traded. They lack the seat-of-the-pants knowledge necessary to develop good trading systems. Mercifully, I did the trading first. Therefore, the research we do is more applicable to the real world. Can you give me an example of how the lack of real-world experience would hurt the researcher? As an example, assume I develop a mechanical system that often signals placement of stops at points where I know there will tend to be a lot of stops. Hi, the real world. It is not too wise to have your stop where everyone else has their stop. Also, that system is going to have above-average skids. If you don't understand that and adjust the results accordingly, you are going to get a system that looks great on paper, but is going to do consistently poorer in the real world. You mentioned that before you developed a mechanical trading system, you paid close attention to the trading process. Did you keep a log of what you did right and wrong, or was it a matter of memory? Yes, I would write down observations and think about them. I thought about everything I was doing. Is that something you would advise other traders to do to improve? That is, keep track of what they are doing right and what they are doing wrong. Sure. The trading experience is so intense that there is a natural tendency to want to avoid thinking about it once the day is over. I am that way when things are working. But when they are not, it spurs me to want to think about what I'm doing and how I might do better. When things go bad, traders shouldn't stick their heads in the sand and just hope it gets better. What you are saying is that the times when it is most tempting to avoid thinking about the markets at all are the times when you should be thinking about them the most. Right. I don't have any problem with that because I am obsessive about the markets. What do you do in a situation where your feelings as a trader tell you to do one thing and your systems point in the other direction? If they are absolutely opposed, you do nothing until you can resolve that conflict. Are most of your systems trend-oriented in nature? Yes. So, by definition, they will never be in the right direction at market turns. Yet you, as an experienced trader, may sense when a market may be prone for a turn. In a situation like that, would you be willing to buy because of what you see as a trader, even though your system is short? I would probably want to be flat, since I tend to weigh the psychological opinion-oriented segment of trading about equal with the technical and trend-following element. So you want to see the market display some signs of turning around before you'll commit. What is more likely is that I will be positioned in the right direction of a trend and decide to liquidate faster than a trend following. System would because of the intuitive factor. What about entering a new trade counter to a prevailing trend? I've certainly done it, that is, made counter-trend initiations. However, as a rule of thumb, I don't think you should do it. Do those type of trades do more poorly than other trades? Generally, yes, although every now and then they may give you a great story like going short sugar at 60 cents, which I did. Sugar plummeted from a high of 66 cents in November 1974 to a relative low under 12 cents only 7 months later. Each 1 cent move in sugar is worth 1,000. A large trader like Dennis will often trade positions measured in thousands of contracts. I've got 10 stories like that. But I have to tell you, in all honesty, I don't think the broad class of trades I have done like that have been profitable. The short sugar trade is a great example, because the market had witnessed an incredibly explosive up move, and it took a lot of courage to step in as a seller at 60 cents. But take the flip side when sugar is in a real bear market and is down to 5 cents. Every trend-following system in the world is going to be short. Yet, if conditions are such that the fundamentals are in transition and the market price is only a little over the cost of the bag it's packed in, would you make an exception? Actually, I've lost more money in situations like that because all the market has to do is go down 1 more cent and you are out of there. I made a lot of money going short sugar at 60 cents, but I lost much more going long sugar at 6 cents. When you do a trade like that, that is, buying a market because the downside is so-called limited, do you just ride it out or do you eventually throw in the towel? You throw it in. Because how do you know? Maybe it is going to 2 cents. Maybe it is going to 1 cent. I guess a main concern is that you are constantly giving up the premium in the forward months. In a bear market, the more forward contracts tend to trade at a premium. For example, May sugar might be at 6 cents, July at 61, and October at 7. Even if cash prices remained stable, a holder of October futures would lose 1 cent between May and October. Sure, you're forced out at 3 and get back in at 5. Then it falls to 3 again. Otherwise, there wouldn't be that much risk in the trade. Right? The idea that one side of the market is much more likely to work in the absence of anything else is an illusion. The market just wouldn't be there if that was true. There were plenty of guys who went short soybeans at $4 in 1973 because just like sugar at 4 cents couldn't go any lower, beans at 4 couldn't go any higher. Well, not only did they go higher, they went to a high of 12.97 in a matter of 4 or 5 months. There is another point that I think is as important. You should expect the unexpected in this business. Expect the extreme. Don't think in terms of boundaries that limit what the market might do. If mere is any lesson I have learned in the nearly 20 years that I've been in this business, it is that the unexpected and the impossible happen every now and then. So don't be too tied to history? Right. And yet all your rules are based on history. Is there a contradiction there? No, because a good trend-following system will keep you in the market until there is evidence that the trend has changed. If you had been doing your historical research on soybeans in 1972, you would have concluded that any time soybeans advance by 50 cents, you might as well get out. Because the market had never moved up or down by significantly more than that. Obviously, that was the wrong conclusion because it went up another $8. A good trend-following system, however, would have kept you in for most of the move. So you don't want to draw boundaries from history over market behavior? Right. The correct approach is to say, this structure means up and this structure means up no more. But never that this structure means up this much and no more. When you trade a system, do you go with the version of the system that tested out best for the past, or do other factors command consideration? One of the toughest problems in deciding how to trade is whether you just go with what is optimal for the database or whether you start from some other premise. You might deliberately trade something other than the optimal parameter set, version of the system with the best past performance, because you think the future is going to be unlike the past in a specific way. By definition, any other parameter set is going to have a poorer past performance than the optimal set. But if the difference in performance is only 10%, it might well be worth that 10% difference if you believe the suboptimal set, as measured by past data, will fit the future better. You have gone from being a very small trader to a very large trader, especially now that you are managing outside money. Do you find that order size gets in the way? Does it become substantially more difficult to be successful when you're trading size? At some level it would. I don't think we have reached that point yet, although we may not be tremendously far away from it. I think about 3 times the amount we are handling now would be just about it. We currently have about $120 million lying in customer funds. In other words, you haven't hit the wall yet. No. Is that because you are using many different approaches and therefore don't have all your orders going in at one point? Yes, you have to think about diversification. If you had one method or one person making all the decisions, you couldn't handle amounts that large. But if you use different strategies and have a diversity in decision makers, you can handle several $100 million without any major problem. Could that have been a subliminal reason for developing your training program, to try to diversify the decision-making process? Actually, we hadn't thought of it that way, but it did work to our advantage. In fact, we are going to try to market some of the traders we have trained for trading customer money. Is slippage a problem in your trading? Slippage is the difference between the theoretical execution price assumed by a computer program and the actual fill price. No. We try to make a hard-nosed estimate when building the cost of trading into a system. Also, we reduce our costs significantly by having our own brokers. When you hold a major position, at what point do you know you are wrong? What tells you to get out of the position? If you have a loss on a trade after a week or two, you are clearly wrong. Even when you are around break-even, but a significant amount of time has passed, you are probably wrong too. Do you define your maximum risk point when you get into a trade? You should always have a worst-case point. The only choice should be to get out quicker. Are you largely a self-taught trader, or did other traders teach you lessons that were worthwhile? I would say I am self-taught. What is really amazing is how little published literature there is on trading. Is there anything you can recommend to people who are interested in trading? I think Edwin Lefebvre's Reminiscences of a Stock Operator, reputedly a semi-fictionalized biography of Jesse Livermore, the legendary stock trader, is interesting and captures the feel of trading pretty well. But that book was written 65 years ago. Are there some key trading strategies that you can talk about without revealing any secrets? The market being in a trend is the main thing that eventually gets us in a trade. That is a pretty simple idea. Being consistent and making sure you do that all the time is probably more important than the particular characteristics you use to define the trend. Whatever method you use to enter trades, the most critical thing is that if there is a major trend, your approach should assure that you get in that trend. A trend could easily be defined using a simple system. Is there something special that you look for to define a trend? Then. If I see a trend developing, I know eventually I'll have to get in. The question is whether I get in earlier or later, and that might depend on how I see the market reacting to news. If a market goes up when it should go up, I might buy earlier. If it goes down when it should go up, I'll wait until the trend is better defined. How much common behavior is there between markets? Are the patterns of beans similar to the patterns of bonds, or do markets have their own personalities? I could trade without knowing the name of the market. So, what you are saying is that patterns in different markets are very similar. Yes. In our research, if a system doesn't work for both bonds and beans, we don't care about it. Would you say the stock market is an exception? That is, does the stock market also behave like other markets, or does the stock market have its own behavior pattern? I think it is probably separate. Why would you say that is true? Well, my research on individual stocks shows that price fluctuations are closer to random than they are in commodities. Demonstrably, commodities are trending and arguably stocks are random. Do you have an explanation for that phenomenon? I believe that there is not enough fundamental information per stock to create sufficient trends to move them from their random character. There aren't as many commodities as there are stocks. In other words, there is not the same flow of information as in the commodity markets. There is not enough information, not enough fundamentals, just nothing going on. In the commodity markets, technical information is basically confined to price, volume, and open interest. Since there is so much more technical information available for stock indexes' advanced decline. Ratios, various sentiment indicators, relationships between different groups of stocks, etc. do ordinary trend-following systems start off at a big disadvantage because they don't use enough information. I'm not sure that is the disadvantage. I think the disadvantage is that stock index prices are too close to random to develop enough clear-cut trends because the inputs, the individual stocks, are mostly random. What are your thoughts on the recent attacks against program trading? The people that are complaining ought to be ashamed of themselves. Do you mean people in the financial community? Yes. They should have enough sophistication to understand the inanity of what they are complaining about. Do you see program trading as a convenient scapegoat for a declining market? Sure. It is a good excuse for doing a lousy job for yourself and your clients. The claim is that program traders are taking money out of the pockets of the people who are investing in the stock market. Nothing could be further from the truth. Program trading may move the stock market around a bit, but not in any systematic way. If program trading caused prices to go too high or too low, that should provide better opportunities for the value investor. Of course, it's bad for those people who pretend they are value investors, but are really traders. How do you handle a losing streak? Cut back if it is really bad, stop and get out. Do you sometimes need to get away from the markets for a few days? Generally, it just takes a day or two, but you do need to stop for a period of time. It is almost like a pitcher not balking. Before he throws the ball, he has to stop at least for that second. That is what I try to do. At least have a pause. It could be for just one day. What is the biggest public fallacy about market behavior? That markets are supposed to make sense. How about fallacies regarding technical analysis? The belief that technical factors are not as important as the fundamentals. Are there any analysts whose work you respect? There are a lot of them, Schwager, for example, is good. Would you consider the work of outside analysts as an input in a trade? No. When we taught our people to trade, I had a hypothetical question. Suppose everything you know about the markets indicates a buy. Then you call the floor and they tell you that I'm selling. Do you? A buy, B go short, C do nothing? If they didn't eventually understand that A was correct because they have to make their own market decisions, then they didn't fit into the program. Why do you handle other people's money? You are doing very well on your own. Well, there is one big advantage. Managed money offers potential return with no risk. For 10 years, people have been asking me if I'm getting tired of all the risk. Do I think I'm going to bum out? Do I think I'm going to stop? For the longest time, I didn't understand what they were talking about. But I have to admit, at this point, I understand the value of cutting down your own risk. I could have traded smaller and had a smaller profit and smaller risk. But if customer money comes in, I could use that to supplement the profitability and still keep my risk lower. It just gives you a better deal. In a later interview, Dennis changed his mind on this subject, possibly influenced by the aggravation related to large losses in his public funds. Dennis decided to extricate himself gradually from the money management business, saying, "I found that it was more trouble than it was worth. The costs were not financial. They were psychological." The material that follows is from that second interview. I know this is not going to be your favorite subject, but I've got to ask you about it. Some of the public funds you manage ceased trading in April 1988. Is that because they reached the automatic 50% loss cutoff point? Actually, they were down just under 49% when we stopped trading. Rather than trigger the automatic termination point, we liquidated all positions and re-solicited the investors to allow a lower cutoff point. Would you do anything differently in the future because of this particular experience? I would cut back a little faster than I did, but the trades would still be the same. Someone said to me, "You claim the markets were bad." Well, since you could have done the exact opposite and made a lot of money, weren't they really good? I told him that the last thing I would have wanted to do was to be on the opposite side of those trades. In the long run, that is a way to lose an infinite amount of money. The short side of the interest rate markets in October 1987 resulted in one of your worst losses. What went wrong there? A large part of that loss was due to the fact that the market gapped way past our point for covering our short position. For example, on October 20s, we would normally have been out of our short Eurodollar position about 40 to 50 points higher, but the market opened 240 points higher that day. We blew 190 points in a skid that was absolutely unavoidable. If the market is that much out of line, do you still get out of your position right away? Sure. If you have any doubt about getting out as fast as possible in a situation like that, then you are really in big trouble. Do you think the sharp losses you suffered were due to any change in the markets? That's hard to say. The only factor I can objectively identify is the tendency toward more false breakouts. Do you feel the recent prevalence of false breakouts is related to the tremendous increase in computerized trend-following trading during the past 5 to 10 years? Are there just too many people doing the same thing, getting in each other's way? Yes, there is no doubt about it. In a perverse sort of way, it represents the ultimate triumph of technical trading over fundamental trading. I say perverse because it is a victory that devalues technical trading. Do you think we may see the day when trend-following systems no longer work? There will come a day when easily discovered and lightly conceived trend-following systems no longer work. It is going to be harder to develop good systems. Given that, can the approaches you were using before still work with the same efficacy? Actually, I believe that if you view the problem correctly, you can make the fact that there are many other trend followers in the market work to your advantage. I can't get too specific about the solution, because if we are right, that is pretty valuable information. To be successful, you always have to be one step ahead of everyone else. It sounds like you started working on this problem well before your performance problems began. In late 1987. That's right. During the past 10 years, there has been a virtual bandwagon effect of people using trend-following approaches. We have been thinking about this problem for a long time. Half the work in solving a problem is finding the right way to conceptualize it. It took us years before we figured out the right questions to ask. When did you finally arrive at what you considered a satisfactory solution? Ironically, right around the time we closed down the public funds. I know you can't be specific, but does your solution to false breakouts involve being far more short-term oriented so that you can respond more quickly to those situations? The secret is being as short-term or as long-term as you can stand, depending on your trading style. It is the intermediate term that picks up the vast majority of trend followers. The best strategy is to avoid the middle like the plague. When you talk about the experience of managing well over $100 million and losing roughly 50%, not to mention your personal large losses, you discuss it with great emotional detachment. Do you really take it that calmly? Isn't there an emotional side to it? I try for there not to be. It is totally counterproductive to get wrapped up in the results. Trading decisions should be made as unemotionally as possible. Yes. But how do you do that? You have to maintain your perspective. There is more to life than trading. To me, being emotionally deflated would mean lacking confidence in what I am doing. I avoid that because I have always felt that it is misleading to focus on short-term results. So you are able to avoid the emotional trap? Yes, but the flip side is that I also avoid the emotional elation when things are going well. There's no way to play just one side of that street. If you feel too good when things are going well, then inevitably you will feel too bad when they are going poorly. I wouldn't claim that I realized that after 3 years of trading, But after you've done it for 20 years, it either drives you crazy or you learn to put it into perspective. Does it become easier after 20 years? Not necessarily, he laughs. It gets easier to put it into perspective, but everyone has shock absorbers that deteriorate over time. Being a trader is like being a boxer. Every now and then, the market gives you a good wallop. After 20 years, you get a bit punch drunk. Is there any advice you can give to other traders on how to stay emotionally calm during periods of trading losses? It is a little bit like playing golf. You can throw your clubs around after making a bad shot, but while you are making the next shot, you should keep your head down and your eye on the ball. Do you use long-term scenarios about economic growth, inflation, and the dollar in making your trading decisions? I have mental pictures, but I try not to use them when I'm trading. Trading to me is like betting on independent rolls of the dice that you think are loaded a little bit in your favor, because you know some statistical things about the market. Long-term scenarios can prove to be right or wrong, but even if they are right, on balance, I'm not convinced that they make much difference over the term of any individual trade. Even if you think the dollar is going to collapse, that doesn't affect your basic trading pattern? I would like to say it doesn't, and I don't think it should, but it probably has in the past. The worst thing you can do is miss a profit opportunity, assuming you are already disciplined enough to cut your losses short. And if you think about it, rigid long-term views are the kind of thing most likely lead you to that mistake. For example, if I believe the dollar is going to weaken, and because of this I ignore a sell signal in the foreign currencies, I might risk missing a large profit. What is my reward if my view was right? Avoiding a small loss. Therefore, the risk-reward is all wrong for my type of trading. Acknowledging that caveat, as a long-time market observer, what major trends do you see shaping up over the coming years? I bet we will be at record levels of inflation by the end of 1990s. This interview was conducted in mid-1988. What is going to be the driving force behind that inflation? It is going to be driven by trying to avoid a deep recession. The recession is going to be caused by the federal budget deficit as investors require higher and higher levels of real interest rates to buy the debt. The government will try to avoid the recession by stimulating the economy, a tactic which essentially doesn't work. In other words, fear of a recession will cause tremendous monetary easing, which in turn will lead to inflation. It is unfortunately a very Republican idea, but I think it is right. Whether you like it or not, the financial markets are in conservative hands. People who lend money to the government and business will not buy monetary easing as a solution to a recession. Are you implying that the deficit problem is just a time bomb, which will eventually shatter the economy? Sure. We tend to think that since it is not a problem now, that means it won't be. We expect continuity in our lives, but the economy, and certainly the markets, are more discontinuous than continuous. And you are saying that people look at the deficit year after year and think, well, it can't be so bad, the economy is strong, and one day everybody wakes up. It is like having termites in the foundation of your house. You may not notice them until one day they gnaw away a big chunk and the house collapses. I don't think anybody should take a large amount of comfort in the fact that things appear to be holding together. Hypothetically, if you were president and could influence change, would the deficit be the first thing you would change? Sure. I think it is especially important for Democrats, since they were the first ones to pick up the banner of Keynesianism, the advocacy of government programs to increase employment, to admit that while it may be a great theory, it doesn't work in the real world. I don't think Keynes ever proposed using deficit spending in strong economic times. No, that's true. He proposed surpluses that were supposed to be counter-cyclical to deficits, surpluses in good times, deficits in bad times. The trouble is that we have only one side of that equation because of the lack of political will to create the surpluses when times are good. So what we really ought to do is admit that Keynesian economics is just an excuse for easy money, overspending, and overconsuming. We ought to just admit that the government is a debt junkie, and the whole concept of deficit spending is flawed in practice. You mean Keynesianism as it is being applied, not Keynesian economics as he himself purported. The theory is fine, it just doesn't work in the real world. Therefore, we shouldn't use it. Besides, Keynesian economics was a solution to the problem of oversaving and underconsumption, which was a fair enough attempt to pull us out of the Great Depression. The problem now is the exact opposite: undersaving and overconsumption. Even if Keynesianism were politically tenable, you still need a different solution because you have the exact opposite problem. Is there an economic theory that you feel fits the times and makes sense? We have to get rid of deficit spending. We need to retire the deficit in some orderly way, and the federal government should have to balance its budget just as the states do. At that point, Milton Friedman's proposal for a constant money supply adjusted by a growth factor would probably be a good idea. What is the most important advice you could give the novice trader? Trade small because that's when you are as bad as you are ever going to be. Learn from your mistakes. Don't be misled by the day-to-day fluctuations in your equity. Focus on whether what you are doing is right, not on the random nature of any single trade's outcome. After Dennis announced his retirement from trading to pursue his political interests full-time, I called with some follow-up questions. I spoke to an aide who took down the questions. Several days later, he called back with Dennis' replies. These questions and answers follow. Individuals who invested in your funds during your final year as a money manager fared poorly. How would an investor have done if he started on your first day as a money manager and kept his money fully invested until your last day in that role? Each $1,000 invested would have been worth $3,833 when the accounts were closed. This works out to approximately a 25% annual compounded return. The figure would have been more than double that at the equity peak about 1 year earlier. You are rumored to have lost a very substantial portion of your own net worth during your final year of trading. Are these stories true or exaggerated? I lost about 10% of the money I had made in the markets. Of course, measured as a percentage of my net worth, the figure is much higher because of my charitable and political contributions over the years. Did your poor trading results during the past year speed your career transitions? It made no difference. Have you really gone cold turkey, or are you still trading lightly? I am not trading at all. Richard Dennis is one of the legendary commodity traders of our time. He is the type of trader you might visualize implementing large long positions near market bottoms and large short positions near market tops. It is thus surprising that Dennis downplays the value of trying to pick major turning points. In fact, he claims that such trades have done little, if anything, to contribute to his trading success. Dennis believes that one of the worst mistakes a trader can make is to miss a major profit opportunity. According to his own estimate, 95% of his profits have come from only 5% of his trades. Missing only a few such profit opportunities could have a dramatic negative impact on performance. As a corollary, you need to guard against holding too rigid an opinion on a market, since such an opinion could easily lead to missing a major trend. One particularly useful piece of advice offered by Dennis is that the times when you least want to think about trading, the losing periods, are precisely the times when you need to focus most on trading. Paul Tudor Jones, The Art of Aggressive Trading. October 1987 was a devastating month for most investors, as the world's stock markets witnessed a collapse that rivaled 1929. That same month, the Tudor Futures Fund, managed by Paul Tudor Jones, registered an incredible 62% return. Jones has always been a maverick trader. His trading style is unique and his performance is uncorrelated with other money managers. Perhaps most important, he has done what many thought impossible: combined 5 consecutive triple-digit return years with very low equity retracements. I am fudging slightly. In 1986, Paul's fund realized only a 99.2% gain. Jones has succeeded in every major venture he has tried. He started out in the business as a broker, and in his second year grossed over $1 million in commissions. In fall 1980s, Jones went to the New York Cotton Exchange as an independent floor trader. Again, he was spectacularly successful, making millions during the next few years. His really impressive achievement, though, was not the magnitude of his winnings, but the consistency of his performance. During his 3.5 years as a floor trader, he witnessed only one losing month. In 1984, partially out of boredom and partially out of fear of eventually losing his voice. An occupational hazard for a pit trader, Jones again abandoned his successful career for a new venture, money management. He launched the Tudor Futures Fund in September 1984 with $1.5 million lying under management. At the end of October 1988, each $1,000 invested in this fund was worth $17,482, while the total amount of money he managed had grown to $330 million lying. In fact, the amount under management would have been higher, but Jones stopped accepting new investment funds in October 1987 and has also made cash disbursements since that time. If one believes in cycles as Jones does, it appears that he is due for another career change. It is hard to imagine what he can do for an encore. Jones is a compendium of contrasts. In private conversation, he is relaxed, but as a trader, he shouts his orders with the ferocity of a drill sergeant. His public image is one of a swaggering, egotistical trader, but one-on-one he is easygoing and unassuming. The media usually dramatizes the flamboyant elements of his lifestyle: Chesapeake Bay mansion, private 3,000-acre wildlife preserve, beautiful women, fine restaurants. But he has also made helping the poor a second avocation. Jones has emulated New York businessman Eugene Lang by setting up a fund to finance the college education of 85 elementary school graduates in Brooklyn's economically depressed Bedford-Stuyvesant section. This is not merely a matter of donating money. Jones has become personally involved by meeting with his adopted students weekly. More recently, he started the Robin Hood Foundation, whose endowment has grown to $5 million lying. This organization, true to its name, raises money from the rich and distributes it to private groups and individuals working to aid the poor. Jones had arranged our interview for 3:15 p.m., time by which all the futures markets are closed except for the stock indexes. Even with only one market trading, I was a little concerned about the practicality of starting the interview at that time, since I knew that the S&P stock index futures contract was one of Jones's primary trading vehicles. In fact, when I arrived, he was in the midst of trading the S&P. I waited until he finished shouting orders over the speakerphone and explained that I did not want to interrupt his trading. "Maybe we should delay the interview until the market closes," I suggested. "No problem," he answered. "Let's go." As it turned out, Jones was not merely trading the S&P that afternoon, he was building up a major position in anticipation of a huge break in the stock market. There is an intensity in Jones's placement of an order that is reminiscent of a tennis player aggressively returning a volley. By 300 at even. "Go, go, are we in? Speak to me." Yet, he shifted easily between trading and our conversation. Jones speaks with admiration about his first tutor in the business, the legendary cotton trader, Eli Tullis. Perhaps the one trait of Tullis that made the greatest impression on Jones was his steel-hard emotional control. He recalls how Tullis could carry on a polite, relaxed conversation with visitors, without blinking an eye. At the same time, his positions were getting decimated in the market. Jones' casualness in seeing visitors, talking to his staff, and participating in this interview at the same time he was trading a heavy S&P position reflected the same trait. A rally in stock index futures in the closing minutes of trading that day caused over a $1 million lion loss in Jones's position. Yet he was so composed that I didn't realize the market had moved against him until I checked the closing prices later that day. There was insufficient time to complete the interview at our first meeting. I returned about 2 weeks later. Two things were notable about this second meeting. First, whereas he had been strongly bearish and heavily short the stock market at the time of our first conversation, Jones's short-term opinion on the stock market had shifted to bullish in the interim. The failure of the stock market to follow through on the downside at the price and time he had anticipated convinced him that the market was headed higher for the short term. "This market is sold out," he emphasized at our second meeting. This 180-degree shift in opinion within a short time span exemplified the extreme flexibility that underlies Jones' trading success. He not only quickly abandoned his original position, but was willing to join the other side once the evidence indicated his initial projection was wrong. Yes, his change of heart proved well-timed. Second, Jones had suddenly adopted a very cautious tone regarding projections pertaining to the stock market and the economy. He was concerned that a second major selling wave in the stock market, the first being October 1987, could lead to a type of financial McCarthyism. Indeed, there is historical precedence for such concern. During the Senate hearings held in the 1930s, committee members were so desperate to find villains responsible for the 1929 stock crash that they dragged up New York Stock Exchange officials who had held long positions during the 19 price collapse. Jones feared that, as a prominent speculator and forecaster of economic trends, he might make a convenient target for any future governmental witch hunts. Jones had been particularly rattled by a call from a prominent government official regarding his trading. You wouldn't believe how high-placed this person was. He explained to me in a voice tinged with incredulity, taking particular care not to divulge anything specific. Although Jones remained friendly, the directness of the first interview was replaced by an almost pre-recorded quality in his replies. For example, a question about trading strategy was met with a response about it, running an illegal practice in which broker places his own order MRON or a large customer order. This reply virtually bordered on the absurd since Jones handles no customer orders. It made as much sense as a football fan who bets in his office pool, denying that he took a bribe to throw the game. It sounded as if Jones was using the interview as a forum for making an official statement, perhaps to be used as evidence in some hypothetical future congressional hearing. I thought that Jones was being overly cautious, if not paranoid. But then again, the expectation that a true economic crisis would lead to killing the messengers of bad news does not really seem that far-fetched. When did you first get interested in trading? When I was in college, I read an article on Richard Dennis, which made a big impression on me. I thought that Dennis had the greatest job in the world. I already had an appreciation for trading because my uncle, Billy Donovan, was a very successful cotton trader. In 1976, after I finished college, I went to my uncle and asked him if he could help me get started as trader. He sent me to Eli Tullis, a famous cotton trader who lived in New Orleans. Eli is the best trader I know, he told me. I went down to see Eli and he offered me a job on the floor of the New York Cotton Exchange. How come you went to work for Eli instead of your uncle? Because my uncle was primarily involved in the cash side of the business, merchandising cotton. I was interested in becoming a trader straight away. How long did you work on the floor of the exchange? What was your job there? I was a floor clerk. That is how everybody begins. But I also did a lot of analytical work, watching the market to try to figure out what made it tick. I clerked in New York for about 6 months and then returned to New Orleans to work for Eli. Did you learn a lot about trading from Eli? Absolutely. Working with Eli was a fabulous experience. He would trade position sizes of 3,000 contracts when the entire market open interest was only 30,000. He would trade more volume than any cotton trader off the floor. He was a true sight to behold. Was he trading futures against cash or just speculating? He was a pure speculator. The amazing thing was that since he used his own broker on the floor, everyone always knew exactly what his position was. He was very easy to tag. Eli's attitude was, the hell with it, I'm going to take them head on, so everyone knew his hand? Definitely. But apparently it didn't hurt him? No. Is that an exception? Do you try to hide your positions? I try. But realistically, the guys in the pit who have been there for 5 or 10 years know it is me. Everyone knows when I trade. The one thing I learned from Eli is that ultimately the market is going to go where it is going to go. So you don't think it is important to hide your positions? I think it is important to make an effort. For instance, my orders used to be particularly easy to read because I traded in multiples of 300 contracts. Now I break my orders up. I might give one broker an order for 116 and another broker an order for 184.1, have at least 4 brokers in every pit. What else did you learn from Tullis? He was the toughest son of a bitch I ever knew. He taught me that trading is very competitive and you have to be able to handle getting your butt kicked. No matter how you cut it, there are enormous emotional ups and downs involved. That sounds like a general character building lesson. What about specifics regarding trading? Tullis taught me about moving volume. When you are trading size, you have to get out when the market lets you out, not when you want to get out. He taught me that if you want to move a large position, you don't wait until the market is in new high or low ground because very little volume may trade there if it is a turning point. One thing I learned as floor trader was that if, for example, the old high was at 56.80, there are probably going to be a lot of buy stops at 5,685. When the market is trading 78, 75 offered, the whole trading ring has a vested interest in buying the market, touching off those stops and liquidating into the stops. That is a very common ring practice. As an upstairs trader, I put that together with what Eli taught me. If I want to cover a position in that type of situation, I will liquidate half at 75. So that I won't have to worry about getting out of the entire position at the point where the stops are being hit. I will always liquidate half my position below new highs or lows and the remaining half beyond that point. Other lessons you can attribute to Tullis. By watching Eli, I learned that even though markets look their very best when they are setting new highs, that is often the best time to sell. He instilled in me the idea that, to some extent, to be a good trader, you have to be a contrarian. You have done tens of thousands of trades. Is there any single trade that stands out? Yes, the 1979 cotton market. One learns the most from mistakes, not successes. I was a broker back then. We had lots of speculative accounts, and I was long about 400 contracts of July cotton. The market had been trading in a range between 82 and 86 cents, and I was buying it every time it came down to the low end of that range. One day, the market broke to new lows, took out the stops, and immediately rebounded about 30 or 40 points. I thought the reason the market had been acting so poorly was because of the price vulnerability implied by the proximity of those well-known stops. Now that the stops had been touched off, I thought the market was ready to rally. I was standing outside the ring at the time. In an act of bravado, I told my floor broker to bid 82.90 for 100. July, which at the time was a very big order. He bid 90 for 100, and I remember the Refco broker came running across the pit screaming, "Sold." Refco owned most of the certificated stock at that time, the type of cotton available for delivery against the contract. In an instant, I realized that they intended to deliver against the July contract, which then was trading at about a 4-cent premium to the October contract. It also dawned on me that the whole congestion pattern that had formed between 82 and 86 cents was going to be a market measurement for the next move down. The break from 82 cents was going to equal the width of the prior 4-cent trading range. So you knew you were wrong immediately? I saw immediately that the market was going straight down to 78 cents, and that it was my blood that was going to carry it there. I had come in long 400 contracts, entered another 100 as a day trade, and a final 100 on that macho-type bid that I should never have made. So you realized instantly that you wanted to be out. No, I realized instantly that I wanted to be short. How fast did you react? Almost immediately. When the Refco broker shouted, "Sold," everyone in the ring turned around and looked at me, because they knew what I was trying to do. The guy standing next to me said, "If you want to go to the bathroom, do it right here." He said I looked 3 shades of white. I remember turning around, walking out, getting a drink of water, and then telling my broker to sell as much as he could. The market was limit, down in 60 seconds, and I was only able to sell 220 contracts. When did you get out of the rest of your position? The next morning, the market opened 100 points lower, and I started selling from the opening bell. I sold only about 150 contracts before the market locked limit down again. By the time it was all over, I ended up selling some contracts as much as 4 cents below the point I first knew the position was no good. Even though you reacted fairly quickly, you still took a big hit. In retrospect, what should you have? Market. First of all, never play macho man with the market. Second, never overtrade. My major problem was not the number of points I lost on the trade, but that I was trading far too many contracts relative to the equity in the accounts that I handled. My accounts lost something like 60 to 70% of their equity in that single trade. Did that particular trade change your whole trading style in terms of risk? Absolutely. I was totally demoralized. I said, "I am not cut out for this business. I don't think I can hack it much longer." I was so depressed that I nearly quit. How many years had you been in the business at that time? Only about 3.5 years. Had you been successful up to that point? Relatively. Most of my clients had made money, and I was an important producer for my company. How about someone who had given you 10,000 at the beginning of the 3-year period? They were probably up about threefold. So everyone who was with you for a long time was still ahead of the game? Yes, but I had to suffer some intense drawdowns during the interim. That cotton trade was almost the deal breaker for me. It was at that point that I said, Mr. Stupid, why risk everything on one trade? Why not make your life a pursuit of happiness rather than pain? That was when I first decided I had to learn discipline and money management. It was a cathartic experience for me in the sense that I went to the edge, questioned my very ability as a trader, and decided that I was not going to quit. I was determined to come back and fight. I decided that I was going to become very disciplined and businesslike about my trading. Did your trading style change radically from that point on? Yes. Now I spend my day trying to make myself as happy and relaxed as I can be. If I have positions going against me, I get right out. If they're going for me, I keep them. I guess you not only started trading smaller, but also quicker? Quicker, more defensive. I am always thinking about losing money as opposed to making money. Back then, in that cotton trade, I had a vision of July going to 89 cents, and I thought about all the money I was going to make on 400 contracts. I didn't think about what I could lose. Do you always know where you are getting out before you put a trade on? I have a mental stop. If it hits that number, I am out no matter what. How much do you risk on any single trade? I don't break it down trade by trade. All the trades I have on are interrelated. I look at it in terms of what my equity is each morning. My goal is to finish each day with more than I started. Tomorrow morning, I will not walk in and say I am short the S&P from 264 and it closed at 257 yesterday. Therefore, I can stand a rally. I always think of it in terms of being short from the previous night's close. Risk control is the most important thing in trading. For example, right now I am down about % for the TON TTH, a 36% stop on my equity for the rest of the month. I want to make sure that I never have a double-digit loss in any month. One aspect of your trading style is a contrarian attempt to buy and sell turning points. Let's say you are looking for a top and go short with a close stop when the market reaches a new high. You then get stopped out. On a single trade idea, how many times will you try to pick a turning point before you give up? Until I change my mind fundamentally. Otherwise, I will keep cutting my position size down as I have losing trades. When I am trading poorly, I keep reducing my position size. That way, I will be trading my smallest position size when my trading is worst. What are the trading rules you live by? Don't ever average losers. Decrease your trading volume when you are trading poorly. Increase your volume when you are trading well. Never trade in situations where you don't have control. For example, I don't risk significant amounts of money in front of key reports since that is gambling, not trading. If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. There is nothing better than a fresh start. Don't be too concerned about where you got into a position. The only relevant question is whether you are bullish or bearish on the position that day. Always think of your entry point as last night's close. I can always tell a rookie trader because he will ask me, are you short or long? Whether I am long or short should have no bearing on his market opinion. Next he will ask, assuming I have told him I am long, where are you long from? Who cares where I am long from? That has no relevance to whether the market environment is bullish or bearish right now, or to the risk-reward balance of a long position at that moment. The most important rail of trading is to play great defense, not great offense. Every day I assume every position I have is wrong. I know where my stop risk points are going to be. I do that so I can define my maximum possible drawdown. Hopefully I spend the rest of the day enjoying positions that are going in my direction. If they are going against me, then I have a game plan for getting out. Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you're very good. The second you do, you are dead. Jesse Livermore, one of the greatest speculators of all time, reportedly said that in the long run, you can't ever win trading markets. That was a devastating quote for someone like me, just getting into the business. The idea that you can't beat the markets is a frightening prospect. That is why my guiding philosophy is playing great defense. If you make a good trade, don't think it is because you have some uncanny foresight. Always maintain your sense of confidence, but keep it in check. But you have been very successful for years. Aren't you more confident now than you were before? I am more scared now than I was at any point since I began trading because I recognize how ephemeral success can be in this business. I know that to be successful, I have to be frightened. My biggest hits have always come after I've had a great period and I started to think that I knew something. My impression is that you often implement positions near market turns. Sometimes your precision has been uncanny. What is it about your decision-making process that allows you to get in so close to the turns? I have very strong views of the long-run direction of all markets. I also have a very short-term horizon for pain. As a result, frequently, I may try repeated trades from the long side over a period of weeks in a market which continues to move lower. Is it a matter of doing a series of probes until you finally hit it? Exactly. I consider myself a premier market opportunist. That means I develop an idea on the market and pursue it from a very low-risk standpoint until I have repeatedly been proven wrong, or until I change my viewpoint. In other words, it makes a better story to say, Paul Jones buys the T-bond market 2 ticks from the low, rather than on his 5th try, Paul Jones buys the T-bond market 2 ticks from its low. I think that is certainly part of it. The other part is that I have always been a swing trader, meaning that I believe the very best money is to be made at the market turns. Everyone says you get killed trying to pick tops and bottoms and you make all the money by catching the trends in the middle. Well, for 12 years I have often been missing the meat in the middle, but I have caught a lot of bottoms and tops. If you are a trend follower trying to catch the profits in the middle of a move, you have to use very wide stops. I'm not comfortable doing that. Also, markets trend only about 15% of the time, the rest of the time. They move sideways. What is the most prominent fallacy in the public's perception about markets? That markets can be manipulated. That there is some group on Wall Street that controls price action in the markets. I can go into any market and create a stir for a day or two, maybe even a week. If I go into a market at just the right moment, by giving it a little gas on the upside, I can create the illusion of a bull market. But unless the market is really sound, the second I stop buying, the price is going to come right down. You can open the most beautiful Saks Fifth Avenue in Anchorage, Alaska, with a wonderful summer menswear department. But unless somebody wants to buy the clothes, you will go broke. What other misconceptions do people have about the markets? The idea that people affiliated with Wall Street know something. My mother is a classic example. She watches Wall Street Week, and she takes everything they say with almost a religious fervor. I would bet that you could probably fade Wall Street Week. I know you talk to traders in virtually every major market on an almost daily basis. Are you uncomfortable about being on the opposite side of the fence from these people? Yes. Who wants to fade a winner? I want to be with them because I make a point of talking to the people who I have the best track records. How do you keep all these other opinions from confusing your own vision? Let's say you are bearish on a market and 75% of the people you talk to about that market are bullish. What do? I wait. I will give you a perfect example. Until last Wednesday, I had been bearish on crude oil, while it was in the midst of a $2 advance. The best crude oil trader I know was bullish during that period. Because he was bullish, I never went short. Then the market started to stall, and one day he said, I think I'm going to go flat here. I knew that instant particularly, given the fact that bullish news was coming out of OPEC right at that time, that crude oil was a low-risk short. I sold the hell out of it, and it turned out to be a great trade. Are there any market advisors that you pay attention to? Marty Zweig and Ned Davis are great. Bob Prechter is the champion. Prechter is the best because he is the ultimate market opportunist. What do you mean by opportunist? The reason he has been so successful is that the Elliott wave theory allows one to create incredibly favorable risk-reward opportunities. That is the same reason I attribute a lot of my own success to the Elliott wave approach. Any advisor you consider underrated? I think Ned Davis does the best research on the stock market that I have seen. Although he is well known, I don't think he has received the recognition he deserves. Any analysts you consider overrated? Judge not, lest you be judged. Very few traders have reached your level of achievement. What makes you different? I think one of my strengths is that I view anything that has happened up to the present point in time as history. I really don't care about the mistake I made 3 seconds ago in the market. What I care about is what I'm going to do from the next moment on. I try to avoid any emotional attachment to a market. I avoid letting my trading opinions be influenced by comments I may have made on the record about a market. No loyalty to positions is obviously an important element in your trading. It is important because it gives you a wide-open intellectual horizon to figure out what is really happening. It allows you to come in with a completely clean slate in choosing the correct forecast for that particular market. Has the tremendous growth of the money you are managing made it more difficult to trade at the same level of profitability? It has made it tremendously more difficult. Do you think you could make a substantially higher percentage return if you were trading smaller amounts of money, without of money? Question. Do you ever question whether the detrimental impact of size on your performance outweighs profit incentive fees you earn from managing money? I think about that question every day. It is going to be interesting to see what happens by the time your book is published. Have you stopped accepting new investment funds? Yes, a long time ago. You've been both a broker and a money manager. How do you compare the relative advantages and disadvantages of these two jobs? I got out of the brokerage business because I felt there was a gross conflict of interest. If you're charging a client commissions and he loses money, you aren't penalized. I went into the money management business because if I lost money, I wanted to be able to say that I had not gotten compensated for it. In fact, it would probably cost me a bundle because I have an overhead that would knock out the Bronx Zoo. I never apologize to anybody because I don't get paid unless I win. Do you keep your money in your own funds? I would say that 85% of my net worth is invested in my own funds, primarily because I believe that is the safest place in the world for it. I really believe that I am going to be so defensive and conservative that I will get my money back. You did extraordinarily well during October 1987, a month which was a disaster for many other traders. Could you fill in some of the details? The week of the crash was one of the most exciting periods of my life. We had been expecting a major stock market collapse since mid-1986 and had contingency plans drawn up because of the possibility we foresaw for a financial meltdown. When we came in on Monday, October 19, we knew that the market was going to crash that day. What made you so sure? Because the previous Friday was a record volume day on the downside. The exact same thing happened in 1929, 2 days before the crash. Our analog model to 1929 had the collapse perfectly nailed. Paul Jones's analog model, developed by his research director, Peter Borish, superimposed the 1980s market over the 1920s market. The two markets demonstrated a remarkable degree of correlation. This model was a key tool in Jones's stock index trading during 1987. Treasury Secretary Baker's weekend statement that the U.S. would no longer support the dollar because of its disagreements with West Germany was the kiss of death for the market. When did you cover your short position? We actually covered our shorts and went somewhat long on the close of the day of the crash itself. October were most of your profits in October due to your short stock index position. We also had an extremely profitable bond position. The day of the crash we put on the biggest bond position we ever had. The bond market had been acting terrible all day long on October 19. During the day, I was very concerned about the financial safety of our clients and our own assets. We had our assets with various commission houses on the street, and I thought those funds could be in jeopardy. It was an intolerable situation for me. I kept on thinking, what is the Fed reaction going to be? I thought that they would have to add massive amounts of liquidity to create a very rosy environment instantaneously. However, since bonds had been acting poorly all day, I couldn't bring myself to pull the trigger on a long bond position. During the last half hour of trading, bonds suddenly started to turn up, and it clicked in my mind that the Fed was going to take actions that would create a tremendous upsurge in bond prices. As soon as I saw the bond market act right for a moment, I went wild. Do you believe that October 1987 was an early warning signal of more negative times ahead? I think the financial community, particularly Wall Street, was dealt a life-threatening blow on October 19, but they are in shock and don't realize it. I remember the time I got run over by a boat, and my backside was chewed up by the propeller. My first thought was, damn it, I just ruined my Sunday afternoon because I have to get stitched up. Because I was in shock, I didn't even realize how badly cut up I was until I saw the faces of my friends. Everything gets destroyed 100 times faster than it is built up. It takes one day to tear down something that might have taken 10 years to build. If the economy starts to go with the kind of leverage that is in it, it will deteriorate so fast that people's heads will spin. I hate to believe it, but in my gut that is what I think is going to happen. I know from studying history that credit eventually kills all great societies. We have essentially taken out our American Express card and said we are going to have a great time. Reagan made sure that the economy would be great during his term in office by borrowing our way into prosperity. We borrowed against the future, and soon we will have to pay. Are you blaming the current situation on Reaganomics? I think Reagan made us feel good as a country, and that is wonderful, but in terms of economics, he was the biggest disaster that ever struck. I think he basically hoodwinked us by promising to cut the deficit, and then went on the biggest spending binge in the history of this country. I don't think a Democrat could have gotten away with it, because everyone would have been very vigilant about a $150, $180 billion deficit. Do you see any way in which we can solve our current problems before we go into a deep recession or even depression? That is what scares me so much. I don't see any blueprint out of our current dilemma. Maybe there are macroeconomic forces at work that are part of a larger supercycle that we don't have any control over. Perhaps we are simply responding to the same type of cycles that most advanced civilizations fell prey to, whether it was the Romans, 16th century Spain, 18th century France, or 19th century Britain. I think that we are going in for a period of pain. We are going to relia what financial discipline is all about. 2. Do you use trading systems at all? We have tested every system under the sun, and amazingly, we have found one that actually works well. It is a very good system, but for obvious reasons, I can't tell you much more about it. What type of realm does it fall into? Contrarian. Trend following? Trend following. The basic premise of the system is that markets move sharply when they move. If there is a sudden range expansion in a market that has been trading narrowly, human nature is to try to fade that price move. When you get a range expansion, the market is sending you a very loud, clear signal that the market is getting ready to move in the direction of that expansion. Are you trading a portion of your funds on that system at the present time? We just started trading the system about 6 months ago, and so far it is doing very well. Do you feel a good system can compete with a good trader? A good system may be able to trade more markets effectively than a good trader because it has the advantage of unlimited computing power. After all, every trade decision is the product of some problem-solving process, human or otherwise. However, because of the complexity in defining, interacting, and changing market patterns, a good trader will usually be able to outperform a good system. But a good system can help diversify? Unequivocally. A good system will catch 10 times as much of the price move as I will, during the 15% of the time a market is in a major trending phase. The following section of the interview was conducted 2 weeks later. During the interim, Jones had reversed his trading bias on the stock market from bearish to bullish. 2 weeks ago, you were very bearish. What made you change your mind? You mean besides the Wall Street Journal article that publicized to the world that I was short 2,000 SAMP/P contracts? The market didn't go down. The first thing I do is put my ear to the railroad tracks. I always believe that prices move first and fundamentals come second. Do you mean that if you were right, prices should have gone down and they didn't? One of the things that Tullis taught me was the importance of time. When I trade, I don't just use a price stop, I also use a time stop. If I think a market should break and it doesn't, I will often get out even if I am not losing any money. According to the 1929 analog model, the market should have gone down, it didn't. This was the first time during the past 3 years that we had a serious divergence. I think the strength of the economy is going to delay the stock market break. I believe one reason why we are diverging from the 1929 model is because of the much easier availability of credit today. Volvo is giving out 120-month car loans. Think about that. Who owns a car for 10 years? 20 years ago, the average length of a car loan was 24 months. Today, it is 55 months. I think the final bottom line will be the same, but the ease of credit will delay the process relative to the 1920s when we had a cash economy. Some of your preliminary comments before the start of our interview today make it sound like you are paranoid because of your success. If the misery in this country gets deep enough, the perception is going to be that we did well as a trading firm, while other people were hurt because we had some knowledge. It is not that we had any unfair knowledge that other people didn't have. It is just that we did our homework. People just don't want to believe that anyone can break away from the crowd and rise above mediocrity. I understand that, similar to a number of other traders I have interviewed, you have trained a group of apprentice traders. What was your motivation? When I was 21 years old, a guy took me under his wing, and it was the greatest thing that ever happened to me. I felt an obligation to do the same thing for other people. How did you find the people you trained? Countless interviews. We have been deluged by applicants. How many traders have you hired? About 35. Have they been successful? Some have done very well, but overall we have had mixed success. Do you believe that is because it takes talent to be a good trader? I never thought that before, but I am starting to believe that now. One of my weaknesses is that I always tend to be too optimistic, particularly about the ability of other people to succeed. Was your I Have a Dream program, in which you have pledged to sponsor the education of a group of kids from a poverty-stricken area, inspired by the 60-minute show about Eugene Lang, right? I went to talk to him the week after the show, and within 3 months we had set up our own program. I have always been a big believer in leverage. The thing that really turned me on about the program was the potential for its multiplicative impact. By helping one kid, you can have an impact on his family and other kids. We have also recently set up a new program called the Robin Hood Foundation. We are trying to seek out and fund people who are on the front lines in providing food and shelter to the poor. We are seeking out the people who are used to working with virtually no budget at all, rather than the bureaucracies, which often do not deploy the money effectively. Has this become a major part of your life? I would say so. The markets have been so good to me that I feel I should give back something in return. I can't say that I have been successful because I am better than anybody else. By the grace of God, I was in the right place at the right time, so I feel a tremendous obligation to share. Is the positive intensity of winning as strong as the pain of losing? There is nothing worse than a bad trading day. You feel so low that it is difficult to hold your head up. But if I knew that I could also have a similar experience in the exhilaration of winning, I would take the combination of winning and losing days any time because you feel that much more alive. Trading gives you an incredibly intense feeling of what life is all about. Emotionally, you live on the extremes. What is the most important advice you could give the average trader? Don't focus on making money. Focus on protecting what you have. Do you still see yourself trading 10 or 15 years down the road? I wouldn't have it any other way. Paul Jones was a winning trader from his start in the business, but in the early years his performance was volatile. It took a traumatic trading experience to permanently forge the importance of risk control into his mind. Since that gut-wrenching cotton trade in 1979, Jones has managed to maintain excellent net profitability, while bringing his risk way down. Today, risk control is the essence of Jones' trading style and success. He never thinks about what he might make on a given trade, but only on what he could lose. He mentally marks each of his positions to the market. No matter how large a profit he may have in a position, in Jones's mind his entry price was the previous night's close. Since this approach assures that there is never a cushion in his trades, Jones never gets complacent about any of his positions. He not only watches the risk of each position, but he closely monitors the performance of his entire portfolio in real time. If his total equity drops 1 to 2% during a single trading session, he might well liquidate all of his positions instantaneously to cut his risk. It is always easier to get back in than to get out, he says. If Jones' trading starts going poorly, he will continually reduce his position size until he is on track again. That way, When he trading his worst, he is also trading his smallest. In any month with net trading losses, Jones will automatically reduce his risk exposure to make sure he never registers a double-digit loss in a single month. After big winning streaks, he is particularly cautious about getting overconfident. In short, Jones maintains risk control in a dozen different ways. As he puts it, the most important rule in trading is, play great defense, not great offense. Gary Bielfeldt, yes, they do trade T-bonds in Peoria. For years, I have heard the name BLH mentioned as one of the major players in the futures markets, particularly T-bonds, the world's largest futures market. I assumed BLH was a huge trading corporation, but in seeking out the country's best traders, I discovered that BLH was basically a single individual, Gary Bielfeldt. Who is Gary Bielfeldt? Where did he get the capital to rival the primary Wall Street institutions as a major force in the T-bond futures market? Bielfeldt began his trading career 25 years ago, with a mere $1,000 investment. At first, his capital was so limited, he confined himself to trading a single corn contract, one of the smallest futures contracts at a time of relative stagnation in agricultural prices. From this extremely modest start, Bielfeldt eventually built his account up to staggering proportions. How did he do it? Bielfeldt does not believe in diversification. His trading philosophy is that you pick one area and become expert at it. For much of his trading career, the soybean complex and to a more minor extent, the related grain markets provided that focal point of attention. Although Bielfeldt had the desire to become a full-time trader from the beginning, his tiny capital base restricted his trading to a part-time endeavor. In those early years, he earned his living running a small brokerage office. The problem he faced was how he, a trader without any independent funds, could develop a sufficient capital base to become a professional trader. Bielfeldt's strong desire to make this leap in his capital base prompted him to take a large, if not imprudent, risk. By 1965, Bielfeldt had painstakingly built up his initial 1,000 stake to 10,000. Based on his fundamental evaluation of the soybean market, as well as the concurring opinion by his former agricultural economics professor, Thomas Hieronymus, Bielfeldt strongly believed that prices would go higher. In an all-or-nothing play, he bought 20 soybean contracts, an extremely high leverage position given his 10,000 account size. A mere 10-cent price decline would have completely wiped out his account, while a considerably smaller decline would have been sufficient to generate a forced liquidation margin call. Initially, prices did move lower, and Bielfeldt came perilously close to that damaging margin call. But he held on, and prices eventually reversed to the upside. By the time he liquidated the position, he had more than doubled his equity on that single trade. That trade launched Bielfeldt toward his much-sought-after goal of becoming a full-time trader. Bielfeldt built his account with unerring consistency. By the early 1980s, Bielfeldt's trading size had grown to the point that government-established speculative position limits in the soybean and grain markets were becoming an impediment. This factor, aided by a particularly bad trade in the soybean market in 1983, prompted Bielfeldt to shift his focus to the T-bond futures market, which at the time had no position limit. Although a position limit was eventually implemented in the T-bond market, the 10,000 contract limit dwarfed the 600 contract limit in soybeans. The 1983 soybean loss may have been the best thing that ever happened to Bielfeldt. The shift to T-bonds coincided with an evolving major bottom in that market. He became very bullish and built up a huge long T-bond position at the right time. When the T-bond market exploded during the mid-1984 to early 1986 period, Bielfeldt was perfectly positioned to garner huge profits. His ability to stay with a major position for a long-term move allowed him to leverage his well-timed trade to a much greater degree than would have been achieved by most professional traders with the same initial position. This long T-bond position was Bielfeldt's best trade ever and catapulted him into a new echelon. That, in short, is the story of how one lot corn trader became a T-bond futures trader in the same league as the most prominent institutional market participants. Bielfeldt could not be further removed from the popular image of a large-scale trader in the highly leveraged sphere of futures trading. One would hardly expect to find one of the world's largest bond traders in Peoria. Bielefeld's attachment to his hometown is so strong that he refused to consider becoming a trader on the floor of the Chicago Board of Trade because it would have meant giving up his cherished lifestyle. He is the epitome of the small-town model American citizen. Honest, hard-working, devoted to family and community. One of Bielefeld's major goals has been to plow back a portion of his trading-derived wealth into projects benefiting his hometown. I interviewed Bielefeld in his large, comfortably furnished office. The huge wraparound desk configuration was flanked by 10 quote screens. Despite this vast array of electronics, Bielefeld was low-keyed. He rarely glanced at the screens during the afternoon I spent in his office, and it is hard to visualize him trading frantically at any time, the vast array of quote machines notwithstanding. Bielefeld is soft-spoken man of few words. He is also a very modest man who consistently hesitated talking about his achievements, lest it sound like bragging. His very conservative nature led him to avoid even seemingly innocuous subjects. For example, at one point in discussing the reasons for his net trading losses in a given year, he asked me to turn off my tape recorder. I could hardly imagine what he might say that necessitated this precautionary measure. The off-the-record comments proved far from shocking. It turned out that his trading losses in that year were influenced by an overextension into other commitments, including his membership on the Chicago Board of Trade Board of Directors, a position which required frequent travel to Chicago. Apparently, he was reluctant to be quoted because he did not want to make it seem that he was blaming his other responsibilities, which he deemed part of his natural obligations, for his trading losses. The combination of Bielefeld's laconic nature, modesty, and conservatism made this a very difficult interview. In fact, this was the only interview I conducted in which the average length of the questions was longer than the average length of the responses. I considered deleting the interview from the book, a tempting choice since I had an excess of material. However, I found Bielefeld's story so compelling and his character so strong that I was reluctant to take the easy way out. As a compromise, I weighted this chapter to the narrative side and limited the interview section to a few excerpts. What is your basic approach in analyzing and trading the markets? I always try to lean primarily on fundamental analysis. However, since I found it was very difficult to know all the fundamentals, usually you're doing pretty well if you have 80% of the pieces, I thought it was important to have something to fall back on in case my fundamental analysis was wrong. I assume you are referring to technical analysis as a supplement, right? I developed my own trend-following system. Do you trade this system in any consistent way? I use the system primarily as a backup to tell me when to get out of a position. Can you think of an example? At the start of 1988, one was long the bond market primarily because I was expecting a weaker economy. Everything seemed to be on target until early March when the bond market started edging down. At some point, I have to say you are wrong. In this case, my system provided me with the rationale for getting out of my losing position. What went wrong with that trade? Basically, the economy was a lot stronger than I had anticipated. Thought that there would be a bigger fear factor left over from the October 1987 stock market crash than actually materialized. What is your opinion of trend-following systems? The best thing anyone can do when starting out is to learn how a trend system works. Trading a trend system for a while will teach a new trader the principle of letting profits run and cutting losses short. If you can just learn discipline by using a trend-following system, even temporarily, it will increase your odds of being successful as a trader. Do you have an opinion about systems sold to the public? I looked at some of these systems a few years ago and found that they generally made too many trades. If a system trades too frequently, the transaction costs will be too high, a factor that will significantly reduce the probability of the system working. I think to be viable, a trend-following system has to be medium to longer term. The more sensitive systems just generate too much commission. Besides providing a training vehicle for learning good trading habits, do you feel that trend-following systems can provide an effective trading approach? I would advise anyone who develops a system to combine it with their own judgment. In other words, they should trade half the money on a system and the other half using their own judgment, just in case the system isn't working. Is that the way you trade? I used to pay more attention to systems than I do now, basically. I just focus on my own judgment. Is that because your own judgment is more reliable, or because systems haven't been working as well as they used to? They haven't worked as well as they used to because there are too many people using them. Whenever too many people are doing the same thing, the market will go through a period of adjustment. What are the key factors you focus on in fundamentally evaluating the T-bond market? The economy is definitely the single most important factor. 4 other important elements are inflation expectations, the dollar, the trade balance, and the budget deficit. You have been trading for over 25 years, a much longer time period than most other traders. Is there any single trade that stands out as the most dramatic? There are quite a few trades that would qualify as dramatic, but the one that stands out most prominently was my attempt to pick the bottom of the bond market in 1984. In 1983, when did you start trying to buy the bonds? I started trying to pick a bottom when the bonds were trading in the 63-66 area. How much risk did you allow when putting on a trade? Generally anywhere from 2 rare points. 1 point in T-bond futures is equal to 32 ticks. A 1-point move is equal to 1,000 per contract. So if you tried to pick a spot that looked good and it didn't work, you would bail out and try again at another spot. Since bonds eventually declined into the 50s, I guess you must have had a few strikes against you before you finally went long in the right place. Yes, there were several losses over a period of time. Do you remember when you finally got positioned at a point where you didn't have to get out? I turned really bullish in May 1984, when they auctioned off 5-year notes at a 1,393 yield. I had been involved in banking since 1974, and at the time we couldn't find any qualified borrowers for 3-year loans at 13%. Yet here were government 5-year notes selling at nearly a full percentage point above that level. Moreover, this was at a time when we were at the height of a recession in Peoria, unemployment was approaching 20%, and the farm crisis was worsening. I felt that interest rates had probably gone high enough. From that point on through April 1, 1986, traded T-bonds heavily from the long side. There is no question that that was my best trade and longest trend ever. What are the elements of good trading? The most important thing is to have a method for staying with your winners and getting rid of your losers. What do you do to make sure that you stay with a winning position to exploit the longer-term trend? How do you avoid the temptation of taking profits prematurely? The best way I know to learn discipline and patience is to think through a trade thoroughly before putting it on. You need to develop a plan of your strategies for various contingencies. That way, you won't get swayed by every news item that hits the market and causes prices to move up or down. Also, it helps greatly to have a long-term objective that you have derived by really doing your homework. You combine that long-term objective with a protective stop that you move as the position goes your way. Alternatively, you could use a trend-following system to signal when you should get out of the trade. By having thought out your objective and having a strategy for getting out in case the market trend changes, you greatly increase the potential for staying in your winning positions. Why do most traders lose? They overtrade, which means that they have to be right a lot just to cover commissions. What are the traits of a successful trader? The most important is discipline. I'm sure everyone tells you that. Second, you have to have patience. If you have a good trade on, you have to be able to stay with it. Third, you need courage to go into the market, and courage comes from adequate capitalization. Fourth, you must have a willingness to lose. That is also related to adequate capitalization. Fifth, you need a strong desire to win. Those elements seem fairly straightforward except for the willingness to lose. Can you expound on that? You should have the attitude that if a trade loses, you can handle it without any problem and come back to do the next trade. You can't let a losing trade get to you emotionally. Can you talk more about what you mean by courage? If a 260-pound fullback is running through the line and a 175-pound linebacker has to stop him, he has to have the courage to go into him. You need that kind of courage to be able to participate in the markets. If everyone is bullish the dollar and the yen is sharply lower, it takes courage to fade that major consensus and buy the yen. How do you judge success? Most people will judge success by how well they do in their field. A teacher would judge success by how well the students do, and how they go through life. A trader would probably judge success by whether he wins or loses in the market. Speaking personally, how do you judge success? I judge success by what I do with the money I accumulate. One of the things that my wife and I have done is to establish a foundation so that we could share some of our success with the community by supporting various programs. Is this foundation one that you just fund, or do you have a hands-on relationship in running it? My family and I are directly involved in evaluating different projects and deciding which ones to fund. When did you set up this foundation? In 1985. But I had thought about the idea as far back as the early 1970s. I had always planned that if I were to become successful, I would set up a foundation to help the community. Do you think this long-term goal was an important motivation leading to your success as a trader? Yes, I think it helped. What advice do you have for the beginning trader? When you are starting out, it is very important not to get too far behind because it is very difficult to fight back. Most traders have a tendency to take risks that are too large at the beginning. They tend not to be selective enough about when they take risks. At this point, Bielefeld asked me to turn off the tape recorder. He talked about the relevance and application of poker strategy to trading. His reason for keeping the comments off the record was that he didn't want to contribute to the image of trading as a form of gambling. I found his analogy particularly apropos, and finally persuaded him to put it on the record. Could you explain your analogy between trading and poker? I learned how to play poker at a very young age. My father taught me the concept of playing the percentage. Hands. You don't just play every hand and stay through every card, because if you do, you will have a much higher probability of losing. You should play the good hands and drop out of the poor hands, forfeiting the ante. When more of the cards are on the table and you have a very strong hand, in other words, when you feel the percentages are skewed in your favor, you raise and play that hand to the hilt. If you apply the same principles of poker strategy to trading, it increases your odds of winning significantly. I have always tried to keep the concept of patience in mind by waiting for the right trade, just like you wait for the percentage hand in poker. If a trade doesn't look right, you get out and take a small loss. It's precisely equivalent to forfeiting the ante by dropping out of a poor hand in poker. On the other hand, when the percentages seem to be strongly in your favor, you should be aggressive and really try to leverage the trade similar to the way you raise on. The good hands in poker. Bielefeld's story provides an inspiring example of what is attainable given patience on the one hand and an aggressive trading style on the other. Here is an individual who, starting with a minuscule amount of money, working independently and without benefit of staff or elaborate technology, became one of the world's most successful traders. Moreover, because of his long-term goals and actions, his ultimate success positively impacted an entire community. The portion of Gary Bielefeld's interview that I found most insightful was his analogy between poker and trading. It is also interesting to compare Bielefeld's key point in this analogy to the similar advice offered by James Rogers. Have the patience to wait for the right trade to come along. Ed Sikota, everybody gets what they want. Although completely unknown, not only to the public, but to most of the financial community as well. Ed Sikota's achievements must certainly rank him as one of the best traders of our time. In the early 1970s, Sikota was hired by a major brokerage firm. He conceived and developed the first commercial computerized trading system for managing clients' money in the futures markets. His system proved quite profitable, but interference and second-guessing by management significantly impeded its performance. This experience provided the catalyst for Sikota going out on his own. In the ensuing years, Sikota applied his systematized approach to trading a handful of accounts and his own money. During that period, the accounts Sikota managed have witnessed an absolutely astounding rate of return. For example, as of mid-1988, one of his customer accounts, which started with $5,000 in 1972, was up over 250. 0% on a cash-on-cash basis. Normalized for withdrawals, the account theoretically was up several million %. I know of no other trader who has matched this track record over the same length of time. I had never heard of Sikota when I first began working on this book. Sikota's name had come up several times during my interview of Michael Marcus as the person who was most influential in transforming him into a successful trader. After our interview, Marcus said reflectively, you really should interview Ed Sikota. He is not only a great trader, he is a mind. Marcus provided an introduction over the phone, and I briefly outlined the concept of my book to Sikota. Since I was already out west, it was most convenient for me to interview Sikota on the same trip by rerouting my return to New York via Reno. Sikota was agreeable to participating, but seemed skeptical of my ability to complete the inter-VW in the space of 2 hours, the time available in order for me to make my flight connections. I assured him that, although it was tight, I had done a few other interviews in that space of time. It is feasible as long as our conversation remains very focused, I explained. I cut my arrival at the airport extremely close, having forgotten to revise my ticket to reflect the change in itinerary. After a vociferous argument with a ticket agent who insisted I didn't have enough time to catch my flight, a contention she nearly made self-fulfilling, I raced through the airport, reaching the gate with only seconds to spare. By the time I arrived in Reno, the tension from my near-missed flight had just about dissipated. The drive to Sikota's house was too far for a cab, so I rented a car. It was very early morning, and the highway winding up into the mountains offered spectacular vistas below. The classical music station I found on the radio was playing Mozart's Clarinet Concerto. The combination was glorious. Sikota works from an office in his house, which borders Lake Tahoe. Before beginning the interview, we took a brief walk out onto the beach behind his house. It was a cold, clear morning, and the view was idyllic. The contrast between his workplace and my own, an office in the Wall Street area, with a prominent view of an ugly building, could hardly have been more striking. I plead guilty to jealousy. In contrast to virtually all the other traders I had interviewed, Sikota's desk is not flanked by an array of quote screens, or, for that matter, even a single screen. His trading is largely confined to the few minutes it takes to run his computer program, which generates signals for the next day. In my conversation with Sikota, I was struck by the intensity of both his intelligence and sensitivity, an odd combination, I thought. He has a way of looking at things from a unique vantage point. At one moment, he could be talking about analytical techniques and would appear as the consummate scientist. He holds a degree in electrical engineering from MIT, bringing up a three-dimensional diagram on the computer screen, generated by one of the many programs he had designed. Yet in another moment, when the conversation turned to the psychology of trading, he would reveal great sensitivity and insight into human behavior. Indeed, in recent years, Sikota has become very involved in the field of psychology. It appeared to me that psychology and its application in helping people solve their problems had become a more important element in his life than market analysis and trading. I suspect that Sikota would probably find this contrast somewhat artificial, in that to him, trading and psychology are one and the same thing. Our conversation was not focused as I had intended it to be. In fact, it went off in so many directions that we had barely scratched the surface by the time the 2 hours had elapsed. I continued on, assuming that I would merely catch a later flight. As it turned out, the flight that I had missed was the last direct one from Reno to New York. Sikota later told me that he knew in our first phone conversation that I would end up spending the day. He is extremely perceptive about people. For example, at one point in our conversation, Sikota asked me, "How many minutes fast do you set your watch?" I found this question particularly striking in that in our brief time together, he had been able to pick up on one of my basic character traits. The question was also particularly timely, given my near-missed flight earlier that morning. Sikota's success goes well beyond his trading. He impressed me as someone who had found meaning in his life and was living exactly the life he wanted to be living. How did you first get involved in trading? In the late 1960s, I decided that silver had to rise when the U.S. and the Treasury stopped selling it. I opened a commodity margin account to take full advantage of my insight. While I was waiting, my broker convinced me to short some copper. I soon got stopped out and lost some money and my trading virginity. So I went back to waiting for the start of the big, inevitable bull market in silver. Finally, the day arrived. I bought. Much to my amazement and financial detriment, the price started falling. At first, it seemed impossible to me that silver could fall on such a bullish deal. Yet the price was falling, and that was a fact. Soon my stop got hit. This was a very stunning education about the way markets discount news. I became more and more fascinated with how markets work. About that time, I saw a letter published by Richard Dawkins, which implied that a purely mechanical trend-following system could beat the markets. This too seemed impossible to me. So I wrote computer programs on punch cards in those days to test the theories. Amazingly, his theories tested true. To this day, I'm not sure I understand why or whether I really need to. Anyhow, studying the markets and backing up my opinions with money was so fascinating compared to my other career opportunities at the time that I began trading full-time for a living. What was your first trading-related job? I landed my first job on Wall Street in the early 1970s as an analyst with a major brokerage house. I was assigned to cover the egg and broiler markets. Broilers are young chickens up to 2 pounds dressed weight. The futures markets for both broilers and eggs have since disappeared as waning trading activity prompted their delisting by the parent exchanges. I found it interesting that an entry-level guy like me was immediately placed in charge of dispensing trading advice. I once wrote an article recommending that traders stay away from the market for a while. Management censored that comment from the market letter, likely because it didn't promise to motivate much. Trading. I wanted to start applying computers to the business of analysis. Remember, in those days computers were still typically punch card devices used for accounting. The guy who was running the computer department seemed to see me as a threat to his job security, and he repeatedly chased me off his turf. After about a month at that job, I announced that I was going to quit. The head of the department called me in to find out why. It was the first time he had ever been interested in talking to me. I went to work for another brokerage house, which was going through a reorganization. There was a lot less management. So I took advantage of the lack of supervision by using the accounting computer to test trading systems during the weekends. They had an IBM 360, which took up a large air-conditioned room. Over the course of about a half year, I was able to test about 100 variations of 4 simple systems for about 10 years of data on 10 commodities. Today, the same job takes about 1 day on a PC. Anyway, I got my results. They confirmed there was a possibility of making money from trend-following systems. I take it that computer testing of systems was not part of your job since you did it on weekends. What were you actually hired to do? During the week, my normal Clark Kent-type job was to load new rolls of paper onto the writer's machine when the margin turned pink. I was also responsible for tearing off the news in strips and hanging them up on the wall behind the machine. The trick was to tear between line feeds so as to get a smooth edge. The funny thing was that hardly anyone would read the news since they'd have to lean way over the machine to see the pages. So I started reading the news and personally delivering it to the brokers. One bonus of this job was that I got to observe a lot of brokers' trading styles. Your official position sounds like a glorified office boy. Why did you accept such a menial job? Because I knew I wanted to be in the business, and I didn't care what I did or what I got paid. Why didn't you stay at your original position? At least there you were an analyst. Because it was a stultifying environment. I disapproved of management pressures to recommend trades when I thought there were no trading opportunities. Also saw that being allowed access to the company computers for testing trading systems, my real desire, was a dead issue. Did you know that you could have access to the computer at your new job? No. But since the company had just gone through a major shakeup and most of the management had been fired, I figured there wouldn't be very much of a bureaucracy to interfere with my use of the computer. What became of your work on computerized trading systems? Eventually, management got interested in using my research results for managing money. I developed the first large-scale commercial computerized trading system. What do you mean by large scale? The program was marketed by several hundred agents of the firm, and the equity under management was several $1 million, a large amount of money in the early 1970s. Low. Did you get management to support you to that extent? They were familiar with Richard Dawkins, who was a pioneer in developing trend systems, although at the time he was doing everything by hand. Because of that exposure, they were already favorably disposed to the concept of using trading systems to manage money. Also, at the time, computers were so new that computer system was a great buzzword. How did your trading program do? The program did fine. The problem was that management couldn't keep from second-guessing the signals. For example, I remember one time the program generated a buy signal for sugar when it was trading around 5 cents. Management thought that the market was already overbought and decided not to take the signal. When the market kept on going higher, they came up with the rule that they would buy on the first 20-point pullback. 100 points equal 1 cent. When no such pullback developed, they modified the rule to buying on the first 30-point reaction. As the market kept moving higher without any meaningful retracements, they changed the rule to 50 points and eventually 100 points. Finally, with sugar prices around 9 cents, they finally decided that it was a bull market and that they had better buy before prices went much higher. They put the managed accounts long at that point. As you might guess, the sugar market peaked shortly thereafter. They compounded the error by ignoring the sell signal as well, a signal which also would have been very profitable. The bottom line was that because of this interference, the most profitable trade of the year ended up losing money. As a result, instead of a theoretical return of 60% for the year, quite a few accounts actually lost money. This type of meddling was one of the main reasons why I eventually quit. What were the other reasons? Management wanted me to change the system so that it would trade more actively, thereby generating more commission income. I explained to them that it would be very easy to make such a change, but doing so would seriously impede performance. They didn't seem to care. What did you do after you quit? I just quit the research department, but I stayed on as a broker managing accounts. After about 2 years, I gave up brokerage to become a money manager. That shift allowed me to get away from earning my living from commissions, which I think can be a counterproductive incentive to making money for clients. I switched to a pure profit incentive fee arrangement. Did you continue trading the system after you left? Yes, although I substantially revised the system over the years. What is the performance track record? I do not publicize my track record other than my model account, which is an actual customer account that started with $5. Zero in 1972 and has made over $15 million lion. Theoretically, the total return would have been many multiples larger had there been no withdrawals. With performance like that, how come you haven't been deluged with word-of-mouth requests to manage money? I do receive requests, but I very rarely accept new accounts. If I do, it is only after considerable interviewing and screening to determine the motivations and attitudes of the client. I have found that the people I associate with have subtle yet very important effects on my performance. If, for example, they are able to support me and my methods over the long term, then they tend to help me. If, however, they get too concerned with the short-term ups and downs of their account, they can be a hindrance. How many accounts did you originally start out with? About a half dozen back in the early 1970s. How many of those accounts are still with you? 4. One client made about $15 million lion and decided to withdraw his money and manage it himself. Another made over $10 million lion and decided to buy a house on the beach and retire. What source did you learn from before designing your first system? I was inspired and influenced by the book Reminiscences of a Stock Operator, and also by Richard Donkian's 5 and 20-day moving average crossover system, and his weekly rules system. I consider Donkian to be one of the guiding lights of technical trading. What was your first trading system? My first system was a variation of Donkian's moving average system. I used an exponential averaging method because it was easier to calculate and computational errors tended to disappear over time. It was so new at the time that it was being passed around by word of mouth as the exponential system. Your reference to a first system implies that you eventually changed systems. How did you know when your system needed to be changed? Systems don't need to be changed. The trick is for a trader to develop a system with which he is compatible. Were you incompatible with your original system? My original system was very simple with hard and fast rules that didn't allow for any deviations. I found it difficult to stay with the system while disregarding my own feelings. I kept jumping on and off often at just the wrong time. I thought I knew better than the system. At the time, I didn't really trust that trend-following systems would work. There is plenty of literature proving they don't. Also, it seemed waste of my intellect and MIT education to just sit there and not try to figure out the markets. Eventually, as I became more confident of trading with the trend and more able to ignore the news, I became more comfortable with the approach. Also, as I continued to incorporate more expert trader rules, my system became more compatible with my trading style. What is your trading style? My style is basically trend following with some special pattern recognition and money management algorithms. Without divulging trade secrets, how have you been able to so spectacularly outperform standard trend following systems? The key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. And there are bold traders, but there are very few old, bold traders. Witty and true, but the question remains, albeit in translated form. There are many trend-following systems with money management rules. Why have you done so much better? I seem to have a gift. I think it is related to my overall philosophy, which has a lot to do with loving the markets and maintaining an optimistic attitude. Also, as I keep trading and learning, my system, that is the mechanical computer version of what I do, keeps evolving. I would add that I consider myself and how I do things as a kind of system which, by definition, I always follow. Sometimes I trade entirely off the mechanical part, sometimes I override the signals based on strong feelings, and sometimes I just quit altogether. The immediate trading result of this jumping around is probably break-even to somewhat negative. However, if I didn't allow myself the freedom to discharge my creative side, it might build up to some kind of blowout. Striking a workable ecology seems to promote trading longevity, which is one key to success. How would you compare the relative advantages and disadvantages of systems trading versus discretionary trading systems? Trading is ultimately discretionary. The manager still has to decide how much risk to accept, which markets to play, and how aggressively to increase and decrease the trading base as a function of equity change. These decisions are quite important, often more important than trade timing. What percentage of your trading is systems-based? Has this percentage changed over time? Over time, I have become more mechanical since 1 have become more trusting of trend trading, and 2, my mechanical programs have factored in more and more tricks of the trade. I still go through periods of thinking I can outperform my own system, but such excursions are often self-correcting through the process of losing money. What are the present and future prospects for trend-following systems? Do you think the growing prevalence of their use will doom them to eventual failure? No. All trading is done on some sort of system, whether or not it is conscious. Many of the good systems are based on following trends. Life itself is based on trends. Birds start south for the winter and keep on going. Companies track trends and alter their products accordingly. Tiny protozoa move in trends along chemical and luminescence gradients. The profitability of trading systems seems to move in cycles. Periods during which trend-following systems are highly successful will lead to their increased popularity. As the number of system users increases and the markets shift from trending to directionless price action, these systems become unprofitable, and undercapitalized and inexperienced traders will get shaken out. Longevity is the key to success. What are your thoughts about using fundamental analysis as an input in trading? Fundamentals that you read about are typically useless as the market has already discounted the price, and I call them funny-mentals. However, if you catch on early before others believe, then you might have valuable surprise-a-mentals. Your answer is a bit facetious. Does it imply that you only use technical analysis? I'm primarily a trend trader with touches of hunches based on about 20 years of experience. In order of importance to me are 1, the long-term trend, 2, the current chart pattern, and 3, picking a good spot to buy or sell. Those are the 3 primary components of my trading. Way down in very distant 4th place are my fundamental ideas and, quite likely, on balance, they have cost me money. By picking the right spot to buy, do you mean determining a reaction point at which you will buy? If so, how do you avoid sometimes missing major price moves? Oh no. If I were buying, my point would be above the market. I try to identify a point at which I expect the market momentum to be strong in the direction of the trade, so as to reduce my probable risk. I don't try to pick a bottom or top. Does that imply that if you are bullish, you will always wait for short-term strength before entering a position? or will you sometimes buy on a reaction? If I am bullish, I neither buy on a reaction nor wait for strength. I am already in, I turn bullish at the instant my buy stop is hit, and stay bullish until my sell stop is hit. Being bullish and not being long is illogical. Do you ever use contrary opinion as an aid to your trading? Sometimes. For example, at a recent gold bug conference, virtually all the speakers were bearish. I said to myself, gold is probably near a bottom. The market did indeed rally after that conference. Would you buy because of that type of input? No, the trend was still down, but it might get me to lighten up my short position. What was your most dramatic or emotional trading experience? Dramatic and emotional trading experiences tend to be negative. Pride is a great banana peel, as are hope, fear, and greed. My biggest slip UPS occurred shortly after I got emotionally involved with positions. How about some actual war stories? I prefer not to dwell on past situations. I tend to cut bad trades as soon as possible, forget them, and then move on to new opportunities. After I bury a dead trade, I don't like to dig up the details again, at least not in print. Maybe some evening after dinner, sitting around a fire, off the record, deep in the Tahoe winter. Can you describe specific trading mistakes that you learned from? I had a thing for silver for years. One of my first losses was in silver, as were many of my worst losses. It seemed to get into my blood and hypnotize me. It inveigled me to pull my protective stop so as to avoid getting bear rated. Naturally, it would hold momentarily and then collapse some more. I got killed so many times by silver spikes that I started thinking I was some kind of werewolf. I worked on myself with hypnosis and positive imagery. I also avoided walks in the full moon. So far, it seems to be working. How do you pick your trades? Mostly by my trading system, although occasionally I will get an impulsive flash and override my system. Fortunately, I don't usually take on a big enough position to do any lasting damage to my portfolio. What are the elements of good trading? The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance. How do you handle a losing streak? I handle losing streaks by trimming down my activity. I just wait it out. Trying to trade during a losing streak is emotionally devastating. Trying to play catch-up is lethal. Since you are primarily a systems trader, wouldn't following a system imply no changes of trading activity during losing periods? I have incorporated some logic into my computer programs, such as modulating the trading activity depending on market behavior. Still, important decisions need to be made outside the mechanical system boundaries, such as how to maintain diversification for a growing account when some positions are at position limit or when markets are too thin. Psychologically, I tend to alter my activity depending on performance, tend to be more aggressive after I have been winning and less so after losses. These tendencies seem okay. In contrast, a costly tendency is to get emotional over a loss and then try to get even with an overly large position. Are you a self-taught trader, or did another trader teach you worthwhile lessons? I am a self-taught trader who is continually studying both myself and other traders. Do you decide where you're getting out before you get in on a trade? I set protective stops at the same time I enter a trade. I normally move these stops in to lock in a profit as the trend continues. Sometimes I take profits when a market gets wild. This usually doesn't get me out any better than waiting for my stops to close in, but it does cut down on the volatility of the portfolio, which helps calm my nerves. Losing a position is aggravating, whereas losing your nerve is devastating. What is the maximum percentage of equity you will risk on any individual trade? I intend to risk below 5% on a trade, allowing for poor executions. Occasionally, I have taken losses above that amount when major news caused a thin market to jump through my stops. What was your single worst thin market loss? All markets are too thin when I want to get out of a bad position in a hurry. Most markets have, on occasion, moved rapidly against me due to surprise news. As soon as the news is digested, the market thickens up again at a new level. During the big sugar bull market, when prices moved from 10 cents to 40 cents, I was carrying thousands of contracts and I gave up several cents getting out of my position. Each cent in sugar is equivalent to $1,120 per contract. Very few traders have enjoyed the spectacular success you have. What makes you different? I feel my success comes from my love of the markets. I am not a casual trader. It is my life. I have a passion for trading. It is not merely a hobby or even a career choice for me. There is no question that this is what I am supposed to do with my life. What are the trading rules you live by? Cut losses. A, B, C, D, E. Ride winners. Keep bets small. Follow the rules without question. Know when to break the rules. Your last two rules are cute because they are contradictory. Seriously now, which do you believe? Follow the rules or know when to break the rules? I believe both. Mostly I follow the rails. As I keep studying the markets, I sometimes find a new rail which breaks and then replaces a previous rail. Sometimes I get to a personal breakpoint. When that happens, I just get out of the markets altogether and take a vacation until I feel that I am ready to follow the rails again. Perhaps someday, I will have a more explicit rail for breaking rails. I don't think traders can follow rails for very long unless they reflect their own trading style. Eventually, a breaking point is reached and the trader has to quit or change, or find a new set of rails he can follow. This seems to be part of the process of evolution and growth of a trader. How important to trading success is varying the size of the bet. It might be a good idea depending on the reason for doing so. Consider, though, if you had a successful modification policy, say M for changing system S, then you might be better off just trading M. How important is gut feel? Gut feel is important. If ignored, it may come out in subtle ways by coloring your logic. It can be dealt with through meditation and reflection to determine what's behind it. If it persists, then it might be a valuable subconscious analysis of some subtle information. Otherwise, it might be a dangerous sublimation of an inner desire for excitement and not reflect market conditions. Be sensitive to the subtle differences between intuition and wishing. What was your worst year? What went wrong? One of my worst years was 1980s. The bull markets had ended, but I kept trying to hold on and buy back in at lower prices. The markets just kept on breaking. I had never seen a major bear market before, so I was all set up for an important educational experience. What happened to the money management rules in your system in 1980s? Did you override them? I continued to trade even though my system was largely out of the markets due to the enormous volatility. I tried to pick tops and bottoms in what I considered grossly overbought and oversold markets. Markets just kept on going and I lost a lot. Eventually, I saw the futility of my approach and quit for a while. What is the most important advice you can give the average trader? That he should find a superior trader to do his trading for him, and then go find something he really loves to. Do you believe chart reading can be used for successful trading? I consider trend following to be a subset of charting. Charting is a little like surfing. You don't have to know a lot about the physics of tides, resonance, and fluid dynamics in order to catch a good wave. You just have to be able to sense when it's happening and then have the drive to act at the right time. What was your personal experience in October 1987? I made money on the day of the October 1987 crash. I also made money for the month as a whole, and for the year as well. I lost on the day after the crash, however, since I was short the interest rate markets. Most trend traders were likely either out or short stocks and stock indexes during the crash. Are the markets different now than they were 5 to 10 years ago because of the much greater current participation by professional managers? No. The markets are the same now as they were 5 to 10 years ago because they keep changing, just like they did then. Does trading become more difficult as your size increases? It becomes more difficult because it is harder to move large positions without moving the market. It becomes easier because you have more access to competent people to support you. What type of support do you mean? A team of experienced brokers with professional attitudes. Experienced traders can be very supportive by just being there for sharing joys and sorrows. Also, the old-timers seem to be able to smell the beginnings and endings of major moves. I also receive important support from my friends, associates, and family. Solo. Do you use any outside advisory services? I keep track of a lot of outside advisors, mostly by reading the business press or hearing from my brokers. The services usually break even, except when they start to gloat, then they are likely headed for trouble. How about market letters? Market letters tend to lag behind the market since they generally respond to demand for news about recent activity. Although there are certainly important exceptions, letter writing is often a beginning job in the industry, and, as such, may be handled by inexperienced traders or non-traders. Good traders trade. Good letter writers write letters. Do you use the opinions of other traders in making trading decisions? Or do you operate completely? I usually ignore advice from other traders, especially the ones who believe they are onto a sure thing. The old-timers who talk about maybe there is a chance of so-and-so are often right and early. At what point did you get the confidence that you could keep on winning as a trader? I vacillate between A, I can keep on winning, and B, I have just been lucky. I sometimes get most confident of my ability just before a major losing streak. How similar are the price patterns in different markets? Common patterns transcend individual market behavior. For example, bond prices have a lot in common with the way cockroaches crawl up and down a wall. Unfortunately for cockroach followers, there is usually no one around to take the other side of a trade. Does the stock market behave differently from other markets? The stock market behaves differently from all other markets, and it also behaves differently from the stock market. If this is hard to understand, it is because trying to understand the markets is a bit futile. I don't think it makes any more sense trying to understand the stock market than trying to understand music. A lot of people would rather understand the market than make money. What do you mean the stock market behaves differently from the stock market? The stock market behaves differently from itself in that easily identifiable patterns seldom exactly repeat. What is your long-term outlook for inflation, the dollar, and gold? Inflation is part of the way societies sweep away the old order. All currencies eventually get debased, like it or not. Compute 1 penny invested at the time of Christ, compounded at 3% per year. Then consider why nobody has anywhere near that amount these days. Gold tends to be dug up, refined, and then buried again. The geographical entropy of all gold on the planet seems to decrease over time. A lot has been collected in vaults. I project the trend as one toward a central world gold stash. Do great traders have a special talent for trading? Good traders have a special talent for trading, just as good musicians and good athletes have talents for their fields. Great traders are ones who are absorbed by the talent. They don't have the talent has them. What is the balance between talent versus work in trading success? I don't know where one starts and the other stops. How much of a role does luck play in trading success? Luck plays an enormous role in trading success. Some people were lucky enough to be born smart, while others were even smarter and got born lucky. How about a serious answer? Luck, or smarts or gift are words indicating an attitudinal proclivity for mastery. One tends to do well at one's calling. I think most good traders have a little extra spark about trading. Some people are natural musicians or painters or salesmen or analysts. I think it is difficult to acquire talent for trading. However, if it is already there, it can be discovered and developed. What effect has trading had on your personal life? My personal life is integrated with my trading life. Is the joy of winning as intense as the pain of losing? The joy of winning and the pain of losing are right up there with the pain of winning and the joy of losing. Also to consider are the joy and pain of not participating. The relative strengths of these feelings tend to increase with the distance of the trader from his commitment to being a trader. When you made your first few million, did you lock some of it away to avoid the Jesse Livermore experience? Livermore was a famous speculator of the early 20th century who made and lost several fortunes. I feel the Livermore experience was a function of his psychology and had little to do with the location of his assets. In fact, I remember reading that Jesse Livermore used to lock some of his winnings away and then find a key when he needed to get at them. Therefore, locking up winnings would be necessary to emulate his experience, not to avoid it. Furthermore, you would probably also need to overtrade and have wipeouts, while you simultaneously fired up your emotions with the burning desire to win it right back. Acting out this drama could be exciting. However, it also seems terribly expensive. One alternative is to keep bets small and then to systematically keep reducing risk during equity drawdowns. That way, you approach your safe money asymptotically and have a gentle financial and emotional touchdown. I notice there is no quote machine on your desk. Having a quote machine is like having a slot machine on your desk. You end up feeding it all day long. I get my price data after the close each day. Why do so many traders fail in the marketplace? For the same reason that most baby turtles fail to reach maturity. Many are called and few are chosen. Society works by the attraction of the many. As they are called out, the good ones are left and the others are released to go try something else until they find their calling. The same is true for other fields of pursuit. What can a losing trader do to transform himself into a winning trader? A losing trader can do little to transform himself into a winning trader. A losing trader is not going to want to transform himself. That's the kind of thing winning traders do. How would you rate the relative importance between psychology and market analysis too? Successful trading. Psychology motivates the quality of analysis and puts it to use. Psychology is the driver and analysis is the roadmap. You have focused a lot on the field of psychology. Can you tell by talking to a person whether that person would probably be a winning or losing trader? Yes, the winning traders have usually been winning at whatever field they are in for years. What traits do you look for to identify the winning trader personality? 1. He/she loves to trade, and 2. He/she loves to win. Don't all traders want to win? Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money. I know one trader who seems to get in near the start of every substantial bull move and works his $10,000 up to about $250,000 in a couple of months. Then he changes his personality and loses it all back again. This process repeats like clockwork. Once I traded with him, but got out when his personality changed. I doubled my money while he wiped out as usual. I told him what I was doing and even paid him a management fee. He just couldn't help himself. I don't think he can do it any differently. He wouldn't want to. He gets a lot of excitement, he gets to be a martyr, he gets sympathy from his friends, and he gets to be the center of attention. Also, possibly, he may be more comfortable relating to people if he is on their financial plane. On some level, I think he is really getting what he wants. I think that if people look deeply enough into their trading patterns, they find that on balance, including all their goals, they are really getting what they want, even though they may not understand it or want to admit it. A doctor friend of mine tells a story about a cancer patient who used her condition to demand attention and, in general, to dominate others around her. As an experiment prearranged with her family, the doctor told her a shot was available which would cure her. She constantly found excuses to avoid appearing for the shot and eventually avoided it entirely. Perhaps her political position was more important than her life. People's trading performance probably reflects their priorities more than they would like to admit. I think that some of the most flamboyant and interesting traders are playing for more than profits alone. They are probably also playing for excitement. One of the best ways to increase profits is to do goal setting and visualizations in order to align the conscious and subconscious with making profits. I have worked with a number of traders in order to examine their priorities and align their goals. I use a combination of hypnosis, breathing, pacing, visualization, gestalt, massage, and so forth. The traders usually either 1, get much more successful, or 2, realize they didn't really want to be traders in the first place. Surely some people lose because they lack the skill, even though they really want to win. It is a happy circumstance that when nature gives us true burning desires, she also gives us the means to satisfy them. Those who want to win and lack skill can get someone with skill to help them. I sometimes have dreams related to the impending direction of a market. Although these dreams tend to be very infrequent, uncannily, they often prove right. Have you had any similar experiences? I know several people who claim to have market insights during dreams. I think one of the functions of dreams is to reconcile information and feelings which the conscious mind finds intractable. For instance, I once told a lot of my friends that I expected silver to keep on going up. When it went down instead, I ignored the signs and tried to tell myself it was just a temporary correction. I stood to lose face and money. I couldn't afford to be wrong. Around that time, I had dreams of being in a big, shiny, silver aircraft that stalled out and started going down toward an inevitable crash. I eventually dumped my silver position, even went short, and the dreams stopped. How do you judge success? I don't judge success. I celebrate it. I think success has to do with finding and following one's calling regardless of financial gain. Don't be fooled by the humor in Sekoda's comments. There's a great deal of serious wisdom in his pithy replies. For me personally, the most striking comment was, "Everybody gets what they want out of the market." When Sekoda first made this remark, I thought he was merely being cute. But I soon realized he was deadly serious. My reflexive response to this premise was disbelief. It implies that all losers want to lose and all winners who fall short of their goals, like myself, are fulfilling some inner need for a constrained threshold of success, a difficult proposition to swallow. Although my rigidly logical mind would normally dismiss the idea, my respect for Sekoda's knowledge about markets and people forces me to consider the potential truth of the statement that everybody gets what they want out of the market, a most provocative concept. Larry Hite respecting risk. Larry Hite's interest in the financial markets was sparked by a college course, but his path to Wall Street was as circuitous as Moses to the land of Israel. His early adult years did not offer any clue that this was a young man headed for eventual major success. First, his academic performance was inauspicious. Then he went through a string of odd jobs, never managing to hold any for very long. Eventually, he drifted into a dual career of actor and screenwriter. While not recording any major successes, he managed to support himself and enjoyed his work. One of his movie scripts, which never found its way into production, was optioned so often that he began to view it as a source of steady income. One day, Hite heard H.L. Hunt on the radio describing how he made his fortune buying up lots of cheap oil right options, which gave him the opportunity for occasional windfall profits with minimal risk. That same night, Hite briefly met Brian Epstein, the manager of the Beatles, at a party. The two ideas fused in his mind, leading to another career change. He thought to himself, here is something, a rock promoter, that has the potential for making a lot of money with a minimal investment. Although he landed a few record contracts for some of his groups, none ever reached true stardom. Once again, although his success was limited, he managed to earn a satisfactory living in a self-employed position. Meanwhile, Hite's real interest remained in the financial markets. You often hear about people working on Wall Street become screenwriters. I may be the only person who ever worked as an actor in a script-writer pay-for-me Wall Street career, he says jokingly. In 1968, Hite finally decided to pursue his primary interest. While fascinated with the futures markets, he didn't have the slightest idea how to break into that field, so he began as a stockbroker. Several years later, he became full-time commodities broker. More than a decade passed before Hite, convinced that he had learned the ingredients necessary for successful long-term trading performance, took the initial steps that led to the ultimate formation of Mint Investment Management Company. He realized that his trading ideas needed to be subjected to rigorous scientific testing. With an offer of partnership but no immediate pay, he enlisted Peter Matthews, who held a PhD in statistics. 1 year later, he hired Michael Dellman, a designer of computer systems for a defense electronics firm. Matthews and Dellman brought their own ideas to the table, but perhaps even more significantly, their work provided the mathematical proof that Hite's trading concepts were indeed statistically sound. Hite is emphatic that Mint's success would not have been possible without Matthews and Dellman. Mint's objective was never to make the largest percentage return. Rather, Hite's philosophy was to aim for the best growth rate consistent with extremely rigorous risk control. It is in this perspective, return relative to risk, that Mint really shines. From the inception of trading in April 1981 through mid-1988, Mint registered an average annual compounded return of over 30%. But it is their consistency that is most impressive. Their annual returns have ranged from a worst of plus 13% to a best of plus 60%. Their largest loss in any 6-month period was only 15% and under 1% in any 12-month period, not just calendar years. Not surprisingly, Mint's stellar performance has resulted in a spectacular growth of equity under management. In April 1981, they began trading with $2 million land. Today, they manage over $800 million land. Significantly, there is no evidence that the surge of money under management has had any deleterious effect on performance. Haidt believes that Mint can ultimately manage $2 billion, an unprecedentedly large sum for a futures fund. Our interview was conducted over lunch at Windows of the World atop New York's World Trade Center, on a day it was blanketed with clouds. We took the hint when we were the last ones left in the restaurant and finished the interview in Haidt's office. How did you first get interested in markets? When I was in college, I took a business course with a professor who had a trenchant sense of humor. To give you an example, he also worked as a bank examiner one day before leaving the bank following an audit turned to the bank president and, as a joke, said, "Got you." The man had a heart attack on the spot. After that, they did another audit and found that the bank president had embezzled $75,000. Anyway, in class one day, this professor is reviewing all the financial instruments, stocks, bonds, and so on. Then he says, "Now we come to the craziest market of all commodities. These people trade on only 5% margin, and most of them borrow that." The whole class laughed except me. For some reason, the idea of trading on 5% margin made perfect sense, Tom. When did you first get involved in the financial markets? Not until many years later. I was a rock promoter at the time, and on one weekend there were 3 separate shootings in clubs at which the groups I managed were working. I decided it was an opportune time to change careers and pursue my true interest, the financial markets. Although I was really interested in futures, I didn't have any idea how to look for a job in that field. So I decided I would start out as a stockbroker. My first interview was with a very old-line Wall Street firm with offices that made you feel like you should speak in hushed tones. The man who interviewed me was the kind of guy, he adopts a pompously refined voice, who talks with his teeth together and lives in Connecticut. He tells me, "We only buy blue chips for our clients." Not having a financial background, I was unfamiliar with the term blue chip, but it sounded odd to me in the context of a state investment firm. So after the interview, I looked up its derivation. I found that the origin of the term could be traced to the color of the most expensive chip in Monte Carlo. I said to myself, "Aha, now I know what this game is all about, gambling." I threw away my copy of Graham and Dodd, Principles of Security Analysis, considered by many to be the Bible of stock market analysis, and bought a book called Beat the Dealer. I came away with the idea that successful investment was really a matter of odds, and if you could compute the odds, you could find and test methods that could beat the market. What made you believe that you could develop methods to put the odds in your favor? I don't know that I understood it all then, but over the years I came to realize that the markets are inefficient. I have a friend who is an economist. He would try to explain to me, as if talking to a child, why what I was trying to do was futile because the markets are efficient. I have noticed that everyone who has ever told me that the markets are efficient is poor. He argued that if I could develop a winning system on a computer, so could others, and we would all cancel each other out. What is wrong with that argument? Because people develop systems and people will make mistakes. Some will alter their system or jump from system to system, as each one has a losing period. Others will be unable to resist second-guessing the trading signals. Whenever I go to a money management conference and sit down with a group to have some drinks at night, I always hear the same story. My system worked great, but I just didn't take the gold trade, and that would have been my biggest winner. There is a very important message here. People don't change. That is why this whole game works. In 1637, tulips in Holland traded for 5,500 florins and then crashed to 50, a 99% loss. Well, you might say trading was relatively new then. These people were primitive. Capitalism was still in its infancy. Today we are much more sophisticated. So you go to 1929 and find a stock like Air Reduction, which traded at a high of 233, and after the crash fell to $31. A decline of 87%. Okay, you might say the roaring 20s were crazy times, but now things are surely different. Move ahead to 1961, and you find a stock called Texas Instruments trading at 207. It eventually dropped to $49, a decline of 77%. If you think we have gotten more sophisticated in the 1980s, all you have to do is look at silver prices, which in 1980s reached a peak of $50 and subsequently fell to $5, a 90% decline. The point is that because people are the same, if you use sufficiently rigorous methods to avoid hindsight, you can test a system and see how it would have done in the past and get a fairly good idea of how that system will perform in the future. That is our edge. Isn't it possible that the markets can change and the future will be very different from the past? The markets may change, but people won't. When we were still in the testing stage, before we actually started managing any money, my partner Michael Dellman came up with the concept of using holding periods as a measure of system performance. Evaluating systems solely on a calendar year basis is very arbitrary. What you really want to know are the odds for profitable performance in a holding period of any length. In our simulations, Peter determined that 90% of all the 6-month holding periods, 97% of the 12-month periods, and 100% of the 18-month periods would be profitable. After over 7 years of actual trading, the numbers turned out to be 90%, 99%, and 100%. I will tell you how confident I am of the future validity of our evaluation process. There is a fellow who works for us who used to be a colonel in the British Army. His service specialty was dismantling bombs all over the world. I asked him, "How did you do it?" "It wasn't that difficult," he says. There are different styles of bombs. A bomb in Malaysia is different from a bomb in the Middle East. You go there and see what kind of bomb it is and take it apart. I said, "Let me ask you a question. What happens when you come across a bomb that you don't know?" He looks me in the eye and says, "You record your first impression and hope it is not your last." Came into the office one day and found this same steel-nerved individual virtually on the brink of tears. I asked him what was wrong. It turned out that the Fed had made a major policy change, which dramatically reversed many major market trends. Overnight, our fund, which had gone from a starting value of $10 to nearly $15, had fallen back to under $12, just after he had opened a major Swiss bank as an account. I told him, "Get them on the phone." "What?" he asked, somewhat confused. I repeated, speaking more slowly and emphatically. GETHEMONTHEPHONE. When I was a broker, my boss taught me that if you don't call your client when he is losing money, someone else will. And to be honest, when I was a broker, I did the same thing. When I called prospects and they complained about their broker, I would say, "Oh, how could he put you in that trade?" So I get the account on the phone and explain that our simulations show that this type of event will occur once every few years and that I am confident that in 9 months the fund will be back to a new high. In fact, I said, "I have just borrowed some money to add to my own investment in the fund." "You really did that?" he asked in a surprised tone. I assured him that I did. Well, the account doubled up on their investment and the fund immediately shot straight up. Today, that account is one of our biggest clients. How could I be so sure? I knew what those systems were about. What makes this business so fabulous is that, while you may not know what will happen tomorrow, you can have very good idea what will happen over the long run. The insurance business provides a perfect analogy. Take one 60-year-old guy and you have absolutely no idea what the odds are that he will be alive 1 year later. However, if you take 100,000 60-year-olds, you can get an excellent estimate of how many of them will be alive 1 year later. We do the same thing. We let the law of large numbers work for us. In a sense, we are trading actuaries. I have a friend who went broke trading futures. He can't understand how I can trade by following a computerized system religiously. We were playing tennis one day and he asked me, "Larry, how can you trade the way you do? Isn't it boring?" I told him, "I don't trade for excitement. I trade to win. It may be very dull, but it is also very lucrative." When I get together with other traders and they start exchanging war stories about different trades, I have nothing to say. To me, all our trades are the same. There are many money managers who use trend-following systems, and quite a few of those don't second-guess their own systems. What makes Mint different? How have you been able to achieve return-risk ratios far above the industry average? Because we know that we don't know. No matter what information you have, no matter what you are doing. You can be wrong. I have a friend who has amassed a fortune in excess of $100 million, Lion. He taught me two basic lessons. First, if you never bet your lifestyle from a trading standpoint, nothing bad will ever happen to you. Second, if you know what the worst possible outcome is, it gives you tremendous freedom. The truth is that, while you can't quantify reward, you can quantify risk. I will give you an example how important this advice is. One of the world's largest coffee traders invited me to his house in London. When I walked into his library, I noticed he had just about every book ever written on power. He took me to one of the finest restaurants I have ever been at. At dinner, he asked me, "Larry, how can you know more about coffee than me? I am the largest trader in the world. I know where the boats are. I know the ministers." "You are right," I answered. "I don't know anything about coffee. In fact, I don't even drink it." "How do you trade it then?" he asked. I told him, "I just look at the risk." Well, this great meal lasted for several hours. 5 times he asked me what I did, and 5 times I told him that I managed the risk. 3 months later, I heard that he had blown $100 million lion in the coffee market. He obviously didn't get the message. And you want to know something? He does know more about coffee than I do. But the point is, he didn't. Look at the risk. So the very first rail we live by at Mint is, never risk more than 1% of total equity on any trade. Only risking 1%, am indifferent to any individual trade. Keeping your risk small and constant is absolutely critical. For example, one manager I know had a large account that withdrew half the money he was trading. Instead of cutting his position size in half, this manager kept trading the same number of contracts. Eventually, that half of the original money became low percent of the money. Risk is a no-fooling-around game. It does not allow for mistakes. If you do not manage the risk, eventually they will carry you out. The second thing we do at Mint is that we always follow the trends and we never deviate from our methods. In fact, we have a written agreement that none of us can ever countermand our system. The trades are all the same. That is the reason why we have never had a bad trade at Mint. There are really 4 kinds of trades or bets: good bets, bad bets, winning bets, and losing bets. Most people think that a losing trade was a bad bet. That is absolutely wrong. You can lose money even on a good bet. If the odds on a bet are 50-50 and the payoff is $2 versus a 1 risk, that is a good bet even if you lose. The important point is that if you do enough of those trades or bets, eventually you have to come out ahead. The third thing we do to reduce risk is diversify. We diversify in 2 ways. First, we probably trade more markets worldwide than any other money manager. Second, we don't just use a single best system. To provide balance, we use lots of different systems ranging from short-term to long-term. Some of these systems may not be that good by themselves, but we really don't care. That is not what they are there for. The fourth thing Mint does to manage risk is track volatility. When the volatility of a market becomes so great that it adversely skews the expected return-risk ratio, we will stop trading that market. Essentially, our approach has 3 lights in determining the acceptance of trading signals. When the light is green, we take all signals. When the light is yellow, we will liquidate an existing position on a signal, but we will not put on a new position. Finally, when the light is red, we liquidate existing positions automatically, and we do not take any new positions. For example, in 1986, when coffee went from 1.30 to 2.80 and back to 1.0, we got out of our long positions on the way up at 1.70 and didn't trade the market for the rest of the price climb and subsequent collapse. Now, while we may have lost some additional profits, being out of markets like that is one of the ways we are able to achieve such rigid risk control. So one of the key differences between you and other trend-following managers is that you have developed a way of defining when not to play. In any situation or game, you can define a positional advantage for any player, even the weakest one. In trading, you can define 3 categories of players: the trade, the floor, and the speculator. The trade has the best product knowledge and the best ways of getting out of positions. For example, if they are caught in a bad position in the futures markets, they can offset their risk in the cash market. The floor has the advantage of speed. You can never be faster than the floor. While the speculator doesn't have the product knowledge or the speed, he does have the advantage of not having to play. The speculator can choose to only bet when the odds are in his favor. That is an important positional advantage. You mentioned before that you used increased volatility as a signal to stop trading a market. How many days of past data do you use to determine your volatility filter? Anywhere from 10 to 100 days. When you say 10 to 100, are you different time frames within that range? To be deliberately ambiguous, or do you? We look at different time windows in that range you use. I fully understand the logic of your 1% stop-loss rule. However, my one question is, once you are stopped out of a position without the system providing an opposite signal, what gets you back into the trade if the market reverses to its original direction? Isn't it possible that you could get stopped out on a moderate price reaction and then miss a subsequent major move? If the market makes a new high, we get back in. For example, if a long position is stopped out on a money management rule without a sell signal actually being generated, the system will still be in a long mode and no buy signal will be generated, no matter how high prices go. If, however, a sell signal were generated, the system would begin monitoring for a buy signal. But suppose that the market goes into a wide trading range, might you not get continuously whipped between being stopped out and re-entering the position at new highs? That happens, but not enough to be a problem. You have an incredibly strong respect for risk. Were there any personal events in your trading career that ingrained you with that attitude? When I first became involved in commodities, I noticed that if you bought pork bellies in September and sold them before July, you almost always made a profit. So I formed a fund with a group of friends and I put on this trade. It worked. I doubled the money. I felt like a genius. At the time, I had a friend who followed the corn market. I didn't know anything about corn. I only knew about pork bellies. He talked me into buying the new crop corn and selling the old crop. Since this was supposed to be a relatively safe trade, in that I was offsetting my long position in one contract month with a short position in another month, I really loaded up. Shortly thereafter, the government released a surprising crop estimate. In response, the month I was long went limit down and the month I was short went limit up. I was in such despair that I remember walking out to the stairway and literally getting down on my knees and saying out loud, "Dear God, I don't care how much I lose, but please don't let the account go into a debit." At the time, I was working for a sophisticated international firm, and just as I was making my providential plea, a Swiss banker came walking down the staircase. To this day, I still wonder what he must have thought. Were there any other personal traumatic experiences caused by a failure to heed market risk? Not for myself, but throughout my financial career, I have continually witnessed examples of other people that I have known being ruined by a failure to respect risk. If you don't take a hard look at risk, it will take you. When I was a kid and got my first motorcycle, I had an older friend who would always get into fights. He told me, "Larry, when you are on a motorcycle, never argue with a car. You will lose." The same lesson applies to trading. If you argue with the market, you will lose. The Hunt brothers are a perfect example. Somebody once asked me, how could the Hunts lose? They were worth billions. Let's say you have $1 billion and you buy $20 billion worth of silver. I am making these numbers up for the sake of the example. You are in exactly the same risk position as the guy with $1. Zero who owns $20,000 worth of silver. I have a good friend who started from very humble beginnings. His father was a sanitation man. Anyway, he is a very bright guy and he got into option arbitrage. He was extremely good at it and made a fortune. I remember visiting him at a palatial estate he bought in England. Well, he may have been a great arbitrageur, but he turned out to be a bad trader. He developed a trading system that made money. One day he said to me, "I'm not taking the sell signal in gold. It doesn't look right to me. Besides, almost 50% of the signals are wrong anyway." Not only didn't he take the sell signal, he actually wound up going long. Sure enough, the market went down. I told him, "Get out." But he insisted the market will come back. Well, he didn't get out, and he lost the mansion and everything else. Now he lives in a rented box on a street, with 100 other ticky-tacky houses. To this day, I still remember the name of his estate, Beverly. He is still one of my best friends, and his loss of that huge house had an enormous emotional impact on me. He had it and lost it all because of one trade. The irony is that if he had followed his system, he would have made a fortune on that trade. I will tell you another story. I have a cousin who turned $5,000 into $100,000 in the option market. One day I asked him, "How did you do it?" He answered, "It is very easy. I buy an option, and if it goes up, I stay in. But if it goes down, I don't get out until I am at least even." I told him, "Look, I trade for a living, and I can tell you that strategy is just not going to work in the long run." He said, "Larry, don't worry, it doesn't have to work in the long run, just till I make $1 million. I know what I am doing. I just never take a loss." I said, "Okay." In his next trade, he buys $90,000 worth of Merrill Lynch options, only this time it goes down and down and down. I talked to him about 1 month later, and he tells me he is in debt for $10,000. One said, "Wait a minute. You had $100,000 and you bought $90,000 in options. That should still leave you with $10,000 even after they expired. Worthless. How could you have a deficit of $10,000? He said, "I originally bought the options at $4,000. When the price went down to 11, figured out that if I bought another $20,000, all it had to do was go back to 2 for me to break even. So I went to the bank and borrowed $10,000. Respect for risk is not just a matter of trading, it applies to any type of business decision. I once worked for a firm where the company president, a very nice guy, hired an option trader who was brilliant, but not stable. One day the option trader disappeared, leaving the firm stuck with a losing position. The president was not a trader, and he sought my advice. "Larry, what do you think I should do?" I told him, "Just get out of the position." Instead, he decided to hold on to the trade. The loss got a little worse, but then the market came back, and he liquidated the position at a small profit. After this incident, I told a friend who worked at the same firm, "Bob, we are going to have to find another job." "Why?" he asked. I answered, "We work for a man who has just found himself in the middle of a minefield, and what he did was close his eyes and walk through it. He now thinks that whenever you are in the middle of a minefield, the proper technique is to close your eyes and go forward." Less than 1 year later, this same man had to liquidate a huge delta neutral spread position in options, a balanced position whose value will change very little for small price moves in either direction. Instead of just getting out, he decided to get out of the position one leg at a time. By the time he finished liquidating that position, he had gone through all of the firm's capital. Besides errors in risk control, why do people lose money trading? Sometimes because their trades are based on a personal bias instead of a statistical approach. For example, there is a regular panelist on Wall Street Week who is about 65 or 70 years old. On the show one day, he said that the lesson his father taught him was, bonds are the cornerstone of your portfolio. Think about that. Since this man first got into the business, he has seen interest rates go down only once out of every 8 years. Bonds go up when interest rates decline. Obviously, the name bonds means a lot more to him than the reality. You trade a very wide variety of markets. Do you trade them all the same way? We don't trade markets, we trade money. Mickey Quennington, who is our marketing director, once introduced me to a former chief executive of this firm, E.F. Mann. The firm to which Haidt gave 50% ownership in his management company in exchange for financial backing. This guy was a tough old Irishman, and he asked me, "How do you differentiate between gold and cocoa in your trading?" I answered, "They are both a 1% bet. They are the same to me." He was outraged. He practically shouted back at me, "You mean to tell me that you don't see any difference between gold and cocoa?" I think if it wasn't for the fact that he liked Mickey so much, he would have thrown me out of his office. I married a very proper Englishwoman who is always concerned that her family considers me a bit crass. I was once interviewed by a reporter from the London Times, who asked me what I thought about the future direction of the London cocoa market. I told him, frankly, I don't see markets. I see risks, rewards, and money. I was the last person quoted in that article. He finished it by saying, "Mr. Haidt doesn't care about the cocoa market. All he cares about is money." My wife read the article and said, "Great. Now I'll never be able to go home. This will just prove to my family that they were right about you all along. I assume that if you trade all markets the same, you probably don't believe in optimization. Optimization refers to the process of testing many variations of a system for the past, and then selecting the best performing version for actual trading. The problem with this fine-tuned approach is that the link between past and future performance is often a very rough one. Absolutely. We have a saying here, it is incredible how rich you can get by not being perfect. We are not looking for the optimum method. We are looking for the hardiest method. Anyone can sit down and devise a perfect system for the past. Are there any technical indicators that you have found to be overrated? Overbought, oversold indicators. None of them seem to prove out in testing. Any types of indicators you consider particularly valuable? Although I don't really trade off of them, there are two that come to mind. First, if a market doesn't respond to important news in the way that it should, it is telling you something very important. For example, when the news of the Iran-Iraq war first came out over the newswire, gold was only able to move up 1.1. Said to myself, a Middle East war has just broken out, and the best the gold market can do is go up $1. It has to be a great sale. The market broke sharply after that. The second item is something that Ed Sikota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that the price is at a new high tells you something has changed. Any other lessons that you learned from Ed Sikota? Ed Sikota actually explained his philosophy one day. You can risk 1% of your capital, you can risk 5%, or you can risk 10%. But you better realize that the more you risk, the more volatile the results are going to be. And he was absolutely right. Besides your partners, who I know were integral in developing your trading systems, were there any other traders who taught you valuable lessons? Absolutely, Jack Boyd, who hired me as a broker analyst. Having read that Handy and Harman had said in their annual report that silver stocks totaled either 3 billion or 7 billion ounces, I wrote a report on the silver market in which I said, according to Handy and Harman, there is either twice as much silver as some people think or less than half. That report went over very big with Jack and helped me land the job. Jack had been putting out trading recommendations for his firm for many years. I found that if you followed all of his recommendations, you would have made money in every year. Finally, I asked Jack how he did it. You have to picture that Jack was 6'4". He said, Larry, if you want to know where a market is going, all you have to do is this. He threw his charts on the floor and jumped up on his desk. He said, look at it, it will tell you. I assume by that, he meant get a perspective of the big picture. Right? Because I don't know of too many people who get rich by taking small profits. Working with Boyd was extremely important form. From the time I met him, I knew that his approach was the right way to do it. In other words, I knew that if you traded across the board, controlled your risk, and went with the trend, it just had to work. I could see it absolutely clearly. Any final words? I have two basic rails about winning in trading as well as in life. If you don't bet, you can't win. Bet. If you lose all your chips, you can't bet. There are two basic elements to Haidt's trading philosophy. First, contrary to opinion of many academics, Haidt is firmly convinced that the markets are inefficient. This means that if you can develop a method that places the odds in your favor, and it doesn't have to be by very much, you can win. Second, an effective method is a necessary but not sufficient condition to win. In order to survive and thrive at trading, you also have to respect market risk. If you don't, sooner or later, it will get you. Haidt controls risk rigorously by applying four basic principles. 1. His system never trades counter to the market trend. There are no exceptions and he always follows the system. The maximum risk on each trade is limited to 1% of total equity. 2. 3. Mint carries diversification to an extreme. First, their system is really a combination of many different systems, selected not only for their individual performance, but also for their degree of lack of correlation with other selected systems. Second, Mint trades in an extraordinarily wide spectrum of markets, encompassing exchanges in the U.S. and diverse market groups, including stock indexes, interest rates, currencies, raw industrial goods, and agricultural commodities. 4. Volatility is continually tracked in each market in order to generate signals to liquidate or temporarily suspend trading in those markets where the risk-reward ratio exceeds well-defined limits. One final observation. After merely earning a modest living at some colorful careers, such as scriptwriter, actor, rock promoter, Larry Hite succeeded spectacularly in the single endeavor for which he had the greatest enthusiasm: fund manager. I found this to be a striking example of Ed Seykota comment. It is a happy circumstance that when nature gives us true burning desires, it also gives us the means to satisfy them.